The Federal Reserve System works every day to support a growing and stable U.S. economy. Across the United States, the Federal Reserve, through its Federal Reserve Education Program, also helps people understand how the economy works, so consumers have the tools to make sound financial decisions. Through this education program, teachers have access to classroom-ready online resources for students from kindergarten to college. Videos, classroom lessons, online education, publications, and more. These resources are all free for educators to use in their lesson plans, or as they see fit. Many of the Federal Reserve System's regional reserve banks, located in 12 districts across the nation, also offer in-person and online professional development that allows educators to deepen their knowledge and hone their craft when it comes to economics, personal finance, and more. Students, too, can take advantage of in-person opportunities by taking tours of exhibits in many of the 12 Federal Reserve banks around the country. Whether a student visits with their family or a school group, they get an in-depth look at how the Federal Reserve works to promote a healthy, sustainable U.S. economy. At the Board and Reserve Banks, students also get hands-on opportunities like internships and participation on student boards, which introduce them to key economics concepts and potential careers in economics and finance. Consumers are empowered to make sound financial decisions through the availability of easy-to-understand resources that explain personal finance concepts, the broader economy, and the Federal Reserve's role in it. Federal Reserve Education is committed to equipping educators, educating students, and empowering consumers when it comes to understanding and participating in our evolving economy. For more information, visit federalreserveeducation.org to find links to resources and Reserve Bank programs offered near you, and follow Federal Reserve Education on Twitter at @FedEconEd.
What is the Fed?
So what is the Fed?
What is the Fed?
What is the Fed?
The Federal Reserve, often referred to as the Fed, is the central bank of the United States.
Congress created the Fed in 1913 to help promote a safe and sound monetary and financial system for our nation.
The Fed includes the Board of Governors in Washington, D.C., which has 7 members, including the chairman and vice chairman.
All of the members of the board are appointed by the President of the United States and confirmed by the United States Senate.
The Fed also includes 12 regional Federal Reserve banks located in cities throughout the country.
The reserve banks serve as the central bank's operating arms and also gather economic information from all over the country
To help the Fed both monitor the economy and get the broad input necessary
To develop and implement effective U.S. monetary policy.
Today, the Fed performs a number of important functions, all with the ultimate goal of promoting a healthy U.S. economy.
One of the Fed's most recognizable functions is conducting U.S. monetary policy,
which involves influencing interest rates and the availability of money and credit in our economy.
Congress has tasked the Fed with implementing monetary policies that promote maximum employment and stable prices.
High levels of employment provide people with more economic opportunities, and stable prices promote growth
By making it easier for households and businesses to plan for the future.
Monetary policy decisions at the Fed are made by the Federal Open Market Committee,
which includes all 7 members of the Board of Governors and presidents from the reserve banks.
This committee meets regularly to assess the conditions and outlook for the economy.
In addition to conducting monetary policy, the Federal Reserve also helps to supervise and regulate the nation's banks and works to promote a stable financial system for consumers, communities, and businesses.
The Fed also works with communities, nonprofit organizations, and others across the nation to address housing problems, promote equal access to credit, and advance economic and community development.
The Fed also promotes stability in the financial system, because instability in the financial system can pose a severe threat to the broader economy and to communities across the nation.
The Fed also acts as a bank to other banks by clearing checks, making electronic payments, and providing the currency that Americans need and use every day.
Our nation's economy and financial system face constant challenges.
The Fed is working every day to address those challenges and is committed to helping foster good economic conditions and outcomes. employment opportunities, stable prices, and financial stability that benefit all Americans.
And we are also the Fed.
To learn more about the Federal Reserve, you'll find a wide range of resources on the Board of Governors website at federalreserve.gov.
Hello. Welcome to the third conference on diversity and inclusion in economics, finance, and central bank, hosted by the Federal Reserve in partnership with the Bank of Canada, the Bank of England, and the European Central Bank. My name is Brian Doyle of the Federal Reserve, and before we begin our program, let me share a couple of pieces of information. First, for those who are participating in the conference via WebEx and who want to ask questions or make brief comments during our discussion sessions, we'll be making use of the raise hand feature, which can be found on the right-hand side of your screen. Session chairs will call on you in order that hands are raised, and will then ask you to turn on your camera, unmute yourself, and then briefly ask your question. Second, for those needing closed captioning, this conference is being streamed live with captioning on the Federal Reserve's YouTube channel, www.youtube.com/Federal Reserve. No captions will appear within WebEx. And now, to begin our proceedings, I'm very happy to turn it over to the Chair of the Federal Reserve, Jay Powell, who will give introductory remarks.
The Federal
Good morning. It's a pleasure to welcome you to today's discussion and to host this third conference on diversity and inclusion in economics, finance, and central banking. My colleagues and I are proud to co-sponsor this conference, along with the Bank of England, the European Central Bank, and the Bank of Canada. We are truly honored by this impressive array of panelists, discussants, and speakers, which include both eminent research economists as well as current and former policymakers from here and around the world. We are grateful for the time, energy, and insights you have committed to this work, and we look forward to the day when we can gather together again in person. To kick off today's discussions, I'd like to briefly touch on these subjects from two distinct perspectives. First, I'll discuss some of the ways we at the Federal Reserve approach issues of persistent economic inequities. Then, I'll review some of how we as central banks are addressing the issues around diversity and inclusion in economics as institutions and as employers. Taking the first of these topics, we know, of course, that an economy is healthier and stronger when as many people as possible are able to work. If entrenched inequities prevent some Americans from participating fully in our labor markets, not only will they be held back from opportunities, but our economy overall will not realize its potential. And those who have historically been left behind stand the best chance of prospering in a strong economy with plentiful job opportunities. Our recent history highlights both the benefits of a strong economy and the severe costs of a weak one. In the later years of the long expansion that ended with the pandemic, the benefits of employment continued to spread more widely and to reach those at the margins of the economy. Prior to the pandemic, unemployment was at 50-year lows. Wages had been moving up, and meaningfully so, especially on the lower ends of the pay scale. Many who had struggled for years were finding jobs. Racial disparities in unemployment were narrowing. In contrast, one of the great cruelties of the COVID recession is the toll that it took on workers who were finally beginning to experience the benefits of a historically long period of economic growth. Those same groups, unfortunately, disproportionately shouldered the brunt of the pandemic's burden. Most entrenched inequities are beyond the power of monetary policy to address. The specific goals given to us by Congress, however, to foster achievement of our dual mandate of maximum employment and price stability, form the foundation of a strong and stable economy. It was with this in mind that my colleagues and I on the Federal Open Market Committee, as part of last year's update to the Fed's monetary policy framework, defined maximum employment as a broad and inclusive goal. This innovation recognizes that a strong labor market delivers broad-reaching benefits and extends those benefits in particular to low and moderate income communities. While monetary policy does not target any particular group of people, when we assess whether we are at maximum employment, we purposely look at a wide range of indicators, and we're attentive to disparities in the labor market rather than just the headline numbers. In addition, as policymakers working on behalf of the entire public, we benefit greatly by seeking out and listening to the perspectives and experiences of people who represent the diverse landscape of the economy. We regularly meet with a broad range of groups as we assess the economy. And as we worked to update our monetary policy framework, we hosted a series of listening events across the country before and during the pandemic, and these conversations factored importantly into our thinking and our new framework. Next, I'd like to turn to an issue that facing many of us at this conference, namely how central banks as institutions and employers grapple with and confront diversity and inclusion within economics. Collectively, we are among the largest employers in the field of economics, which both affects our own workplaces and affords us an opportunity to help influence and shape the evolution of the profession. Throughout my career in both the public and the private sector, I have seen that the best and most successful organizations are often the ones that have a strong and persistent commitment to diversity and inclusion. These organizations consistently attract the best talent, investing in and retaining a world-class workforce. I know that the central banks represented here today are indeed working diligently to do just that. At the Fed, we're hosting events like this one, where high-quality economic research is brought to bear. We're working to foster an inclusive workplace environment where staff can feel comfortable at work and to promote a similarly inclusive culture within the profession. We're working to broaden our reach by recruiting at historically black colleges and universities and Hispanic-serving institutions, as well as by hosting events to promote career opportunities at the Fed. My colleagues and I know that both the opportunities and the challenges are great and that the work is never truly done. Whether you are a researcher bringing your analytical skills to bear, or on the front lines of improving the diversity of the economics pipeline, or perhaps you're in an institution redoubling your efforts to attract diverse talent, your efforts are making a difference. As a group, we're fortunate to have opportunities like this to reaffirm the importance of diversity in our professions, in our research, and in our policymaking. And I'm glad that we are here today to continue this work. Thank you.
First session of a conference titled and I will moderate this session. We have two presenters, each presenting for 20 minutes, followed by a discussion that will talk for 10 minutes, and then by general discussion for another 10 minutes. During the Q&As, please raise your virtual hand using the WebEx feature. When called, please unmute yourself and try to be brief, clear, and direct, avoiding long preambles before asking your question or making a point. We have a limited amount of time, so we would like to give everyone a chance to participate. With that said, our first presenter is Michael Weber from the University of Chicago, presenting the paper titled Diverse Policy Committees Can Reach Underrepresented Groups. Michael, you have 20 minutes, and I will give you a polite reminder when you have 2 minutes left. Please, the floor is yours.
Thank you so much, Cesar, and thanks a lot to the conference organizers for allowing us to talk about this important topic at this conference. I am presenting some current work with Francesco D'Acunto at Boston College and Andreas Fuster at the Swiss Finance Institute in Lausanne, who for many years actually has worked at the Federal Reserve Bank of New York. Next slide, please. So we want to actually start out motivating our paper using actually a picture Christine Lagarde was actually posting on her official Twitter account when she took the helm of the European Central Bank. And so she invited her colleagues from the Governing Council to retreat outside of Frankfurt in the Taunus and mentioned that they had some nice informal gathering. And while I'm not on Twitter, you could actually read about it on all the media, that there was some public outcry, just stressing the point that, besides Christine Lagarde, it's all white men, and whether this actually resembles an open and inclusive discussion. Next slide, please. And now, of course, as Chair Powell was actually mentioning, there are many good and important reasons why we might actually increase the diversity in important committees, but also in our profession overall. And Christine Lagarde herself actually mentioned last year what we label here a legitimacy reason, that, after all, as a committee that makes decisions for the overall society, we should actually mirror the society we are serving. Sharon Donnery was instead actually highlighting the fact that if we have committee members with different experiences and backgrounds, we might alleviate the concern of groupthink and ultimately reach better decisions. Well, of course, there are very important reasons for increasing diversity. The three of us thought, actually, at least with our toolkit as researchers, what we focus on, it's maybe harder for us to empirically actually document these channels. Instead, we actually want to shed light on a channel and mechanism Jay Powell highlighted in 2018 when he said that diverse organizations are also better able to relate to and talk to many different communities. So we label this an inclusive or effective communication channel to which we actually want to shed some empirical light. Next slide, please. So what we do specifically in this paper, we ask the question whether us as researchers making salient the female or minority representation on the Federal Open Market Committee affects the extent to which different groups, think men versus women, white versus minority survey participants, would incorporate the identical information we as researchers provide into subjective beliefs about inflation, the unemployment, and the macroeconomy overall. Now, of course, using observational data, let's say, Chair Powell makes a speech. Of course, it hinders us to causally make statements how actually these speeches affect beliefs. Instead, what we do actually, we recur to or resort to a clean setting in which we actually can keep constant lots of things. And especially what we do, we run a survey on 9,000 Americans in the summer of last year. We elicit subjectives, trust and expectations of individuals in the US, in the Fed, and for employment and the unemployment rate. And then actually we randomize and make salient the female and representation of a Black male member on the FOMC to then understand whether women or Black survey participants differentially would incorporate the identical information we provide into their own subjective forecasts for the macroeconomy. Next slide. So now what do we find in the paper is we show that female survey participants and Black male and female participants that actually see the representation of a woman or of a Black male member on the Federal Open Market Committee are more likely and more strongly incorporate the identical information into their own forecast for the unemployment rate than when they see, let's say, a white male policymaker. Instead, actually, when we look at the response of white male survey respondents in the survey, there's actually an identical reaction independent of whose policymaker they see with the forecast, documenting on the one hand that diversity or making salient the diversity in committees increases the effectiveness of what we call policy communication. Instead, however, it has no negative effect on the reaction on the currently overrepresented group of white men. And the channels through which actually this higher effectiveness occurs, on the one hand, what we label a trust in the Fed channel. So we document that women and underrepresented groups actually are more likely to afterwards express a higher level of trust towards the Fed, but also they actively choose to gather information about monetary policy making. So we document that those two mechanisms seem to be at work. And then in terms of drivers of these effects, we show that what we label a heterogeneous taste for diversity is more consistent with a pure homophily type mechanism. Next slide. So let me just not spend too much time here. So we contribute to this literature on monetary policy communication. Well, there's been lots of work in the last couple of years trying to understand, whether the exact message that a central bank would send or the medium of sending, like social media versus traditional media, plays a role. I think actually we are the first one who actually try to understand whether the identity of the sender plays a role in the extent to which individuals would actually react to the message. And now I want to tell you directly a little bit about the survey setup. Next. So our survey consists of 4 parts. So at the beginning, we just elicit some basic demographics of survey participants, some prior information about monetary policy making, such as what the inflation target is, or for example, who is in charge of setting basic levels of interest rates. But crucially also, we directly elicit prior expectations over the next 12 months for inflation and the unemployment rate. And the second part of the survey, that's the key innovation of our research. Here we just take our 9,000 survey participants, just randomly allocate them into 7 equal-sized groups. We have one control group that doesn't receive any information, just gets a short introductory text, what the Fed is, and sees the official logo. Instead, we have then 6 treatment groups. 3 groups receive information for the unemployment rate, 3 groups receive information for the inflation rate, and then 2 groups see a picture of Thomas Barkin, 2 groups see a picture of Raphael Bostic, 2 groups see a picture of Mary Daly. All 3 are regional Fed presidents. All 3 were non-voting members at the June FOMC meeting from which we draw our forecasts. Next slide, please. Just to give you an idea how those treatment screens in this online survey look like. So here I show you the treatment arm that receives the inflation forecast from the Survey of Economic Projections for 2020 and 2021 from June of last year, associated with a picture of Thomas Barkin, and we directly stress that he was part of the meeting when actually those forecasts were made. Next slide. Two groups here, a picture of Raphael Bostich, again, stressing his role and title. Here again, we see the treatment arm with Raphael Bostich for inflation. Next slide. And then two groups here, a picture of Mary Daly. And instead here, this time we see actually the group that saw Mary Daly and also saw the unemployment forecasts for 2020 and 2021. Next slide, please. Then actually the remaining two parts of the survey is on the one hand, eliciting the trust in the Fed via two complementary ways, to the extent in the extent that the Fed adequately manages inflation and the unemployment rate, but crucially also cares about the well-being of all Americans, including people like themselves in the survey. And then we elicit posterior inflation and unemployment expectations. And the way we do that is we follow the New York Fed survey of consumer expectations. So we have a full range of potential outcomes for the inflation and unemployment rate, pre-specified bins, and then we ask survey participants to allocate probability mass to those future scenarios that has to add up to 100 before they can continue. And then the last part, we elicit a rich set of observables: age, income, marital status, number of kids, political leaning, and so on. Next slide. So we do that online in cooperation with Qualtrics. We have about 9,000 respondents. We targeted an equal gender ratio and a representative population in terms of age, education, and region. We slightly oversample African American survey participants because we were concerned potentially because of lack of power, we might not find any effects. And so we wanted to make sure that in case we would not find results, it couldn't be due to lack of statistical power. And then we actually directly registered our hypothesis via the AEA registry just to make sure that our hypothesis were ex ante registered in the data. And then I'll also talk a little bit about some follow-up survey that we did 6 weeks later. Next. Like for today, I want to actually focus on the reaction of 4 groups. I want to compare the reaction of white men, white women, African-American men, and African-American women. And actually just for, graphical illustration, I focus on raw data patterns, comparing treatment effects, so the effect of making salient the representation of Mary Daly or Raphael Bostich relative to Thomas Barkin in the raw data. But in the paper, we show that all the results are robust in a formal regression setup, and we have actually controls for many different observables and about 65 different fixed effects. Next, please. And so now what I show you today is actually I want to focus on the share of survey participants in different subpopulations, so white men, white women, black men, black women, in the extent to which our provided forecasts result in anchored expectations. And what we mean by that is just a simple indicator that equals 1. If now my individual survey participant puts the most probability mass on the bin in the subjective distribution, which covers one of the 2 forecasts that we provide from the Survey of Economic Projections. Let's say that I participate in the survey and there's a bin that is between 8 and 10% of the unemployment rate over the next 12 months. I put most probability mass on that bin, then the indicator would be equal to 1. It's just a simple graphical way of indicating the extent to which individuals would incorporate the information we provide from the Survey of Economic Projections in their own subjective forecast. Now, of course, we have way more information from the whole subjective distribution, and so we also directly see to which extent individuals adjust their mean expectations for inflation and the unemployment rate, but actually I refer to the paper for details. Now what we want to do is just actually compare the treatment effect of providing information, seeing different policymakers relative to not seeing any information. Next, please. So here in this graph, we now just plot the share of survey participants within individual subpopulations that actually has anchored expectations according to our definition. So here first, white survey respondents In dark gray, we have male respondents. In light gray, we have female respondents. And so here, the first thing I want to draw your attention to, if you look at the two left bars, those are survey participants not receiving any information. And compare those to all the other bars to the right, we see that actually providing information is useful in anchoring expectations to the extent that everyone in the treatment groups, independent of whether it's Barkin, Bostic, or Daly, has actually a higher share of anchored expectations relative to survey participants that do not see any information. Then the second thing I want to stress, let's say we focus now on female participants in the survey. If you compare the response in the control group relative to Thomas Barkin, you see a treatment effect of 16 percentage points. Now, however, if you compare the share of anchored expectations in the Daly and Bostic treatment groups, you see that the share of anchored expectations is about 25 for Mary Daly and 50% higher for female participants in these two treatment arms relative to when they see Thomas Barkin. Let's just recall, we see identical information. The only thing that differs is that we as researchers make salient the presence of Mary Daly or Raphael Bostic relative to Thomas Barkin. Third thing I want to highlight is that actually, if you look at the male respondents for Barkin, Bostic, and Daly, similar height of the bar, just showing that there is no differential effect across treatment arms, or saying it differently, white men are not put off when they see diverse representation on the FOMC. Next slide. Now here, same setup. This time we focus on black survey respondents, dark gray men, light gray women. So here what you see is similar qualitative pattern than before. However, this time let's focus on black women first. Treatment effect of getting information when they see Barkin, 4 percentage points. Instead, when they see Raphael Bostic, treatment effect is 10 percentage points. And finally, if they see actually Mary Daly, the treatment effect is 16 percentage points, so 4 times larger than when they see Thomas Barkin. And instead, we see for black male respondents roughly equal response across different treatment arms. So here again, we see that making salient the diverse representation has a big impact on the share of survey participants that has anchored expectations, here for the subsample of black female survey respondents, and for inflation and this quantitative mean expectations, we see similar patterns. Next, please. Now, in the last few minutes, I want to briefly shed some light on channels that might mediate these effects, and the first one is actually a trust channel. Next, please. And so here we actually just document the distribution of answers for the control group. Recall they didn't see any picture of a policymaker, meaning that I think this is equal to an unconditional distribution. And here we compare in gray, white male respondents' responses versus everyone else. And here 7 means high level of trust, 1 means low level of trust. And for both trust outcomes, adequately managing inflation and the unemployment rate, caring about the well-being of all Americans, we do see that while male survey respondents have unconditionally higher level of trust. Now what we want to see is, do black and female survey respondents become more trustful once they see minority representation and diverse policymakers on the FOMC? Next slide. And so here what we do, we focus on the share of survey participants with a low level of trust, meaning that they have an answer of 1, 2, 3, so they have very little trust. And now if it's indeed the case that women and black survey respondents become more trustful, we would expect a lower bar, so to speak. And that's effectively what we see. Left figure, white survey respondents, female respondents actually have a lower level of distrust when they see Raphael Bostic or Mary Daly relative to seeing Thomas Barkin. Black female respondents similarly like a 6 or a percentage point lower level of distrust when they see Bostic and Daly relative to Barkin, and similarly for black male respondents about 8 or 9 percentage point lower level of distrust when they see Mary Daly or Raphael Bostic. Next, please. So we saw that one channel that actually increases the extent to why people incorporate information from the Fed when they see diversity representation is a higher level of trust. Alternatively, and complementary, it could also be the case that, ex ante, if I see that it's all white men on the FOMC, I might be less interested in gathering information and caring about monetary policy making than when I make salient the representation, let's say, of women on the FOMC. And so what we do here is first actually documenting indeed ex ante before we highlight that Raphael Bostic and Mary Daly are member on the FOMC. In June of last year, we see that ex ante lower level of knowledge about basic pillars of policy making among women and among Black survey respondents. So again, there's some scope potentially for this channel. Next, please. So what we now do to see direct evidence that, let's say, women become more interested in actively gathering information about monetary policy making is through actually a follow-up survey that we did 6 weeks after our initial survey in October of last year, where we just elicited very similar questions than in our main survey. And then the key part of that follow-up survey was an information acquisition experiment, where we this time randomly split survey participants into 3 different groups. And we told them, before you continue on the survey, we want to give you a choice between 2 different articles and subsequently elicit a few more questions. The first group just had a choice between 2 institutions, CBO, Federal Reserve. The second group had a choice between Phil Swagel, and we highlighted Mr. Swagel, from the CBO versus Mr. Clarida from the Fed. So here this time, again, same institutions, but choice to read an article about 2 male policymakers from separate institutions.
Michael, you have 2 minutes left.
Thank you. And the last group had a choice between Mr. Swagel from the CBO and Michelle Bowman from the Fed. And then we wanted to understand whether women are differentially more likely to choose the article about the Fed in group 3 when we highlight that it's an article about a female policymaker relative to having the choice between 2 male policymakers in 2 groups and just between the institutions in group 1. Next, please. That's indeed what we find. So here we split the sample in male respondents and female respondents, left and right panel, 3 different groups, the institutions group, the male policymaker group, and the female policymakers group. And what we plot here is the share of survey respondents that chose the article about the Fed relative to the article about the CBO. What you see here, let's say if you compare the far right histogram, women choosing the Fed article in group 3, you see that women are about 10 percentage points more likely to choose an article about the Fed when actually it's about a female policymaker than women actually choosing the article about the Fed when it's about a male policymaker instead of a male policymaker in the CBO. This also holds true if you compare it to the difference for male survey respondents. So what we call here the double difference is about 10 percentage points, so a substantially larger share of women chooses to acquire information about monetary policy making when actually we highlight that it's about a female policymaker. Next, please. And so in the paper, we directly show that us making salient the presence of Mary Daly or Raphael Bostic indeed increases the perceived presence of minority and female policymakers on the FOMC. That's actually true independent of gender and race. Even white men update upwards their presence of female or minority representations. And also we show that it's not the case that people react more to seeing Mary Daly because Mary Daly is very well known and people recognize her. Across the board, there is actually an equal level of recognition. And then before concluding, I want to actually show you
mine is
next.
You
Yes.
want to, yeah.
I'm about to wrap up. So we just directly show that our results are more consistent with what we call taste for diversity instead of homophily. Next. And so here we just show that, if you compare this time, like to which extent do you support quotas, let's say for the FOMC, this time you see white men very much against it, instead everyone else in favor of it. And so let me conclude. Next, please. So what we do in the paper is we try to understand whether actually having a more diverse composition on important policy bodies like the Federal Open Market Committee might actually improve policy making through a communication channel. And especially we document that female and Black survey participants are more likely to incorporate identical information into their own forecast when we make salient Mary Daly or Raphael Bostic on the FOMC. They have a higher level of trust subsequently and are more likely to acquire information about monetary policy making. There's no offsetting effect on white men. And of course, there's still lots of things to be learned, like, what is the optimal degree of diversity in these things, and we have nothing to say in our current setup of the survey. Thank you. Now I'm looking forward to Randy's discussion.
Thank you, Michael. We're discussing Randall Aki from University of California, Los Angeles. Michael, Randy, you have also 10 minutes, and I will give you polite reminder when you have 2 minutes left. The floor is yours.
Great. Thank you for having me. Next slide, please. Great. So the research design is, it's a really wonderful one. It's a randomized control trial, about 9,000 participants. So, really nice sized survey. Again, the idea is to understand how race or gender of the FOMC affects the public's unemployment forecasts, inflation forecasts, and trust in the Federal Reserve Bank. And what primarily the work that was done was that reports were provided to participants, survey participants, and they randomized the FOMC's photo. And again, there were 3 treatments, Thomas Barkin, Raphael Bostic, and Barry Daly, and there was a control group where the same report was provided, but there was no photo. Next slide, please. And what they find is that white women and black women form unemployment forecasts within the FOMC's forecasts when Bostic or Daly are shown, and the agreement is lower when there's no photo provided. And black men are more likely to form agreement when Bostic is shown. And interestingly, they find no results for Hispanics. And one of the, really useful or perhaps potentially useful results is that there are no negative effects on white men. There's no backlash or there's no sort of anti-diversity sentiment, what have you, at least in their study for now. Next slide, please. And they also find that female and black subjects have less distrust when either Daly or Bostic are shown. They use a Likert scale for this. And for Hispanic respondents whose ethnic group, again, they note this explicitly. This was not part of the research design, not represented on the FOMC. They detect different patterns. Hispanic men tend to be more distrustful, actually, when exposed to a female or non-white FOMC member. So again, interesting results that have come out of the research. Next slide, please. And so what I thought was quite interesting, and the work that was done by the authors was to try to explain some of these, these results. And they really had these 2 hypotheses, which are quite interesting and quite plausible. One is homophily, or a taste for that's one mechanism, sort of, your own group. And the other is a taste for diversity, sort of preference for just a diverse group of decision makers. And they conclude that there's a taste for diversity are potentially probably driving their results. And they base this on some, pretty sound reasoning. The fact that female and black subjects react similarly to Daly and Bostic, and homophily would say that they should respond actually better or more in a substantial way to their own group, either a female or a black subject FOMC member. And there's little evidence that there was differences amongst those 2 populations. Next slide, please. So I find that interesting, and I find it, sort of compelling. But I still think that there might be some more to think a little bit about. So one again result that I noted earlier is that there's no adverse impact of diversity on the beliefs of non-Hispanic white men, and that result is sort of a useful result, because it means that increasing diversity may mean that there isn't a backlash and there isn't sort of a cost to bear, perhaps. And the authors note that perhaps this is because the non-Hispanic white men who are being surveyed believe that still the majority of the FOMC is influenced primarily by white men. And so one of the pieces of evidence that the authors use to show that that's possibly not the case is that female and black subjects should not react to diversity salience either because they would think a white male majority drives the decisions. Next click. But perhaps this perception of diversity that by the group of female and black subjects is that some diversity is better than none. Therefore, they don't have to believe, their belief doesn't have to be as symmetric as it is for white men, white male subjects. So that, there's this, anything is better than nothing sort of a situation. And so they can still perceive that the FOMC is, primarily comprised of white males, but having some voice on that FOMC is again, useful for them. So again, that symmetry doesn't immediately speak to me. Next slide, or not, yeah. And then second, another piece of evidence that the authors use is that many treated white men in our manipulation check report a perceived FOMC demographic composition in which white men are not the absolute majority. So again, trying to validate the fact that the perceptions of the white male subjects being surveyed, don't necessarily believe that the white men are the majority of the FOMC, and I think that's useful. I do think that though, and I think speaker just mentioned this as well, that we don't know the appropriate threshold. Next bullet point. Yeah, it's probably quite difficult to know where the threshold is, but nevertheless, there still might be sort of this perception that the majority of the FOMC is governed by white males. And so I do question whether that's sort of in the back of the white male subjects' views at this point. And again, I don't think that's testable here. I don't think it's possible, but I do think that might play some influence. That again, one or two individuals does not dominate the decision making, and therefore may not change the perception of white male subjects, survey subjects here. But again, it's difficult to disentangle here. Next slide. And the other part that was really fascinating and a little underpowered because of the sample size was the response from Hispanic population. And so again, potentially it's due to just the relatively small sample. But the part that I really wanted to emphasize is that race for this group was not considered. And Hispanic/Latino is an ethnic group and it's not a race. And so it's hard to know which group this would actually more align with if race were considered in this scenario for this population. So, the question is if they were included with the Black population or the white population or an indigenous population, perhaps, would they be sort of more aligned with the existing results you found, and or would they add additional power because of more observations to those different groups? So I would emphasize thinking a little bit about that in the future. These aren't, because Hispanic doesn't mutually exclude one from being one or the other race, and again, it would be something that would be worth thinking a little bit more in depth about, because these are all socially constructed categories anyway. Next bullet. Yeah, and overall, it leads me to wonder if different things might be salient to different populations in terms of representation. And so, again, this is not part of the research, but this is something that makes me think a little bit broader on what this research.
You have 2 minutes left, sorry.
Sorry?
2 minutes left. 2 minutes left.
Okay, yeah, I think this is my last slide. Overall, this is what sort of inspired this research. I think inspires other thoughts, is that perhaps in some cases race matters for certain groups or populations. Other times it's gender. It could be ethnicity, as Hispanic ethnicity. It could be sexual orientation. It could be language saliency, right? Does one speak Spanish? Does one speak English? Does one speak French? Depending on the location you're talking about. And those sorts of congruence of reference groups might matter in different, different situations, different populations, different organizations. Or is there a hierarchy? Does it sort of cascade downward? One is of primary importance to me and then a secondary. And again, this research wasn't intended to do that. But again, I think, it was really nice because it inspired these thoughts of, I wonder how this functions here. And I wonder how this functions for this population in particular. Next slide. I think that must be it. So again, I thank you very much. It was a really interesting paper, and I really applaud the work taking this in.
Thank you, Randy. So now I will now open the floor for questions. Please raise your virtual hand. When called upon, you'll be moved from attendee to panelist. And please turn on your camera and unmute yourself. We have a limited time, and so please be brief when asking your question. When you finish speaking, please mute yourself. So I don't see any question yet. So maybe Michael can answer some of the comment of Randall.
Yeah, Randall, first of all, thank you so much for a great and super insightful and helpful discussion for us. Actually thinking about these questions will certainly help us actually improve the paper. So like a couple of thoughts actually to some of the important points you raised. So like, why don't we see this, what we call in the paper, putting off effect for white men? So like, if it's indeed this heterogeneous taste for diversity, rather than, they anyway know they have the majority on the FOMC and might just in this manipulation check where we show that it doesn't seem to be the case, potentially lie or just want to what's sometimes called like, kind of an experimenter demand effect. We want to please the experimenter. But what we actually do show now is that even within the sample of white men, if this heterogeneous taste for diversity is true, we might see that more, let's call it progressive or liberal white men might actually also react more strongly to seeing Mary Daly or Raphael Bostic relative to seeing Thomas Barkin. And so we use different proxies, for example, like, are white men declaring they support the Black Lives Matter movement? Do you think that women are discriminated in the US? Are they stating they lean towards the Democratic Party, rather Republican, and younger than, let's say, I think 40 years? And across the range of proxies, we indeed find that white men that seem to be more progressive according to these proxies are in fact indeed actually reacting more strongly in the sense of incorporating the information into their own forecast when they see Mary Daly or Raphael Bostic relative to Thomas Barkin. Now, I don't know, I see a hand up, so maybe I can come back to Randy's comments afterwards.
Yeah, thank you, Michael. There's two hands right now. So the first hand is Chara Scotty. Chara, you want to come in?
Yes, hi. So Michael, very interesting paper. I really enjoy listening to it. You might have touched upon this, but I was wondering, and sorry if I missed it, but I was wondering if you could elaborate a little bit on, whether there is a threshold or like how much diversity you actually need to get to a good spot. And, whether you have in mind any way to actually assess whether, a little bit of diversity has the same impact as a lot of diversity, whether you just need a little bit or more than that.
Yeah, Chiara, that's actually a super important comment. And so in our current setting, unfortunately, we cannot really answer that because we only show that there is some representation, let's say, of women or of African American on the FOMC. But in this type of survey experiments, what is crucial is that you have to provide truthful information. So we could not, artificially now show a picture, let's say, of a Native American or of an Asian American and state that this person was on the FOMC if it was in fact actually, if he was actually or she was not. So it's a little bit limited in the extent to which we can actually indeed show what the optimal degree of diversity is. But we definitely are thinking among our us authors whether maybe we can show a picture of Mary Daly jointly with, let's say, maybe Raphael Bostic to see actually whether showing both of them together or whether maybe some different combinations, let's say, also Michelle Bowman and Mary Daly, actually two women together might make a differential role. But so far, actually, we just state that it would be crucial to better understand what the optimal degree is. But our initial aim was first documenting the extent to which actually the showcasing diversity would actually matter for the efficiency of monetary policy communication. But definitely a super important question.
Thank you, Michael. So the next person is Xiao Hixin. Sorry if I mispronounce your name. So now
no worries. Yeah. Thank you. My name is Chui Shin. I'm an economist at the board. Thanks for the great talk and a wonderful discussion. So trust and attention are mentioned here as potential channels. At the same time, for instance, at the Glasgow climate talks, there's a lot of mention on not only the generation, but also gender gap. Can differences in terms of policy interests and preferences also contribute to the results?
It's such an important comment and question. So, like, we do indeed see that, from an ex-ante perspective, if you look at the expectations for the employment rate and the inflation rate, there are systematic differences across gender and across race in our setting. So, like, that's why in our regression framework, which we didn't show today, also directly conditioned for prior knowledge, for prior expectations, and you still see that, let's say, women and African American survey participants incorporate the identical provided information to a larger extent when they see Raphael Bostic and Mary Daly relative to Thomas Parkin. So, like, it's indeed important, but actually we show that making salient the representation matters over and above.
Thank you, Michael. Now the next person is Liz Evans. Please go ahead with your question.
Hi there. Thank you for the great paper and presentation. So with regard to the little response from the Hispanic population and also not including the racial identity of the Hispanic population, what are your plans to capture that in the further research? Do you plan to include for Afro-Latinos and Afro-Arabs and the growing identification of multiculturalism that exists within our population?
Yeah, Liz, those are all important considerations and questions for additional research we plan to do. Like in our setting, like we were to some extent constrained based on the actual composition of the FOMC in June of last year, because we wanted to make sure that everyone we show has an identical official title, was a regional Fed president, but crucially also was a non-voting or alternate member as of that meeting. So therefore, we effectively were limited to choose Raphael Bostic and Mary Daly. We couldn't also choose, let's say, I think as Randall was mentioning to some extent, let's say a Latino policymaker, because we didn't have a Latino policymaker that was a non-voting member of the FOMC of June of last year. And then, of course, if you would actually want to go into even subgroups that actually are currently not represented, we would actually have a hard time in actually doing it in our current research setting, which of course doesn't mean that once you go away from understanding the role of diversity on expectations formation and trust, that you couldn't do that. It's just within the domain of the FOMC, we are limited what we can do. But I totally agree that it's crucial and important to study these questions.
Thank you, Michael. Now the next person is Michael Herman. With your question.
Yeah, thank you very much. Michael, this is probably less a comment to you because I've made this comment to you already earlier on when I discussed this paper already. But there's so many central banks here on this organizing committee that I want to make it again. And maybe, Michael, you do want to take this up in future research. I mean, one thing that struck me here is, you show pictures of policymakers. Now, of course, by definition, we have very few underrepresented groups as policymakers, whereas we have many more members of underrepresented groups at the staff level. So I think it would be really interesting to sort of see, what is the difference between getting the statement and the logo of a central bank, and then getting the statement and a picture of a staff member, and the statement and a picture of a policymaker to understand, to what extent do you need the authority that comes from the office? To what extent can we also send out our staff, where we have a lot more diversity, to actually be an ambassador for our central banks and generate trust and sort of, instill knowledge about the central banks? To me, that would be really a great experiment to do. I understand you cannot do this in the current paper, but I think that would be interesting. Thank you.
Yeah, let me just echo and totally, agree with what Michael Herman was saying, that it is certainly, a little bit away from our current setup, crucially to understand, the identity of the center, to which extent it matters, and going to staff economists and actually exploiting here the larger extent of diversity compared to the official policy-making body. Maybe actually One thing I briefly want to touch upon, given that we didn't mention it, so like we do see very stronger effects for the unemployment rate than for the inflation rate. And so our reading of that result is that while we do see, like, for example, huge differences in the realized unemployment rate by race and gender, when you look at realized inflation by race and gender, in fact, actually it differs way less, and actually unconditional, there's no difference by race and gender, which to us actually potentially means that for variables where it's actually, we see stark differences, it is crucial to have people in the room when making decisions that actually represent these different experiences and backgrounds, for the extent for which people think actually that they have a chair at the table. So like, I think it's crucial not only to, I agree with you, Michael, to understand also for staff economists, but that's why we focus first in our setup on the actual decision-making body, because it seems to play a role in some extent, to some extent in which people react.
Okay, so I think we have, there's no more hand, but the Randall has his hand, maybe very quickly, 1 minute at most. Yeah.
Thank you. I just was going to emphasize, I was going to say the exact same thing Michael Ehrman just said, that, from the outside, most people don't have a perception of the difference of, the functioning of the FOMC versus the Federal Reserve Bank. So it does seem really a cool opportunity to be able to increase the diversity by using a staff economist of a diverse types of background to enlarge the pool of candidates for our future study, for instance. So yeah, I think that's a really, really great idea.
And also it may be interesting also to do for the central bank like the ECB and Bank of England and other central bank to see if these features also is against US too. That would be cross country. Okay, that's a good transition. Thank you very much to the presenters and discussant, and as well as the participant for questions. So we're going to the second presenter. The second presenter is Paola Profeta from Bocconi University. She will present the paper, The Women Matter in Monetary Policy Board. Paola, again, you have 20 minutes, and I will give you a polite reminder when you have 2 minutes left. The floor is yours. Thanks.
Thank you very much for the introduction, and thank you very much for giving me the possibility to present this paper today. This is a joint paper with Donato Marcendaro and Davide Romelli. They are the experts in monetary policy. I am the expert in gender economics. So we joined our forces and tried to answer this question: do women matter in monetary policy boards? So next slide, please. In order to motivate our paper, we started from a simple observation. So there is an increasing representation of women in central banks, especially in top positions of central banks, and this has been constant during the very recent period. So today we have more than 15 central banks that are headed by women, and this is quite different from the past. So there is also a lot of attention from researchers and in general also from the policy debate about how the representation in terms of gender composition of committees in general, or representation of women in institutional positions may have any relationship or even impact, if you're able to identify a causal relationship, on outcomes. For example, on policy making, on the agenda which is decided, etc. So we have not found a precise paper and analysis with respect to monetary policy decision making, although there is a lot of interest in recent research on the effects of board composition with respect to this outcome. And there is also this general, let's say, idea, which is shared by many, that diversity or heterogeneity may be beneficial for the outcomes, for enlarging perspectives, for taking decisions, and in general for a different style of leadership in decision-making positions. So we try to apply this to the context of monetary policy. Of course, there is also a lot of attention, in particular by a very large literature on women representation in corporate boards. And so if you give me next, okay, thank you. And corporate boards, we know quite a lot now, because we have seen several papers trying to understand whether women matter and the presence of women matter in corporate boards. In particular, thanks to the introduction of board gender quotas in several contexts, we know we are also able to identify somehow causal effects from the presence of women in board gender balanced leadership and several outcomes. But while this is something that we have seen in the literature of corporate boards, we don't know a lot about central banks. So basically, our question is, what is the relationship between the gender composition of monetary policy committees and monetary policy decisions? And what I'm going to present, I mean, the paper that we are going to present is more, has a contribution more on the descriptive side, in the sense that we collect a lot of data and deliver information and kind of picture of the presence of women in monetary policy committees and monetary policy decisions. We are not able to identify causal effects, but we are able to give you a broad picture of, let's say, women's representation in this context, which is particularly important because, as we know, deciding upon monetary policy is particularly critical for the economies worldwide. So our contribution will mainly be on a collection of data on women in central banking, which, as you probably know, are not immediately available. So this is not an easy task. So in the next slide, okay, I will present you, let's say, the major contribution of these papers. First of all, as I told you, we are going to present a new data set, which is quite complete and precise in terms of information related to the members of monetary policy committees in 86 countries. So we managed to reach a large number of countries. And for the period from 2001 to 2017, we also managed to reach a large amount of time, although probably less than what we initially planned. So I'm going to present you a measure of gender representation in central bank boards for this large sample of countries, and also evolution over time, which is the picture that I plan to present today. Then we make some additional effort with respect to this descriptive contribution, which is to investigate what are the main drivers for this increased presence of women in central banks. We will see that there is an increasing trend, so that the presence of women is increasing in this position. And we would like to understand whether there are some regularities or some characteristics that systematically are associated with the increasing presence of women in central banks across countries. And then I'm also trying to draw some implications for the conduct of monetary policy. Of course, this part is also not completely an identified causal relationship, as I said, but interesting correlations. So let me go to the next slide to tell you how we position this paper into the large literature on, let's say, women's representation in decision-making positions, which is a large literature. It's also very interdisciplinary because we have contribution across different disciplines. For example, not only economics and finance, but also management, but also in political science, for example. There is a lot in terms of studying the presence of women in decision-making positions. And what we know so far from the literature, more specifically on monetary policy committees, is, for example, that there are contributions that try to understand what's the value of diversified boards or diverse boards or heterogeneity, for example, and what are the regularities associated with the heterogeneities, what is the impact of educational career clear tenure or internal versus external members on the voting behavior, and also with respect to the popular, approach, which is we would like to understand whether men versus women have a more hawkish versus dovish attitude. So theoretically, that is not so clear, because on one side we would expect that the women have more dovish attitude, so they care more about unemployment rather than inflation. But on the other side, we also know that women are somehow scarce, and scarcity is represented in this position, and so probably having a more hawkish reputation is easier for them to be somehow appointed to this decision-making positions. So at the end, it's an empirical story which we would like to also contribute to explain. The dissenting behavior of female members is also well documented by a previous paper. And as I told you before, we also related to a large trend of gender diversity and the presence of women on corporate governance, on boards of directors. For example, I have worked extensively on the presence on the introduction of board gender quotas, in particular in Italy, and the fact that this has, and in this case we can talk about causal impact, and the fact that the introduction of board gender quotas has, for example, in particular on the selection of the board, so the characteristics of the board, so the qualification and other characteristics in terms of selections, and also on the outcomes in terms of performance, but also in terms of stock market reaction. And we also know that there is a large literature, for example, related to risk preferences. So women tend to be more risk averse than men, and this has been used as one of the arguments. Of course, there are a lot of caveats now with respect to this basic statement. And this has been used several times as an argument to understand why women do not reach top positions, or somehow it's one of the explanations behind the existence of the so-called glass ceiling. So, as I said, we are going to contribute mainly in the broad literature of women's representation in decision-making position, and in particular in the context of monetary policy. Next slide. This is already the first, let's say, type of result that I'm going to present you, which is, as I said, a representation of the situation. So basically here you see the share of women in monetary policy committees. In this picture, we represented the situation in 2017, but we have data that are reported, of course, in the paper for the entire time span from 2001 to 2017, and we have 86 countries. And you see that there is a large variation across countries. There is, this geographical distribution. So it's pretty evident that there are countries, almost 50% of the countries where the monetary committees do not include any women, so it's zero. The average share is around 15%. There are countries, for example, such as Canada or Norway, with a very high share, so between 50% and 60%, but also other countries that have the same percentages. So this is the first picture. How do we get? Did we get to this picture? Of course, it was not easy. It was mainly a work of manually collecting information, which are sparse, not organized, and not easily accessible. So basically, the main challenge for our work was really to construct the data set, which I hope will be useful now, let's say in general, also for other research. And so we had to go into the directories and identify the members of the boards, and also identify their gender. And many times we had to search manually for a picture or for other information, because those are not available in the directories. And so just to give you an idea, in the next slide, this is the information available, for example, in central bank directories and statutes for the UK, where you see what type of information is reported. So we have the name, basically, of the governor and deputy governors and the members of the monetary policy committees. We only have the names, so then we have to reconstruct the other characteristics, in particular the gender. Next slide, please. This is another example of the type of information, the type of data that we have dealt with. And in this case, we have Norway and the source is the central bank annual reports. And the next one. In other cases, for example, here we have Ethiopia and Kenya. We have the pictures of the members. So in this case, you also know if they are men or women. Okay, so if we go to the next slide, I can show you the other important result from this collection of data, which is the evolution over time, which actually confirms our expectations. So basically, across time, we have moved from, on average, 11% of women in monetary policy committees in central banks to the current level, let's say in 2017, where we stopped the data collection at around 17%. The size, it's important to say that the size of the committee has remained very stable. So this really means that there is an increase of the presence of women. In the next slide, we see a similar increase also for the share of women acting as governor or deputy governor. And even in this case, the increase is from less than 5-6% up to 15%. For example, if we look at the governor and deputy governor is even a little bit higher. So we have in this period of time really a big change in terms of an increasing presence of women, in terms of increasing diversity, and these numbers are really, let's say, showing the picture. So this is one of the characteristics. This is something that we can find also in other contexts, not only in monetary policy boards, but I think it's also important if we can measure this type of progress. In the next slide, I give you some additional couple of pictures of the data from the data that we collected. In this case, we present the percentage of women in monetary policy committees that never had a woman for the period 2000 to 2016, and so I compare with those with one woman and those with two or more women. And basically, you can see here from the picture that the increase is driven mainly or mostly by central banks that already had two or more women in monetary policy committees that increased even more, rather than those with zero, which remained a quite stable percentage, remained at quite stable level. So if things start to move and so there is an increase in presence, then it's easier also to increase even more, rather than starting, let's say, from zero. So this is also something that I think it's interesting in terms of the dynamic of this gender balance representation. The next one presents you a division by region, and here it is clear that North America has the higher share of women in those positions, followed by South Africa. And so if you divide by region, while, for example, South America lags really behind with respect to the rest of the other parts of the world. And we also see some heterogeneity by income groups. So the low-income countries have a higher share. This is probably driven by South Africa, and then the middle, and then also the high. And you also, if you compare from 2002 and 2016 in terms of the evolution, there are also interesting heterogeneity. So let me move to the next part of the analysis. Let's say, So that says, then in the paper you also find additional, let's say, descriptive evidence of the data set. And as I said, I hope that the data set will be useful in general to assess and really measure the progress in terms of women's representation in one of these dimensions, which is monetary policy, which is particularly important for our economies. Then what we do in the next step is to try, as I mentioned before, try to understand if there are some irregularities or some factors, or somehow some variables which are significantly related to the share of women in monetary policy committees. And here we investigate in particular several variables. I mean, depending on the data that we have collected, we have, for example, a variable which captures the staff gender ratio. So how many women in general are employed in the central banks. The country gender equality index from the World Economic Forum. The World Economic Forum every year builds an indicator that captures gender equality according to several dimensions, and a synthetic indicator for.
Sorry, Paula, you have 2 minutes left.
Yes, for the indicators. An indicator of central bank independence and other variables. So in the next slide, you see the first results of this. And in this case, the next slide, please. What I see is that basically all these variables do not show any significant relationship with the share of women in monetary policy committee, apart from the staff gender ratio. You have different columns because we add some controls. This is fixed effect, country fixed effect, time fixed effect variation. So it's a little bit demanding. A specification still is a correlation. So we find a relationship only with the staff gender ratio. Next slide, please. So this is the second part of the analysis, which is once we have these women in this position, what we can say about, let's say, the outcome of performance or what they do. And what we do is to estimate a standard Taylor rule, where the dependent variable is the interest rate, target interest rate in each period, and see how this depends on both the inflation, the output gap, the lagged policy rate, and we augment the standard interest with the share of women and an interaction between the share of women and inflation. And you see here what is interesting is that this interaction terms turned out to be significant, positively significant. So it means that for the same level of inflation, countries with more women are more likely to set higher interest rates. So in other terms, to have a more hawkish approach with respect to men. So to be more aggressive in fighting inflation. And this is the main result of this part. Of course, we run several robustness checks that we are not able to explain now because I am a little bit late. So we run not only an ordinal least square, but also GMM. We use annual data, but we also use quarterly data. And in the next slide, you see that the result is the same if we use, for example, a dummy, which is equal to 1 if the Monetary Policy Board has at least a woman present and 0 otherwise. The results are confirmed. In the next slide, the results is confirmed also if we use the unemployment gap instead of the output gap.
Sorry. Maybe you want to wrap up? We basically out of time.
Yes, I am done. And then in the next one is more robustness test that you find in the paper. So my last slide, which is the next one, is we try to test this a little bit more precisely, looking at the Swedish Central Bank, where we have detailed information on the rate proposed by each member of the Monetary Policy Committee in each meeting from 2000 to 2017. So there are around 125 meetings. 733 policy changes, and the 18 members, 10 are men and 8 are women. And in this case, we look at age and we look at gender. Basically, age does not have any significant relationship with the voting process. So with the policy rate proposed by members of the board. While if we look at age, we can and gender, we can
Sorry,
confirm.
Paola, you may have to wrap up. Sorry about that. Yeah, you may have to wrap up. Yeah.
Yes, it was my last word. I have a last slide with the conclusions, but if I don't have time, I think that I can stop here.
Okay. Thank you very much, Paola. And the discussant is Michael Ehrman from the European Central Bank, ECB. Michael, you have 10 minutes, and please go, and I will give you a polite reminder we have 2 minutes left.
Okay, thank you very much. Thanks a lot for having me here and assigning me this very interesting paper, Paola. I think this is really a great paper. Obviously, everything I'm going to say here are my own personal views, not those of the ECB. So next slide, please. So I think it became very clear in Paola's presentation, you know, the big asset underlying this paper is the data set. I mean, it's very rich. I think this was a lot of hard work. It's not easy to actually dig up all this information. I think this is a big asset. And, you know, this generates a lot of appetite for more analysis. So, you know, I think this is mainly what I want to focus on in my remarks here. I think right now the paper is relatively narrow. In particular, if you compare this with the title of the paper, which is very broad. The question is, do women matter in monetary policy boards? I presume your answer would be yes, but then of course we want to understand why and, you know, how does this matter and in what dimensions? So it's a very broad question, and I think right now the analysis is very narrow. I think you can do a lot more with the data that you already have, and this is mainly the thrust of my comments. So next slide, please. So the first part of the paper is basically a descriptive analysis of the data set, and Paola spent most of her presentation on this because, again, this is the big asset of the paper. Now, I was struck a little bit about the tone of the paper. So the first sentence in the paper is, women are increasingly represented in central banks, full stop. So, and in the abstract, you also have this sentence, you know, we document an increasing share of women in monetary policy committees. This is of course true, and, you know, this is very positive, but I think, you know, you might want to balance this a little bit more by also talking about the levels that you find with your data. So, you know, the trend is positive, the trend is increasing, but the levels are amazing, are impressive. I mean, you've shown these numbers. Actually, the version of the paper that I have has a different number of central banks and a different sample period. So maybe, you know, not all of my numbers will now add up with what you've been showing. But over 15 years, among 103 central banks, 20% of MPCs never, ever included a single woman. You know, that is a remarkably low level, and I think that is worth emphasizing also in the paper a little bit more than just focusing on the trend. Next slide. On the data, again, this is, as I said, you know, this is fantastic. I would have liked to see a little bit more clarification, and maybe also there's some double checking to be done. Let me take one example. In the version of the paper that I have, you give the number for Canada you give numbers for 2016 for all those countries. One of them is Canada, and both Cesar and I worked at the Bank of Canada in 2016. So I picked this as an example. If I'm not mistaken, the board composition, the MPC composition was the following males: Governor Polos, Tim Lane, Sylvain Leduc joined in May 2016, and Larry Shempry was there the entire year. Females were Senior Deputy Governor Caroline Wilkins, Agathe Coté was there until February, and Lynn Patterson throughout the entire year. So that made me think about a couple of questions. You know, how does your data set handle empty seats? How do you handle transitions within a year? So the number that you have in the appendix table A for Canada is 33%. So then from there, I take it that you take the snapshot at the year end, because at the year end, you know, a third of the MPC was female. Now you could do a weighted average that would bring you to 37%. You could simply count all the names over the entire year. That would bring you to 43%. Or actually, what I now realize, you could also do obviously the beginning of the year, which would bring you to 50%. Now, Table A1 has a number of 33%. The figure that you show shows Canada to be between 40 and 60%. So this is why I think some double checking would need to be done here. And I think it would be important to clarify how exactly you measure these data. Next slide, please. So then the first set of results in the next section is let's explain female representation. And Paula has shown, this is a subset of the tables she has shown, and she already commented on the staff-gender ratio is the only one that comes out significantly. So then, of course, my first question would have been, what explains the staff-gender ratio? Can we do a little bit more analysis on that variable? You seem to have it, so maybe that helps us understand a little bit better what's going on. The second variable that doesn't work is the gender gap index. So this is the World Economic Forum's index, if I understand correctly. I checked their website. They have an overall index, which I presume is not what you want to use, because that also includes a gender gap with regard to health and survival and with regard to educational attainment. And the World Economic Forum, when commenting on this index, they argue that these are largely closed. So the relevant area where gender gaps still arise in your sample are probably economic participation and opportunity and political empowerment. So I would be curious to know which one you have tried, which one it is. We see here whether others work better. And maybe, you can think about other potential determinants. What about the share of females in government, the share of females in parliament? Is there a female prime minister at the time of nomination of these board members? So, I would really encourage you to dig a little bit deeper into these interesting results. Next slide, please. And then the next part of the paper goes into interest rate setting. So, the authors are doing something very courageous here. It's hard to estimate Taylor rules for an individual country because ideally you want real-time information, forward-looking information. This is impossible to do on an international panel data. So I think what the authors do is fine. But what I haven't understood is, so they introduce this variable of female participation, and then they interact this variable with inflation. And there's very little sort of underlying reasoning why this particular variable is interacted. What is the hypothesis? Why should MPCs with females on average be more hawkish? For instance, I could imagine this depends on the mandate of the central bank. I mean, you mentioned in your presentation, they might be more aggressive. Well, if you have a dual mandate, are they more aggressive on inflation or on unemployment? That's ex ante not clear to me why they would need to be seen as more hawkish on inflation. So some more hypothesis development in the paper, I think, would be welcome. And I think your data would be fantastic to help us understand why the existing literature is inconclusive. So there is papers on the FOMC, which tends to find that females are more dovish. Cross-country papers tend to find that females are more hawkish. Maybe that difference is because indeed the FOMC has a dual mandate and most of the others don't. And so I think your data set can help us shed light on this. Next paper, next slide. But then again, I mentioned, why are you interacting with inflation? Why not interacting with the output gap? Are MPCs with females differently responding to the output gap? Is there a different persistence term? You could interact with any of the variables in the Taylor rule. Why did you pick inflation? I think it would be interesting to look at the others. Maybe females look at other variables. Maybe they are more holistic, and that would lead you to larger residuals of your Taylor rules. Another hypothesis you could test. A couple of econometric issues. You use actual inflation as a proxy for inflation expectations, which again, given this data set, I think that's the best you can do. But, maybe females are better forecasters than males, and then the quality of the proxy. Okay, the quality of the proxy would be different. You also find that the variable itself, the share of women in the board, has a negative effect on policy rates. I think you want to control for a time effect because at the end of the sample, there's more females and policy rates are lower, which also raises this question, how do you take the effective lower bound into account? Can you do a robustness test by excluding that? Next slide, please. And let me skip that slide. So next slide, please. So As I said, this for me generated a lot of appetite for more research. I already mentioned a couple of more hypotheses on the Taylor rule you could test. Many questions would be interesting to do, but would require a lot more data, like, are the committees more collegial, more open discussions? Is there less groupthink, more diversity? You would require minutes of votes, and you cannot do this. Are they more trusted by citizens? You would require surveys. I don't think you can reasonably do this. But some questions I think you can tackle with your data or with little additional work, like, do they perform better in the sense of bringing inflation closer to target? Is the output gap smaller on average, or more positive, more negative? Are they more open to admitting mistakes? Are they more prone to reverse interest rates? And on the female members themselves, is there any difference in the reappointment probability, in the length of tenure? I think there's a lot of interesting stuff you could do. Next slide. And so that brings me to the conclusion. I think this is a really interesting data set. I want to applaud you for putting all the hard work in there. It would be a fantastic service to the profession to make this data set available. And I just hope you'll do a lot more with this. And I look forward to reading more of your papers on that data set. Thank you.
Thank you, Mike. Thank you, Michael. Yeah, thank you, Paula. So now you will go to the Q&As. So please raise your virtual hand, and when called upon, you will be moved from attendee to panelist. Again, please turn on your camera and unmute yourself. You have a limited time, so please be brief in your question. And so when you finish, basically unmute yourself, mute yourself again. So I think so far you have one hand, but maybe I can give an opportunity to Paula to quickly reply to Michael, and then move to the discussion.
Thank you very much. It was great to receive all these comments, and thanks a lot for your comments. Many things are things where we actually are working on. For example, the interaction with the output gap, and also a little bit more the theory behind the results. Others, yes, are things that we have tried. For example, for the World Economic Forum Index, we have tried all the components, and actually I also agree that the economic and political participation are the most important ones, and actually, but the result does not change if you limit to this component. The staff ratio is given, it's the data that we find in the directories, but of course we don't know what's behind this, so it may be that, again, this also depends on the culture of the country, or in general, or on the obstacles to female employment, etc. In the country. So again, on the index, with the data, yes, we took like a kind of strong assumption on the empty seats. So basically attributing them to male. So like those who are empty and that we don't find the positions, so we assume that they are taken by male. Of course, we can change and see how numbers change, relaxing this type of assumptions, but this was consistent somehow in the data set. I also agree that we can find with the share of female in government, in parliaments, etc. We have this data information. Actually, we tried already some things like that. We tried also with some historical variables which have been shown by the gender economics literature to be important, to be related to current gender gaps and the women's underrepresentation. This is actually an area of research where I have extensively worked for other papers, but it seems that it's very difficult to find something that is significantly related to this outcome. And at the end, yes, all our the regressions that I presented have country and time fixed effect. So somehow it's not a cross country. It's the effect that we are going to identify is within country, but of course, it would be interesting if we end up with the kind of new contribution with respect to the inconclusiveness of the previous results. I have to say that even in other, let's say in parallel, when I have worked, for example, on on politicians. To see if the presence of women among politicians, so the share of women among in political positions, for example, in government or in local municipalities, where you have also more detailed data, even though at country level, and try to understand how this relate, or if this is any relationship with the outcomes in terms of the policy that are decided, etc. It's always quite tough to find significant results. So it's quite inconclusive also with this respect. So probably the idea is really that diversity is beneficial per se, but it's very difficult to identify the effect of gender balance representation in decision-making positions on a precise outcome when we really want to measure. What is more promising is probably to identify this in terms of style of leadership, but this would require going into the minutes, or how the process works, how decisions are taken, which is which is probably where now some research will go, but so far it's a little bit more difficult. With this data set, we are not able to do this. But in general, I have to say, because the similar inconclusive results appear also when we look at women's underrepresentation in politics and the impact on outcomes. So it seems always that there is a different strategy. At least my understanding, my lesson from this type of research is that it's easier to find a different strategy in terms of long-term horizon, perspective, strategy of approach in making decisions rather than measuring the outcome.
Okay, thank you. You have two people here for questions. So the first person is Ilkunuz Ude. Please go ahead with your question. Sorry again if I mispronounced your name.
That's all right. So my name is Ilknur, and I'm an economist at the board. So thank you very much for the presentation, Paula. I find it super interesting, especially the data set as Michael put forward. And for some reason, I cannot turn on my camera, but please forgive me for that. So I rather have maybe two suggestions rather than the comments on the econometric specification and clarifying the things. So the first one is that I would use, rather than try to estimate the interest rates, I would use the deviation of the interest rates from the expectations, so that this can give you a cleaner interpretation of the women's share. This is on your main regressions, that they are more hawkish. So because clearly the interest rates can increase, not necessarily there are women, but other things, and given that the lagged interest rates are super significant, that may help you a bit. And the other one, which you already mentioned on your presentation, the biggest issue is here the endogeneity. And we all know it is super hard to solve this problem. I don't have a direct solution of it, but I can suggest a paper, which I can as well, happy to send it to you, published in QJE recently, that they are using some sort of an IV estimation and not necessarily an IV estimation, using some 2SLS. I believe that would be a direct fit here. And clearly it can as well help you to sell the story that there is somewhat a causal effect rather than a simple correlation. I'm happy to forward the paper to you going forward. Thank you very much again.
Thanks a lot. Yes, I'm looking forward to see this reference.
Okay, so there is Neil Erickson is the next person. Eric, please go ahead with your question. Neil, sorry. Neil Erickson. Okay. Can see you, but I don't hear you. So the mute is on the left your screen. We don't hear you. So Tim, can you help here?
Neil, you might try selecting another microphone using the caret on the mute button.
Maybe while you're waiting, so one thing that Paula that I thought would be interesting, linked to Michael comment about the fact that the interest rate we see women as hawkish. It could be linked to the expertise too. So the mandate does if the one aspect, but if a woman that care about more financial stability, if they see that there is low for long, they'll probably worry more. We may worry about low interest rates. So that might affect the behavior in general in terms of how we set policy. So if there's ways to control for that, that might be helpful.
Are you able to come off of mute?
Don't think we can hear or see.
And Neil, if you
okay, any other question when you're waiting for Neil? So is there any way to, regarding my point, can we find the expertise of this? For example, let's take the case that Michael put on for the Bank of Canada. So the two of the women that were there were really financial system oriented. So if only one was more monetary policy, it's true that our mandate is the more financial stability, but that might affect also some of the way we approach the interest rates. Some of them are more concerned about low interest rate than things. So I don't know if there's a possibility for you to collect that data or that information or not. You can look at the CV, you can look at...
Yes, exactly. That would require a search through the CV. But for this large sample of countries and numbers, it looks quite unfeasible. Of course, it would be.
For advanced economy is possible. For advanced economy.
Yes, I mean, you can do it, but yes, we wanted also to see, to have some, at least to see what we can find with the data set that we were able to put together. But of course, it can be enriched in several ways. And we also thought about this search through the CVs, at least for a sample of this of our data set. We have not done this so far. Yes.
Okay.
Thank you very much.
No problem. So sorry that we're having technical difficulties here.
Yeah, but I mean, thanks a lot for the comments.
Yeah, my friends just came in. So I think Michael and first let's basically conclude this session and thank all the presenters and discussants for the great job. And it's a very good way to start this conference. So we are very thankful. So now we will take a short break and we will be back in 10 minutes. And we have a panel discussion on central banks and inequality. And the session will be chaired by the Chief Economist of the IMF, Geeta Gopinath. So see you soon at 11 sharp, Eastern Time, Washington, DC time. Thank you very much, everyone.
I just want to make sure you can hear me. Can you hear me? Can everybody hear me? Okay, great. I just changed my microphone, so I want to make sure.
Okay, Geeta, if you want to go ahead and begin, that would be great.
Okay, thank you. Welcome everyone to this panel discussion on central banks and inequality. We're going to base this discussion around two big questions. One is on monetary policy and inequality, and then a second topic around the role of central banks in addressing diversity and inclusion, not just in their institutions, but also more widely in the economics profession. We have a terrific set of panelists. We have Roger Ferguson, who's a former vice chair of the Federal Reserve Board, Nellie Lang, who is the Undersecretary for Domestic Finance from the US Treasury, Isabel Schnabel, who's board member at the European Central Bank, and I believe we are still waiting for Governor Andrew Bailey from the Bank of England to connect. But I think we should start. So again, we start with the first topic, which is about monetary policy and inequality. This gets a lot of attention because we see lower interest rates associated with big increases in asset prices, which benefit the wealthy. And that certainly triggers alarm that monetary policy can generate an increase in inequality. Now, of course, to make a conclusion on this, you need to dig into all the other things that monetary policy does. And we've looked at this at the IMF. And then one of the channels through which monetary policy, of course, affects the economy is when you have lower rates, you're creating more employment. And we know that recessions are times when it is low-income workers who tend to lose their jobs. So stimulus and monetary policy has the benefit of bringing back low-income workers, giving them, making jobs available, and therefore helps the lower end of the income distribution. Similarly, by keeping interest rates low, borrowing costs are also lower, and the low income tend to be the ones who borrow. And so again, that helps in that dimension. So when you look at the multiple ways monetary policy affects the economy, one of the, you end up, at least in the analysis that we've done, with the view that it has mostly not much of a significant effect on inequality because there are benefits and then there are costs. So in that sense, there is an argument for monetary policy to stay focused on its job of macro stabilization within its mandate, be it the price mandate or more.
This is Bank of England. Are you able to hear me and see me?
Flexible mandate. I believe, yes, we are. Yes. Okay, so with that interruption, going back, so I guess that's where we are. It seems like for inequality, it's important to have a role for fiscal policy and structural reforms in addressing inequality, and monetary policy may not be the right toolbox for this. But again, this is not a closed question, and that's why we're having this panel discussion. So I'm going to now pose the question to the panel, which is basically how should central banks take into account economic and social inequality when considering monetary policy? What do you think is within the scope of central bank's current mandate? And what would you say to those who would want those mandates to be changed? And in terms of, would call on the panelists to give about 5 minutes each on their remarks. And in terms of the order of speakers, it will first be Isabel Schnabel, then Nellie Lang, then Roger Ferguson, and then Andrew Bailey. So Isabel, the screen is yours, and you have 5 minutes.
Thank you very much, Geeta, for the introduction, and thank you very much for having me on this great panel. It's a true pleasure to be here, and certainly the topic of our panel today is highly topical. We know that income and wealth inequality have increased in many countries over the past decades, and two main factors can explain this longer-term trend. So one is increasingly skill-biased technological change, and the other is the gradual erosion of workers' wage bargaining power. It is less clear, as you, Geeta, also mentioned, how monetary policy may affect the distribution of income and wealth. So it's certainly well documented that by protecting the purchasing power of people, monetary policy can contribute to reducing income inequality. And the reason is that inflation is actually one of the most regressive taxes. But monetary policy may also reduce income inequality in the way it transmits through the economy. Next slide, please. So as illustrated on the left-hand side of my first slide, research shows that households with lower incomes tend to have on average the highest risk of losing employment during a recession, as Geeta also mentioned in her introduction. And this means that the stimulative effects of monetary policy easing on aggregate demand tend to protect the most vulnerable members of society. And this was also the case during the pandemic. The right-hand chart reminds us that the global financial crisis of 2008-9 primarily hurt younger and less skilled workers with significant risks of permanent scarring. And there's broad consensus that the central bank's pandemic measures, including the ECB's pandemic emergency purchase program, have prevented a collapse of the financial system this time, which at the same time then reduced the pandemic's impact on inequality. New research, however, suggests that the effects of monetary policy are more nuanced when also considering realized capital gains, which are typically not included in official measures of personal income. In Sweden, for example, the effects of monetary policy have been found to be U-shaped because capital gains often constitute a larger share of total income for those at the top of the income distribution. And evidence from Denmark even suggests that households with the highest incomes tend to benefit the most from lower interest rates. And these findings suggest that the distribution of net wealth plays an important role in the overall picture. And this asset price channel is likely to have become more important over time. Next slide, please. So faced with the lower bound, many central banks have increasingly resorted to asset purchases. And as shown on this slide, the ECB has bought bonds worth more than 4.5 trillion euros since late 2014, or nearly 40% of pre-pandemic GDP. And such purchases were certainly necessary for central banks to fulfill their statutory mandates. But since they directly affect the prices of longer dated assets, their impact on relative incomes and wealth may be more pronounced than that of changes in short-term policy rates. And I would like to distinguish two types of effects, direct and indirect. So the direct effect relates to the capital gains that accrue to the holders of securities because of our purchases. And these benefits tend to be highly concentrated. So the right-hand chart shows that in the euro area, less than 1% of households in the bottom net wealth quintile hold bonds, mutual funds, and stocks, while a significant share in the top decile hold such assets. Hence, central banks purchasing longer dated assets disproportionately benefit wealthier households. The indirect effects relate to the portfolio rebalancing triggered by the compression of risk-free interest rates. Faced with low and falling yields, many institutional investors have purchased residential and commercial real estate even well before the pandemic. Next slide, please. So the left chart on this slide shows that, for example, in the Netherlands, real estate investment trusts owned assets worth almost 10% of the country's GDP in 2018. And research by the IMF has found that such investors are likely to have played a role in pushing up global real estate prices in recent years. As a result, house prices are increasingly behaving like globally traded financial assets, and therefore they risk diverging from national income developments. And this is shown on the right-hand chart. There you can see that in the euro area, residential property prices have risen by 35% since 2015, and this is much faster than disposable income. So my final slide, please. And new ECB research corroborates these findings. It suggests that unconventional monetary policy measures, such as asset purchases, are likely to have a significantly larger impact on house prices than changes in short-term policy rates. And in countries where home ownership rates have traditionally been high, such as Spain and Italy, house price increases generally benefit a large share of the population. But in other countries like Germany and Austria, where less than half of the population own their main residence, the recent sharp increase in house prices could heighten inequality. And this was actually a concern raised frequently at our ECB Listens events. So the question is, what does this now imply for our monetary policy? So first, central bank must pay more attention to house prices. As part of our monetary policy strategy review, we recommended a roadmap for the inclusion of owner-occupied housing in our inflation index. The right-hand chart shows that the inclusion of owner-occupied housing costs would have led to persistently higher inflation since around 2014. In the second quarter of this year, owner-occupied housing would have contributed between 0.4 and 0.5 percentage points to a new augmented inflation index. The second implication is that as part of our proportionality assessment, we need to choose and calibrate our policy instruments in a way that secures the achievement of our mandate while minimizing negative side effects. And at the current juncture, it is likely that the large stock of acquired assets, in conjunction with our strong forward guidance on policy rates, will prevent an unwarranted tightening of long-term rates once net asset purchases have been terminated. From today's perspective, this can be expected to happen in March 2022 in the case of net asset purchases under the PEPP, while the pace and duration of our net asset purchases under our regular asset purchase program will, of course, depend on a thorough reassessment of the medium-term inflation outlook. By gradually shifting the policy mix away from net asset purchases, we can prevent the distributional footprint of our measures from increasing and at the same time mitigate financial stability risks. And by ending net asset purchases before raising policy rates, we signal that we are not willingly accepting losses on our balance sheet that would ultimately lead to losses to the average taxpayer. Our forward guidance ensures that we will not respond hastily to rising inflation rates. We recognize that current high inflation has a particularly concerning effect on the incomes of households at the lower end of the income distribution. However, monetary policy cannot mitigate short-term spikes in inflation, and our efforts are therefore focused on assessing how persistent current price pressures will ultimately be. And at our last policy meeting, we therefore concluded that there are good reasons to believe that euro area inflation will decline visibly over the course of next year and will gradually fall back below our target of 2% in the medium term, meaning that the conditions for raising interest rates, as set out in our revised forward guidance, are very unlikely to be met next year. Prematurely raising policy rates in response to a temporary inflation surge would hurt households with low incomes the most, as it would harm their employment opportunities. Nonetheless, significant uncertainty remains as to how persistent some of the current price pressures will prove to be, and therefore, of course, we continue to carefully monitor inflationary developments in the euro area. Thank you.
Thanks a lot, Isabel. And now we hear from Lenny Liang.
Hi. Thank you, Gita, for organizing it. Thank you to the conference organizers for inviting me today. So on this topic, I want to start with the good news that macro policymakers are now recognizing the potential implications that wealth, income, and social inequality can have on economic growth and welfare. Also, I'm going to offer a perspective from Treasury, maybe a fiscal and political perspectives, though I'm a novice at this, I've spent many more years at the central bank as more of a technocrat than than from the Treasury. Supporting a more equitable and socially inclusive recovery from the pandemic has been a core priority of this administration and the Treasury Department. We know the economic impact of the pandemic fell most severely on lower income communities and households, which were disproportionately often in the frontline service jobs. But it's also a longer term priority. President Biden issued an executive order on the first day to advance social equity, to try to close gaps in wages, housing, and lending opportunities, and in access to higher education. It cited estimates that closing such gaps could add $5 trillion to GDP in 5 years. So that is not a trivial amount, it is substantial. On the view of whether monetary policy should consider social inequalities, my views are broadly consistent with generally the economics profession, something that Gita represented earlier. Monetary policy is a blunt tool aimed first and foremost at price stability. In the US, maximum employment is added, so there's already a dual mandate. In general, that hasn't caused conflicts, but already the Fed is tasked with achieving two objectives with basically one tool. That's not to say that monetary policymakers can ignore the economic impacts of monetary policy on inequality. First, we shouldn't lose sight of the fact that price stability, its core mandate, is actually part of the social contract. Inflation is very regressive. I think that's first and foremost. Second, central banks certainly have the responsibility to consider the effects of their policies on inequality. Central banks have a very valuable franchise as the producers of high quality data, information, analysis, and I think they have a responsibility to improve the public discourse in this area. There is the additional question of whether monetary policy leads to greater inequality. My reading of the research is that this link is indirect, a bit tenuous. Of course, asset prices raise, low rates increase asset prices, but for all the other reasons, the channels that Gita represented, generally the net effect on inequality is hard to determine. But there is a potential link. Preemptive policies to reduce inflation work by slowing aggregate demand. That's how monetary policy works. And it's documented that some of these communities and individuals are going to be more vulnerable to slowdowns and to recessions. Isabel's charts were exactly that. And they are the first to lose jobs when growth slows. They are the last to be rehired, and they may have greater difficulty in accessing credit in downturns. And if these patterns are systematic, it seems they could, over long periods of time, reduce the accumulation of wealth and human capital of the most vulnerable. And so these effects could be there. They may be hard to find in the aggregate data, either because they're indirect, they take a long time, they're difficult to identify. But I do think it's very important for central banks to be developing a better understanding of these issues and to be sharing that with the public and improving the public discourse. That said, it's still a separate issue if monetary policy is the most appropriate and effective tool. And I think here there are very strong parallels to financial stability issues. It is clear, at least to me, that monetary policy directly affects financial stability. It affects the probability of a crisis through financial conditions and credit growth. And loose conditions coupled with rapid credit growth, we know are a pretty good indicator of a financial crisis. And they can increase risk to growth, downside risk to growth. Yet even in that situation, unless price stability is jeopardized, policymakers' first option is probably not monetary policy. Rather, a more effective approach would be financial macroprudential policies targeted directly to reducing the probability of a crisis and its conditional impact. I think the parallels to social inequality here are strong. More promising, I think, then are, instead of monetary policy, are some macroprudential policies, because they, in terms of thinking about social inequality, policies like LTVs, et cetera. I hope to say, I'll stop here and hope to say a little bit more later about some of the distributional effects of those kinds of policies. So thank you.
Thanks, Nellie. And now we hear from Roger Ferguson. Roger, I think you're muted.
Thank you. I thought I'd unmuted myself after 24 months of doing this. One might have imagined I'd be naturally looking there. Anyway, thank you very much. A pleasure to be on this panel, and a pleasure to see our friends and colleagues of long-standing, very, very important discussion. So let me build on what has been said by emphasizing a few things, and then maybe talking about recent experiences here in the United States. So let me emphasize the points that Isabel and Nellie have talked about, which is the research has shown, and I agree with it completely, a number of points. One is we need to start with the fact that the fundamental mandate for all central banks and the use of monetary policy is around price stability. And Isabel started at a very important point, which is that inflation is perhaps one of the most regressive taxes in almost all of our societies. I recalled when I was joining the Fed now, 1997, testifying to this point, and particularly speaking to other African Americans as to why it was very important to have a central bank that was vigilant around inflation. And so we need to continue to communicate that message. Having said that, we go forward to the next points, and I think Isabel put her finger on it, as did Nellie, which is when we get into recession, the individuals who are most likely harmed tend to be those at the lower wage scales. And similarly, when you think about the transmission mechanisms, as have been discussed, asset prices tend to be disproportionately, by definition, beneficial to those who are wealthy because they obviously control more assets. Here in the U.S., it also turns out that wealthier individuals and our white citizens have a much larger portion of home ownership than do African Americans and Hispanics. And so we know there are potential social impacts of the kinds of distribution mechanisms or transmission mechanisms that we've talked about. So that's some of the basic facts, simply reinforcing what you've heard already. Having said that, we've also had some recent experience in the U.S. over the last 10 years or so that shows that a central bank with a dual mandate, if it is confronting a situation where inflation is relatively flat, and the Phillips curve, as you know, is relatively flat, allows that central bank to, quote, run the economy hot in order to increase labor force participation, bring in marginal workers who often tend to be, at least in the United States, minority and women workers who tend to have lower salary. And so while we do not think of inequality or social dynamics as being the primary focus of monetary policy, I do not think that it should be. We've had a recent experience here in the U.S. until this crisis that has shown in a situation in which you have a dual mandate and inflation is well contained, a central bank under a bold leader, such as we've had with Janet Yellen and Jay Powell, can run an experiment that results in perhaps increasing the possibilities of leveling out some of these inequalities. And so we should leave that as at least a real world experiment that does not suggest that we should change the way we think about monetary policy, but nor should we say that monetary policy has no effect on current and future prospects for income and wealth inequality. The second point I'd make is we have now another experiment which shows the other side of this, and again works through the question of picking up the economy in a way that brings jobs back equitably across society. So here in the US, we're struggling with a relatively low labor force participation rate, but that is very uneven. So the labor force participation rate for minority males has dropped quite significantly. That for women has also been very, very low. So the most recent measure for labor force participation rate for women remains stuck at around 57%, which is the lowest level in over 30 years versus about 70% for men. And the labor force participation rate for African American men is 4 points lower than white men, at about 66% versus 70%. And why is that important? For reasons that all of you understand, which is individuals being out of the labor force are likely to lose the skills that are necessary to compete effectively for jobs going forward. This is particularly challenging when it comes to the income inequality question, because it is still recognized here in the US at least, that women earn somewhere around 79 to 80 cents for every dollar that the male workers earn. And for African American males, it's not much better versus white males. So that clearly suggests that we have a challenge here of both getting the economy going again, but also determining, the central bank will have to determine whether I can once again run the experiment of attempting to run the economy a little hotter than one might have imagined in a period when inflation might be picking up. So I think there is a bit of a challenge and a dilemma for the central banks, at least in the US, going forward. Let me broaden my comments by saying two other things very quickly. We're talking about monetary policy, but obviously central banks play other roles, at least here in the US and other places. Nellie put her finger on some of those. In the United States, the central bank is also responsible for some elements of bank supervision and regulation, which I think should be done with an eye towards thinking about equitable distribution of financial capabilities. And I know that other societies, having spent some time talking to the individuals in the Bank of England, the Bank of Canada, et cetera, the question of financial inclusion becomes a very important topic more broadly, including things such as access to the payment systems, particularly newer payment technologies. And finally, I close with the last point I'd make in this space, which is all central banks, I think, have an interest in increasing the level of financial literacy in their own economies. And we do know that, at least in the US, financial literacy is, again, much lower in minorities than it is in our white population. And we know there's a high correlation between the level of financial literacy and the ability to manage debt, to save for retirement, to understand how to invest wisely. And so we should broaden our aperture just a little bit while we're talking primarily about monetary policy, to think about the other roles that central banks play in society and how those could potentially have a beneficial effect in ameliorating to some degree the wealth and income inequality that has become a feature of many economies over the last 2 decades. Thank you very much.
Thank you, Roger. And now we have Andrew Bailey. Andrew.
Thank you, Geeta, and thank you for inviting me to participate in this session, which is both fascinating in subject and actually with such distinguished and interesting colleagues. I was going to start by just making a point about the evolution of inequality in the UK, which is, I think, quite interesting and quite relevant, certainly to our situation. And it's this, aggregate inequality, certainly measured, I think, both in wealth and income terms, increased during the 1980s, but actually has not changed hugely, really, since the early 1990s. However, there is quite a lot going on when you look below that. One of the things that I always find most interesting about it and most probably relevant for this debate is that intergenerational inequality has certainly increased over time. There's a study done in the UK quite often, which takes cuts the population up by deciles in terms of the decade in which people were born. And if I remember rightly, I think it says that the generation born in the 1980s is the first one since the Second World War to be less well off than its predecessor, both in terms of income, asset ownership, house ownership. And that's that's therefore quite a big change from what I call the sort of the post-war model. But that doesn't show up in aggregate inequality, interestingly. But it does have quite a lot to do, certainly, with asset ownership. The second thing I think, as colleagues have said, is that because this question does depend on what monetary policy objective the central bank has. In the case of the Bank of England, we don't have a dual mandate in the same way. We have a single inflation price stability mandate, which is interpreted as an inflation target. The precise language is, and this is important because it's hierarchical, is that it's price stability and subject to that, in essence, supporting other objectives of the government. Incidentally, that's how climate change has come in. It's subject to that. One of those other objectives of the government is defined as climate change, as of relevance to the Bank of England. Now, actually, there isn't an inequality policy in there, or an inequality policy in there, I should say, probably, at the moment. So that doesn't feature in there. What I would say, turning to monetary policy in sort of practice, is that I agree with colleagues that I think certainly the pressure, or certainly the commentary, and including from politicians, some politicians, on monetary policy inequality has increased substantially in the last decade, which I think is associated particularly with the use of quantitative easing and asset purchases. It's not a very well focused commentary, I would say, which I'll come on to in a moment, but it certainly has increased. Now, I would, as Isabel was saying, I would separate out here financial assets and housing assets. I think they are different cases in terms of our experience of how, in a sense, it plays out. It's obviously the case that in both cases they tend to benefit. The increase in the value of those benefits those who are more wealthy. However, it does seem to me that the point that has to be made in response is that asset values are part of the monetary transmission mechanism. In the case of quantitative easing, they're arguably more so more prominently part of the monetary transmission mechanism. It would be easy to stop there and say, well, therefore we can observe, in a sense, what's happened to asset values, who owns assets, and then conclude. I think the really challenging thing, which isn't done, is to say, to judge that, we need to know what the counterfactual would be. What would be the outcome in the absence of that policy choice? And one of the points we have certainly made to Parliament and to those politicians who've said, well, you're increasing inequality, is to say, well, we do really believe that in the absence of the policies used, unemployment would have been higher. And that's a point that I think possibly in the sort of, in some of the debates, because of possibly the subtlety in those debates about the use of a counterfactual, this point about what is the alternative level of unemployment, and therefore what's the implication of that for inequality, doesn't get a lot of attention, and it's sometimes I think quite hard to get that point properly across. Now the final point I would make is really, I think, a couple of points Nelly made actually. Interestingly, I think the question, particularly in relation to housing assets, is in some ways posed more sharply in the arena of financial stability policy than it is monetary policy for us. We have got in our financial stability work, in our financial policy committee, we adopted so-called housing tools back in 2014. So we've had them in place for 7 years, currently reviewing them. We review them quite often, actually, about every 2 years. And the reason we do is because I think for central banks, the reason that this is important and does, in a sense, directly get to questions that people perceive to be about equality is that for a central bank, I think adopting a housing tool, and we have two. One is to limit the number of mortgages above a certain loan-to-income ratio that each lender gives It doesn't say they can't, but it's taken a sort of a threshold value and say there's a certain number of mortgages you will want to grant above that loan to income ratio, but historically, if you get concentrated in that area, it will have bad outcomes for financial stability, and it will also have bad macroeconomic outcomes. The second one is an affordability tool, which essentially is for each borrower is a stressed interest rate test. But the reason I make this point is that I think those tools uniquely for central bank, for us as a central bank anyway, really impinge directly individually on members of the public. So I think they directly associate the central bank in ways that monetary policy seems rather more general. People comment on interest rates. People observe, the impact in a general sense, but it doesn't have quite the same impact as can I buy the house I want to buy or can't I? As a result of a policy that the central bank's adopted. So it's interesting to my mind, just to finish, that I think in our case, certainly, I think while there is commentary around monetary policy and inequality, and it's quite a lively debate in some circles, but not in a generalized sense, it can at times, particularly for first-time house buyers in this country, and we have, Isabel was making the point about home ownership, we have quite a strong home ownership, where it's quite high, it can become quite pointed. I'll stop there, Peter, thanks.
Thank you, Andrew. We have a second topic to get to, but I'm going to ask a couple of questions, maybe a little more pointedly. Isabel, if I may come to you. I think what the discussion has shown is that to some extent there are still the traditional arguments that remain on what monetary policy can and cannot do. And it is restricted in the kind of instruments it has. It has an effect on asset prices, it has an effect on housing prices, and through that, it has an effect on inequality. But on the other hand, it is the tool that's needed to prevent severe recessions, create more jobs, and they end up benefiting at the lower end. But it is what's gotten a lot of attention. I think over the last decade, the link between monetary policy and inequality, and in the negative sense, has gotten a lot of heated attention. So I know that the ECB, of course, did a recent review of their monetary policy framework. It would be great if you could share your views on how these concerns on the distributional consequences of monetary policy entered that review. Just very briefly. Thank you. I guess where you arrived at after that.
Thank you very much, Gita. So let me stress first that, of course, monetary policy is not the primary tool to deal with inequality. I mean, I think that's obvious for everyone. And one of the reasons for that is that a large part of inequality is, of course, driven by these long-term structural trends, and that is something that monetary policy cannot deal with. But one aspect that was very present in our review, and which is actually related not only to inequality, but also to financial stability and to climate change, is the question. So actually, there are two questions. So the first is also mentioned by Andrew. How do we deal with our, what we call the secondary mandate, which is similar to what Andrew explained, that we have this clear lexicographic ordering with price stability first, and then as a secondary objective, we are supposed to support the general EU policies, which includes things like environmental protection. It also includes things like social cohesion. So inequality seems to be a part of that. That's one thing. The second thing is, how do we deal with the side effects of our monetary policy measures? And again, that can be financial stability, that can be distributional effects, and so on. So on the first point, I think what is clear is that the legal, so the treaty basically obliges us that if we have the choice between different types of measures, then, and they have basically the same effect on our monetary policy stance, let's say, then we are supposed to use the instrument that is better in line with the EU general policies. And I mean, I think it's important to stress that monetary policy is not like a one-dimensional thing that you can do a bit more or you do a bit less, but we have many different tools, and different tools have different implications for financial stability, for on inequality, and so on. And I mean, this leads me directly to the second point. This is where also our proportionality analysis comes in, which is the point that, and this is really deeply embedded in our strategy, that we say whatever monetary policy decision we take, we always have to make sure that the benefits are greater than the costs. And the costs, I mean, they do include things like distributional effects, financial stability, and so on. And therefore, I would say we cannot simply say we have nothing to do with that. And actually, in our ECB Listens events, I mean, there were basically two topics coming up most, and this was climate change and this was house prices. And simply to say we ignore all of that because this is somebody else's job, I think is not enough. I mean, that is not enough. We really risk also losing the trust of the people if we simply say, oh, this is none of our business, even though we know that our policies have an impact on that. So let me stop here.
Thanks, Isabel. Andrew, you want to jump in?
Just say briefly, because I think it's an interesting point Isabel made about the evolution, certainly as I see it, of this sort of the hierarchical objectives. Because I think when we set out nearly 25 years ago now on this route, that was interpreted very much as a way to handle the dual mandate in a sort of an updated way. So it was really about price stability and subject to that growth. In other words, and the way the Bank of England explained it was, if we get price stability right, we'll support growth. End of story, really. Now, it's moved on a long way in the last 25 years, and it's interesting to reflect on that because, as Isabel said, I think now, I think still that narrative is still there, but it's much more about specific policies. If you can sort price stability out, can you then do some other, some things that will be consistent with that, of which climate change would be one, but aspects of inequality could be another. So it has moved on quite a long way, I think, in the last 25 years. Thanks.
Raja, do you want to come in?
Could I comment on the other part of what Isabel said, which is very much on my mind, which is central banks are, in all of our countries and jurisdictions, highly powerful, rather mysterious, unelected officials, and in which trust is critical. And part of that trust, to Isabel's really good point, is a combination of communication with something that's going to sound funny in central bank community, but empathy. So a recognition that our policies actually do have distributional impacts and that we take that into consideration is important. Here in the US, obviously, because of the very explicit dual mandate, how one thinks about those trade-offs between inflation and unemployment and the implications are very, very important. And so I do think, and to Andrew's point, I don't know how hard it is to make the counterfactual. I think at least from, Nelly may disagree with me here, I think from the US, the understanding that, we have to bring economies back to growth in order to create jobs is pretty clear. But I really want to reinforce Isabel's really good point that so much of this conversation has got to be driven by a discussion around or recognition that trust is really important here. And while we cannot use monetary policy to solve social problems, I don't think societies want to see some of their most important policymakers appear to be completely indifferent to these issues. And so I think that's an important component that Isabel has added to the mix.
Thanks, Roger. I want to now go to Nelly. You left us hanging with the remark that financial regulations might have a role to play in addressing issues of inequality and in macroprudential regulations. So tell us about it. That would be great.
Okay, thanks. Thanks for that. So I think unlike monetary policy, as I said, I think actually financial regulatory and financial stability policies can actually incorporate and reduce social and economic inequality. There's a number of examples, maybe is the best way to think about this. especially if they can work with fiscal. And even a central bank with financial regulations can interact with fiscal. So one example that I point to is directing resources to increase investment in underserved communities, businesses, individuals that can promote financial inclusion and social equity. So in the US, we have financial institutions such as community CDFIs, community development financial institutions, and minority development institutions that are lending programs to provide credit and even technical assistance to underserved communities. So these get credit. They are incentivized by current financial regulations, and they're coupled with fiscal resources. And these programs have been around for decades, and they have proven ways of supporting local communities. So that's one example where financial regulations can help. On macro-prudential policy, which is a newer development, and central banks are given the task of, because of their broad perspective on the economy and financial system, are given this task. There's like this new growing area of research that I find very interesting. So I think we talked about the role of loan-to-value ratios or loan-to-income ratios or debt service to income ratio requirements that are used, as we all know, as a macro-prudential tool. Bank of England has used some form of this. Of course, this is used has been used a lot because many crises have been associated with house price booms, and so this is an area that has been used. But not surprisingly, if you impose loan-to-income ratios or debt service to income ratios, when they're implemented, it will have an effect on there will be a distributional effect. And there's some research, growing research in the last couple of years that, of course, you're going to shift lending from lower income households to higher income households when you impose these. There's some additional research that shows it can also reduce differences in price gains across areas. So it's reducing the geographic dispersion in house prices. Now, the point is, it is reducing the feedback loop between high credit and house prices, which is financial stability enhancing. But once you look below and you see the shifts across income and across regions, that's important information. That's new information that can be brought to bear into discussions of macroprudential policies. There's some additional work, which looks at the time dimension of macroprudential policies. For example, implementing an LTI, a loan-to-income ratio. It should reduce the buildup of systemic risk and reduce the cost of a crisis if it were occurring. So this is like that preemptive element. In that sense, it suggests it could increase inequality in the build-up phase because lower income households have fewer opportunities for home ownership. That's a buildup of inequality. But it could reduce inequality in the bust phase when there's a negative adverse shock, because those vulnerable households would be shielded from the negative wealth effect of price drops. So some interesting research has tried to simulate this with these sort of, VAR models or Bayesian VAR models to sort of the net effect. What's the net effect on inequality if you keep some out from home ownership but shield them from the negative effects? And one paper from the ECB staff of researchers, looked at it across 4 countries. And of course, it's going to depend, but it's going to depend on things like the sensitivity of unemployment to this credit supply shock or the sensitivity of house prices. But it's a great framework. It's like it pins down the things you care about and you can evaluate, and every country can take this on as they're thinking about implementing macroprudential policy. So I think this is very, to me, exciting way to integrate financial policies and social inclusion policies and equality policies, just setting the stage. And so I encourage this conference and all the researchers out there to be doing more of this. These are very, very time relevant questions to policymakers currently.
Thank you, Nellie. I think we could go on this just one topic, but we have a second one, which is on the diversity and inclusion problem in the economics profession. So central banks are some of the largest employers of economics professionals. So in that sense, they have a very big footprint in the profession, and therefore they can influence diversity and inclusion in the field of economics. So the question that I would pose to you is, what role do you think central banks have in addressing diversity, equity, and inclusion at your institutions and within the economics and finance professions more generally? Let me just share a couple of points from the International Monetary Fund, which is another institution that hires a large number of economists. As of 2019, when we had the annual report, the share of women economists among all IMF economists is around 30%. Now that has increased over the years from 26% in 2011, so the direction is right. But of course, we're well short of the goals. Gender diversity is a bigger problem once we look at senior management roles among economists. And again, it falls short of the 50% target. We're currently at about 28% or in terms of women being economists in senior and managerial roles. And of course, there is the question not just of gender, but more generally of diversity from different regions and different races that we need to address. Now, there are actions that are being taken at the IMF in terms of internal staff training, targeted outreach and recruitment, institutionalized diversity office tracking the data on diversity in scores and so on. So there's a lot of work being done, but there is a lot more that needs to be done. So let me first start by going around, and I guess I'm doing this now in reverse order, with Andrew. Andrew, why don't you come in and share your views on this question? Again, 5 minutes.
Thanks, Peter. It's a very important, I think, question. Certainly it's a very important question for us at the Bank of England. And although we don't really quite classify our staff as either economists or not economists in quite the same way, so I can't quote you a figure of economists. I mean, our general figures are not far off the numbers that you're quoting for the IMF. So I think we've got the same challenge. I mean, the first thing that I think is important to stress is that it's important, I think, as central banks in our broader contribution to the economics profession, as you say, to say that we will not accept that it's a sort of forever law of economics that is sort of mainly done by men. There is no good reason for that. It may have been true in the past. There may be all sorts of theories on why it was true in the past, but it cannot be a good argument going forwards. But to do that, of course, we have to play our part in the profession more broadly. I think, helping universities and schools to get to the bottom of what it is that causes people to prefer, one subject over another. But the reason I say that is that from the point of view of the Bank of England, I always, have two strong principles that I operate by the Bank of England, and I would say for any public policy institution, actually, and of course it actually goes beyond public policy institutions. First, we serve the nation that we are the central bank of, and it's important that we bear, a sufficient resemblance to the nation that we serve. Otherwise, people will quite rightly say to us, well, you don't really represent the nation you serve, and how can you represent the nation you serve in that way if you don't really bear a sufficient likeness to the nation that you serve? It doesn't have to be exact. It's not sort of down to the sort of the sort of second decimal, but it has to be sufficient for people to look at the Bank of England. All people in this country to look at the Bank of England and say, I think this is an institution that will understand, my situation, and will understand the economy through different lenses. That's important. The second thing is that I think it's a better institution. It's a better institution for people to work in when it's diverse. I always say, I don't want to work in institutions full of people like me. And I think that is an important point. And we've been working hard at this in the Bank of England, but honestly, and we published last year a review that was done of particularly ethnic diversity in the Bank of England, which I started when I became governor because I knew that we had to make more progress. Relatively, we've made more progress on gender. Haven't got to where we need to get to, by the way, but relatively, we've made more progress. And it concerned me that we had far more to do on the gender front, and we were not making the progress. Now, I think, first of all, we have to then have that constantly in mind. It's hard. We don't have enough role models, frankly, and I think it is important to have role models because I think, people who, young people who join institutions, I think reasonably ask themselves the question, do people like me get on in this place? Can I observe that people like me get on in this place? Now, again, I think we've made more progress on gender than on diversity in the Bank of England. So we've not got to where we need to get to on gender, don't get me wrong, but we've made more progress. And so we have got to make a lot more progress. But it raises really hard questions. It raises questions about when you've got a discipline which is not evenly, not representative, you often, when you're recruiting, get left with very uncomfortable choices. I think, we all, stand by the principle that we always recruit the best candidate. There is, of course, a very interesting question about how you define the term best candidate. I accept that, and there's some quite lively challenge in the Bank of England on that, and quite rightly. But what I do also say to people is what we've got to aim for is a world and an environment in which the best candidates in future are more diverse. That will take time and a load of effort and a load of work. We've got to commit to it. So I will stop there, Geeta, if you don't mind.
Thanks, Andrew. Roger?
Well, thanks again. And let me pick up with some points that Andrew had made and from also the earlier part. So the question is a number of questions. First, two questions, why and how? So why should central banks care about this topic of diversity and inclusion? I think Andrew's put his finger on it, and it builds on something that Isabel said as well, which is we are very powerful, unelected organizations built ultimately around trust and confidence, and the ability, as Andrew said, to roughly represent our societies and be seen to be sensitive to all the components of society is really very important. The Federal Reserve System itself was structured geographically to make sure in this massive country that all regions were represented. And indeed, the reserve banks have three classes of directors, as Nellie knows, in part to create a kind of diversity of profession. And so, at least for this institution, I shouldn't say this, I don't speak for the Fed anymore, but for that institution, concepts of diversity were already built into the initial charter, so that it would be widely perceived to be representative in the ways that people in 1918 thought were important, and we should still carry that forward. So how should we do that? 3 or 4 points come to mind. One has been touched upon already by Nellie and others, which is doing phenomenal research in this space. And fortunately here in the US, with our various reserve banks, we see a great deal of research around diversity and inclusion, et cetera, and the benefits that we believe to be there, and validating the kinds of research that Nellie just talked about. And I think that's really quite important. The second, Geeta, you put your finger on it. Central banks are great hirers of economic talent, and being very explicit about looking for diversity because we think it makes for better central bank decision making is very important. And here, if Mary Daly, who's the president of the San Francisco Fed, were on, she would tell her story. I think now you know her story quite well. She did not go to one of our leading economics institutions. When she was hired as a junior researcher at the San Francisco Fed, it was a highly risky decision. When she questioned the person who hired her about why it was that he was willing, or why were there so few people from her lesser known economics department, he said very simply, because if I go and hire someone from Harvard, Yale, MIT, et cetera, and they fail, it's not my fault. Obviously we went to the best places, and we happen to have someone who didn't work. Here in the U.S., if you go to a second tier school, hire them for the central bank, and it doesn't work, guess whose fault it is? Why did you even look? And so, Mary, I think, would be very passionate about the point that you made, Andrew, of, well, what risk do we take in the hiring process? And probably encourage us to take even more risks in the hiring process than we do. I would say, to give my friends at the Fed some credit, they are now involved in partnering across several of the central banks with a group called the SADIE Initiative, not known to most of you, but it is a group of young African-American women named after the first African-American woman to get a PhD at a major U.S. institution in economics, apparently. And they're looking to mentor and bring these young women, African-American women, if possible, into the system, the Federal Reserve System. So actions can be taken in hiring. Third thing, in the how, and again, we've done it here in the U.S. maybe, showing the model, is the bully pulpit of central banking. And two of our former Fed chairs have gone on to be the presidents of the American Economics Association and have made diversity in the profession a linchpin of their platforms, both Ben Bernanke and Janet Yellen. So I think there is room for us not just to research, not just to work on the hiring, but also to drive forward the conversation with what we in the U.S. Republic bully pulpit. So let me stop there and turn it over to you, Gita. Thank you.
Thanks, Roger. Nelly?
Okay. So maybe I'll just broaden again a little bit to government-wide and thinking about roles in terms of promoting diversity in the economics profession. So let me just start with a couple of data points. Some previous colleagues of mine at Brookings had done a survey using government-wide data on the employment of PhD economists in the US government and compared it to academia. So just a couple of points. First, the government employs, in 2018, 2,111 PhD economists, which is a big number. I don't think it includes the IMF. So the Fed system was about a third of it, a little bit more than a third, which suggested broad government had a lot of economists. And the counterpart was about 5,000 PhD economists at academic institutions. Government is a big employer. Its policies have a big effect. If you compare government to academia, government-wide, about 30% were women. That sounds similar. In academia, it's about 23% based on a C-SWIP survey. And in terms of minorities, government is about 24%. That includes Asian, Hispanic, Black, and others. And academia are about 21%. So government slightly better in terms of greater proportions than academia, but clearly both are underrepresented by Blacks, Hispanics, and women. So I think it's undeniable that economics as a profession has room to improve. I really like Andrew's statement, an expression of our goal is to have the best candidate, the candidate pool, the best candidates are more diverse. That's our goal, is to make the pool of the best candidates more diverse. So I guess in terms of, so I think those are all useful facts. You can collect, all the data are there in a spreadsheet too to look at. What to do about it is, just a substantial problem. Looking at the pipeline, it looks like it's better. Like if you look at undergrads, if you look at research assistants, those who might pursue professional degrees in economics, it's a little better, but it's not, and it's improving, but it's not quite there yet. So while women represent 55% of undergraduate degrees, they represent only about a third of those with economics undergraduate degrees. So we have, I think, some work to do. And the reason this is important, one, why is this diversity important? One is just there's a pool of wasted talent and resources, of underutilized resources. Two, I think lack of diversity means lack of diverse research. I think there's this common view that we know a lot more about men's health outcomes than women's health outcomes based on the previous research. And I think women tend to certain kinds of research and men tend to others, and we could improve the state of knowledge by more diversity. And I think there's a bit more of, there's just a general fairness objective, which is a loaded word, but I kind of just view it as improving the overall work environment. And so those are important things. I think all the institutions are making great efforts to try to improve diversity. There's been a little bit of evidence that mentorship can be helpful. There's some evidence out of this mentorship program with the CSWEP where it's very time intensive, but just working with younger faculty improves publication rates, advancement in the future. Those kinds of things are very promising. But not that I have a straight answer to this, but it is recognizing the issue is at least half the problem, at least half the solution, I should say. Thanks.
Thank you, Nelly. Isabel.
Thank you very much, Geeta. So I've been thinking about this topic a lot already in my previous life in academia. I mean, if I look at my own education, so at my German university, I did not have a single female professor in my entire education. When I became a professor at the University of Bonn, I was the first female full professor at University of Bonn. It's unbelievable, and that was like 5 years ago, right? So that's actually, it's quite. So there is a problem in the profession, and there's of course now there is a lot of research on that. I mean, in academia, there's this issue of the leaky pipeline and so on, and I think we've learned a lot about what is behind that. And I think one of the main findings is that one of the reasons for the underrepresentation of women in economics is that there are either institutional or psychological barriers. So there can be cognitive biases, and there can be like institutional structures which favor men, even though that's not intended, right? So it's not really so much about discrimination. It's much more about such barriers. And for us as central banks, of course, this matters greatly because, I mean, the pool for our recruitment, of course, comes from the university. So we have a keen interest in them solving this issue. So when I came to the ECB, so of course, if you look at the leadership of the ECB since its start, within the group of more than 60 governors of the national central banks, there was a single woman out of more than 60. In the executive board, it's a bit better. So there were 20-something board members, and 5 of them were women. And as you know, now for the first time, there are 2 women in the executive board, and the first female president. The problem is that if the leadership is, if there are so few women, that can give rise to self-fulfilling expectations, in the sense that people tend to think if women are not there, there has to be a reason for that. So maybe they're just not good at that, right? And at the same time, of course, there are no role models for those who come, who are just starting their career. And so at the ECB, there was very interesting work done, as you also discussed about the IMF, Gita, on what is the reason for the underrepresentation of women at the ECB. And actually, one of the authors of the study, Anna Lamo, is actually in the audience. So let me tell you what they found out. So what they found out is that there is at the ECB, or that there was actually a big gender wage gap. So big gap between men and women in wages. And then they discovered that this was due to a promotion gap. So it seems that men were promoted more frequently than women. And then they also found out that that was due to the fact that women were less likely to apply. And then with the gender strategy that was introduced a couple of years ago, the ECB started to encourage women to apply. And already that changed the ratios quite substantially. And of course, Christine Lagarde has put this issue on the top of her agenda, and she has pushed the diversity agenda very, very hard. And we now have an even more ambitious gender strategy, and also more general diversity strategy. And with respect to gender, we now have these hiring and promotion targets of 50%. And I can tell you, it's actually working very well so far. So what I've seen since I've been at the ECB is that there are so many highly qualified women that this has never been an issue. And it has never been an issue that we said, we now have to hire a woman, but she is actually worse than the male candidate. There are plenty of very well-suited women, and I think we are making great progress there. And of course, there are a number of additional measures, like Edward also mentioned, by some of you, like mentoring. We have scholarships specifically for women. But I think we can move forward. I agree with Nelly, there's a long way to go still. But I mean, in principle, I think we know what we have to do, and we should just do it.
Thanks, Isabel. I think I completely agree with you that I think we know what needs to be done. We know all the benefits to the world from having greater diversity and inclusion, and so I think it's about getting the work done. Let me come to Andrew with a question. Andrew, you said that one of the problems, if I may just paraphrase, was a non-diverse pipeline in terms of, and I think several others brought it up too. So I guess the question is, how do we increase this pipeline? As we know, and as Nelly mentioned, that once you start getting to at least the PhD levels, it's about 25% of the students are women. You found women dropping off before that. Now, one of the arguments that you hear about why women may not be going into a PhD program or even a master's is because they associate economics with, Andrew Bailey talking about raising or cutting interest rates and about monetary policy more generally. And it feels less appealing than talking about some of the other issues that they care about, climate specifically, or poverty directly. And so there is a sense in which it's that, at least in surveys, that what comes across is that economics is very monodimensional. What we see is suited men talking about macro policies in very abstract senses, and that doesn't sound that exciting. So I guess, what would you say to them, and how would you encourage them to get into the field?
Well, it's tricky, isn't it? Because I'm obviously not a representative, because I find the whole thing fascinating. And I think we do have. You're right, Gita. We do have to do more. I think we are doing more, but I think we have to do more to make our world sort of come alive, in the sense of make it understandable to people, and to all sorts. I mean, to a whole range of people. That's important. It's important, obviously. But to start with, it's important because the effectiveness of policy will be better if it's better understood. So actually, let's start with that point, which is quite basic, really, but important. And then I think we have to do more to say, look, it really is interesting, and it does make a difference. I mean, I did look at the last, nearly 2 years now. And okay, monetary policy is only part of the story. It's not the biggest part of the story in terms of the response. But certainly, speaking for the UK, but I think I can sort of read it across to other countries. I think economic policy making has made a huge difference in this crisis. I look at how bad this could have been, and look at the things that we've done. And by the way, the things that we did before it to, in a sense, guard against these sorts of events. I mean, I've said a lot of people. I mean, if we'd had a pandemic 20 years ago, 15, 20 years ago, we'd have had a banking crisis on our hands as well, probably because of the weakness of the system. So I think there's a lot to be said for saying, look, this stuff, these things that we do really do matter. But we have to do that in a way that, as you rightly say, doesn't seem boring and rather one-dimensional. But I think it is important, as policymakers, that we do go out there, and probably that we take a few sort of greater risks in terms of how we communicate things to explain to people. It really does matter. And as I say, I think we've got actually quite an interesting example of this in terms of the response to COVID. We've had to make huge responses. We've taken, we've done things that we probably never imagined we would do in before. And I think going out and talking to people who are interested in, kids at school, people at universities, and say, this is what we had to do, this is what we did, and it really is important, and it really is fascinating. Says he who is extremely biased, obviously.
Thank you. Roger, I was wondering if you wanted to come in and share your views on how to increase the pipeline.
Well, first, all of us are biased, right? Because I fell in love with economics when I was 15. Now, part of that, though, is how to increase the pipeline. The reason I fell in love with economics had something to do with financial literacy at home. But in 1966, when I was 15, the first Black governor of the Fed was nominated. And so this whole question of role modeling, as we say sometimes here, if you can see it, you can be it. I'm sort of the embodiment of that. So, a way, not the only way, to increase the pipeline is for, the three women here, myself, Andrew, all of us, to be out talking about diversity of view and why this is exciting for everybody. Secondly, I think we do need to broaden the ambit of the way we think about economics. So we are representative of, a very important dimension of economics, but hardly the only one. We probably happen to think that, central banking monetary policy is the most important of the various disciplines in economics. But, when I think about what economics is about, as to Andrew's point, it's fundamentally about understanding and solving social problems. And, the second way I think we can increase the pipeline is to simply look at the diversity of who's been recognized as leading economists lately. And it includes people who are, most all, let's be fair, male, some females, fortunately, but everyone, economic historians, Danny Kahneman, who's basically a sociologist, psychologist, I guess, recent winners doing things on experimental economics, et cetera. So I think, part of the way to increase the pipeline is to identify the diversity in the profession that already does exist. And I think the third is to think about this dilemma that we have, which is that economics is so heavily associated with mathematics, and what happens around the ability for women and minorities to keep growing in math spills over into other topics. And one of the reasons I was very excited to see, and have been excited to see, different kinds of economists winning is we've many, lots of recognition, is no longer is economics, to my mind, the sort of the stepchild to applied math. It actually is starting to think much more about its social science origins. And that, I think, will certainly help drive the pool, because I believe one can be a very credible economist without necessarily having been the tippy top of your class and continuing on the various dimensions of calculus. I could be wrong, many of you may disagree with that, but I do think celebrating different models of being an economist is another obvious way to increase the diversity.
Thanks, Roger. By the way, if there's a participant who would like to ask a question, please raise your hand. We don't have that much time left. We have about 7 minutes. But if you raise your hand, you can have the screen at that time. Let me ask Isabel, you know, you've seen this story happen over some time now. What makes you optimistic that we might actually be on a trajectory where we end up in a good place? And what makes you pessimistic?
So let me first share one thought that I had when I was listening to the others. So actually, I think there is an interesting connection between the second and the first topic. So one of you said that no longer we have at the central banks, we only have like men with dark suits, but we also have a couple of women. At the same time, we are discussing different things at central banks. So suddenly we are discussing things like inequality, climate change. So I leave it open whether that is a correlation or a causality. But in any case, it may actually be that that this makes central banks more attractive also for women, because it is indeed there is research showing that on average, I mean, women are interested in different things from men, and actually this this shift of topics also in the central banking world may make central banks more attractive. On your question, I must say overall I'm optimistic because so many things are going on, and I mean there seems to be a clear will to change things, and I've seen that at various places. And I mean it's going slowly, but it's moving in the right direction, and this is what makes me optimistic. Maybe one point, and this related to something that Andrew said, is that of course, in the past, women had kind of fewer chances to succeed, but of course now it's kind of reversing. But that implies that actually young men may sometimes feel that they now have the lower chances to succeed. And for this generation of young men now, I mean, this is also a problem. I mean, we should keep that in mind, that some of them may have the feeling that due to the fact that now everybody is looking at gender issues, they may actually end up being disadvantaged. Probably part of that has to happen in a sense, because otherwise we'll never get to, I mean, we don't need the 50-50, but to a more or less equal representation. But I think that's also something that we have to keep in mind.
Thanks, Isabel. Nelly, would you like to weigh in on this question?
Just one thought. I think the recognition of untapped potential is become just more widespread, and the benefits not just to the economy as well as to society from greater diversity and inclusion is more apparent. I'm optimistic. I don't know, what is the final goal, exact representation of the population in the economist profession. I feel like that's probably not where we're aiming. Economists themselves have self-selected out of the broad pool of the population, but I do like the idea of the best pool of candidates is more diverse than today. I think that's something we can definitely aim for, and that's it.
Roger, did you want to come in, or Andrew, on this? On whether you're optimistic and...
Oh, well, I'll come in optimistic. I'm always optimistic. Now, part one. Two, just observing the fact that we've been having this conversation is quite amazing. It's a sign. And secondly, I recall one of my great mentors or friends, Alice Rivlin, describing what it was like when she graduated from Radcliffe, as it was then called, in 1964, 65, trying to get her first job. She had to enter in the back door of a crazy men's club in New York and literally have her be interviewed sitting outside of the women's room, because it was the only place where she could even be interviewed. Now, so is one optimistic? Of course, only because by definition there's been progress. Not enough, not fast enough. But the fact that we're even at this level having this discussion says to me that this is a problem that we'll keep chipping away at. So I tend to believe that progress is the natural path for humanity, and it's going to be slow and steady. But I suspect 20 years from now, this conversation, if it occurs, we'll have a very, very different expectation. That's not the same thing as saying 20 weeks from now, of course.
Thanks. Let me bring in, we have Linda Lober. We have just 2 minutes left, but Linda, do you want to ask your question? Thank you.
Yes, I wanted to just say, Roger had brought up a point. I'm Linda Loubert from Morgan State University in Baltimore, Maryland, an HBCU, and I teach economics. And one of the things that I do is I use GIS in teaching economics, because it's a technology that brings layers of information to a point of interest, to a point of inequality, to a point of whatever it is that you're trying to maybe fund or whatever. So I think the more that we can bring in, these technological tools into economics and not just be so math driven, can excite more people and just kind of just bring just a multitude of things for us to vision.
Thank you, Linda. Since we're out of time, I'm going to wrap up in the last 60 seconds. This has been a great discussion, on the question of monetary policy and inequality. Of course, I think everybody agrees that inequality is a major issue that needs to be addressed. Monetary policy affects it in complicated ways. And to the extent that while there are multiple instruments, there's only that much monetary policy can do. Inequality needs to be tackled by structural reforms and fiscal policy and the other tools that one has. On the second question, I guess the good news is that everybody's optimistic that we're having this conversation and that we're making progress on this front. I liked what Isabel said, that targets help. So maybe if you're an institution that doesn't have a target, it's a good thing to consider having a target that actually will get you there. And lastly, I was wondering, maybe when you have your meetings of central bankers and you can start the meeting by just saying, well, we recognize that we have very few women in this group. Just take a moment to recognize that we have too few women in this group, and then move on, because that is the fact. That I have been in numerous groups where I'm just the one or the only other woman who is at the table. And it might be good for everybody to pause and say that there's something wrong about this. But thank you so much for your time, and this was a really great conversation. And thanks for everybody who joined to listen in. I'm sorry I could not get to all the questions, but thank you, everyone. Have a great day.
Thanks, Peter.
Thank you
very much, Peter.
Thank you.
Professor Duflo hardly needs an introduction, having won the 2019 Nobel Prize for Economics for her work in development economics. Only the second woman to receive this award and the youngest economist overall. She's professor of poverty alleviation and development economics at MIT and co-founder and co-director of the Abdul Latif Jameel Poverty Action Lab, or JPAL. Her research focuses on microeconomic issues in developing countries, including household behavior, education, access to finance, health, and policy evaluation. She has published extensively in top journals like the American Economic Review, Econometrica, the Review of Economic Studies, and many more, including science and medicine-based journals. Today, she will share her insights with us on how we can make the economics profession more inclusive, drawing on initiatives underway at JPAL. Professor Duflo, you will speak for about 15 to 20 minutes. We will then open up for questions. Thank you very much for joining us. The floor is yours.
Thank you. Thank you, everyone. I'm very glad to be here and to be part of this project. Indeed, making economics more inclusive is one of the most important things that we should be doing at the moment, because economic is not inclusive. So today I'm going to talk a bit about the problem, then I'm going to talk a bit about one solution, which is the Economic Transformation Project and the DEDP Blended Masters. So what's the issue? Well, we saw a demonstration of the issue during the Black Lives Matter movement, where instead of highlighting the interesting research that economists have done, including economists of colors, on the issue of racial discrimination and other injustices in the context of the progressive awakening of the sentiment that something was very wrong in the relationship between black and white population in the US, and in particular in how black population has been treated over time. Instead of insisting on that, the press highlighted the fact that the profession is in fact an extremely white profession. And thanks to, perhaps due to not particularly subtle behavior of some of the members of our professions, the headlines was more along this headline from the New York Times: economics dominated by white men is ruled by Black Lives Matter. And then reference to this particular accusation. And later there were more articles about that maybe we don't publish enough on these issues in the professions. I don't know if I agree with that, but I certainly would agree with the fact that economics is dominated by white male as a field. And that's highly problematic because for two reasons. First of all, because it's a social science, and you think it would be very difficult to understand society without having, as part of the profession who seeks this understanding, a broader view, and that represents all corners of societies. And secondly, because economists end up being found across positions of power and influence all over societies, in particular in central bank. And in any effort to diversify the central banks has to start with an effort to diversify the economic profession, and in particular the pipeline of young economists. And this pipeline is very problematic. So the challenge is huge. There is a clear lack of diversity, both as far as women and as far as underrepresented minorities. 35% of economics BA were awarded to women, despite the fact that overall more than half of the BAs were awarded to women. 5% of economics major were Black students, and 5% of all economics degree conferred were to women from underrepresented minorities. So this is a profession which is in fact dominated by white male, and this is something which hasn't progressed as much in economics as it has in other fields, like for example in the STEM fields, after a realization that there was a problem in the last few years. So researchers have identified 3 barriers to improving diversity and inclusion in the field. The first one is about perception and information issues. So the issues that economics is mainly about perhaps what central banks think about, macroeconomics, and thinking about GDP and the inflation and going into finance and making money and so on. And that a lot of students from underrepresented minorities or female students, if they are interested in a particular field, it's often because they are interested in the ramification that it could have for society. And if they see economics mostly as a place that you go to prepare yourself for a career in finance and business, then it interests them much less than if they think that this is the place where we discuss all of the important issues that societies face, including interest rate, but not only, also including climate change and social inequality and so on. The other barrier that stands in between underrepresented minority, women, and a successful career in economics is what has come to be called a hidden curriculum. So the idea that to succeed in economics, or you need not only to do well in your classes, but you need to have, say, been a research assistant and to be able to know how to use Stata or R or other packages. And that's not really taught in class, but this is something that you kind of pick up along the way if you know that you have to pick it up. And if no one is there to tell you what is part of the hidden curriculum, then you cannot pick it up. And the third, more directly, is a hostile environment. So this has been documented for women in particular, with papers showing how women face more complicated questionings, how credit is more given to men than to women on co-authors paper, and so on and so forth. But of course, the reason why it's not been identified for minority is not, I think, because there is not a problem, but because there are so few minorities anyways that it's very difficult to even have enough sample to document that hostile environment quantitatively in published papers. But certainly a lot of members from underrepresented minority voiced that concern. So it's not something that has gone unobserved. I think the economics profession was a bit slow in realizing that this is something that could be that that could and should be dealt with compared to the other field, but now there is an effort. So many of our peer organizations are tackling the lack of diversity and inclusion in the field in different ways. The American Economic Association has a summer program that prepares underrepresented minority for PhD program in economics and related field. And in fact, a fifth of PhDs awarded to underrepresented minorities were coming from graduates of this program, showing its importance. The Minnesota Center for Diversity in Economics is an institution that tries to aim to increase gender and racial diversity through a number of programs. The SADI Collective equips and empowers Black women in quantitative science through programming and mentorship. In this landscape, what did we decide to do through the Economics Transformation Project, which is a project that is led, that I lead at JPAL with Amy Finkelstein and with our wonderful team there, including Jatna Amador and Toby Chaiken. So the idea is to create a more diverse, equitable, and field of economics by addressing those three barriers to entry along the pipeline. So going all the way from high school to admission into a PhD. So this, and all the way we want these three barriers in disparity in access to the knowledge on economics, the hidden curriculum, programs that provide technical skills, and mentorship and networking opportunities throughout the pipelines. So to do that, we have two initiatives that are complementary, that work together. One is the entire Economic Transformation Project, which has this full pipeline idea, and one component of it, but which is ahead of it in a sense in terms of its execution in some ways, is a DEDP MicroMasters, which is a blended program that I'm going to describe in more detail. So let me spend some time on the two projects. So the objective of the Economic Transformation Project is to sort of progressively work along the entire pipeline. So in high school, we try to understand what's the issue. In college access, why are students who are college bound not choosing economics? Then we work on programs to spark interest in economics among URM high school students. So what we have already done is introduction to economics workshop at high school and college access program. We are now in active discussion with MIT MITx Online venture to see whether we could make some of MIT's classes available to high school students alongside with mentoring. And third is programs to provide skill building opportunities for undergraduate and predoctoral scholars from underrepresented minorities. So we provide stipend to attend our existing research staff trainings, which are precisely designed to give this type of programs. Custom workshop and training for partner organizations as well. What we are planning to do in the future is basically extend this, where we started with a high school student. We want to grow with a high school student, but also expand to college students by developing a mentorship program and an advisory group for college students. Work with partners to, and create a learning community of organizations to work together to diversify economics, to sort of share finding and share kind of opportunities, and develop a curriculum for a coding and statistic masterclass, online and offline, to provide skill building opportunities for undergraduates and pre-docs. One of the, and then our third initiative that is both happening and in the future is our MicroMasters blended masters. So the reason why it's also already present in future is that the DEDP is already going on, but it's currently focusing on international students. And the inspiration for the DEDP was that there is a high demand around the world for rigorous analytic and empirical training in development economics. The current training opportunities are limited and very, very expensive. You have to spend 2 years to get a very good master's program at the Kennedy School, for example, or the Woodrow Wilson School. This is not available for most people. And so we thought there is a gap to fill for a program that is just as rigorous, but is a little bit less expensive and less time consuming. So how do we make it work? Well, we created a program which is a MicroMasters, which has a suite of online courses which are upper level MIT undergraduate classes. People have to take 5 online classes online that corresponds to a semester, but they can take it over more than the semesters. There is micro, statistics, and data science, and then 2 courses of development economics, some elective in political economy and the like. When they're done, they take proctored exams for each course. And then on the basis of the proctored exam scores, they can apply when they are finished. They first earn a MicroMasters credential, and second, they can apply to an accelerated on-campus master's at MIT. If they are admitted based essentially on their performance in the MicroMasters, almost regardless of what else they have done. Once they come to MIT, they are given advanced standing for the classes they've already took. So they take 1 semester worth of classes to complete their Masters of Applied Science in 1 year, complete a capstone project, and then they get their degree. So MIT basically took the bold step of saying that a 1 year course, including half of it done online, plus the capstone project constitute a Masters of Science credential. This has been, I think, effective at reducing barrier to entry for development economics. It's inexpensive, it's very rigorous, it's flexible. It has been very effective at enlarging MIT. You can see where the people came from for the masters. I think it's safe to say that none of these students would have been admitted to MIT either as undergraduate or as graduate students. And yet they were all admitted on the masters. So that's the first success in terms of enlarging the reach of our work. The second success is that it turns out that the students are actually much better than the students who come to these classes via the regular admission program. You can see here the conditional distribution function of the classes that they took. This is for econometrics, data science, taught by Josh Angrist. And you can see how, but we have done the same analysis for all the classes that they took in large number. And you can see that the DDP grade stochastically dominate the grade for the non-DDP students in a very clear way. So this was, and now this is for political economy and development, similar graph. And finally, firm, market, trade and growth, again, similar graph, even more striking, if anything, with excellent scores. So the program has been effective at diversifying not only entry into our program, but I think development economics as a whole. Since our first cohort has graduated, students have gone on to the University of Michigan as graduate students, to the World Bank, to IPA, back to their governments and more. So far, we have only 34 total alumni because COVID came a little bit in the middle of our second cohort. You can see it on the photo here. It's a little bit small, but we will enroll 33 students in the coming year to make up for it. So why does that relate to the URM question domestically? It's because now our future plan is with the success and popularity of the DDP Master's Program. JPAL and the Department of Economics have begun planning a program focused on domestic social policy issues, focused on diversity and inclusion. We've hired a new faculty director because I was getting stretched out. So Sarah Ellison is in charge of both the current DDP as well as developing the new And the unique structure of the MicroMasters program can attract URM scholars from all stages of their education, including students fresh out of college, as well as people who are already working. We'll of course need a special outreach to foster interest in communities that are traditionally not well served by MIT. So these are some opportunities to get involved. Central banks could full fund students. We are in need of scholarships. Academic and researchers can participate in our work. Peer organization can participate in learning community. Thank you very much. I'm now going to stop sharing, and I'm open for questions.
Thank you very much indeed. Really interesting initiatives and great to see successes already as well. We've got just over 20 minutes for discussion now. So if anyone from the audience would like to come in, please raise your virtual hand. When I call you, you'll be moved from attendee to panelist. Please then turn on your camera and unmute yourself when I ask you to ask your question. And to allow as many questions as possible, please be brief when asking your question. But let me kick off with a question I had. So I understand that you yourself did not think that economics was necessarily for you at first, with what you were learning not really consistent with making the world a better place. Could you say a bit more on what you might tell a young person about why you persevered?
So I actually gave up economics soon after I started it. My undergraduate, my first 2 years of undergraduate was a very general social science and mathematics education. Then in my third year, when I had to pick a major, I decided to pick history and economics. I did 1 year economics, and I thought, that's it. This is absolutely, this is not interesting. This is just this. And then I decided to leave for Russia to do my master's degree in history, and there by chance I actually ended up working for economists as a research assistant. In fact, I worked, believe it or not, on a project with the Central Bank of Russia. So I suppose it's a central bank that gave me my first exposure to economics. So I was working on this project, which was actually a fascinating project on the explosion of firm-to-firm debt, intra-firm debt. And I had to teach myself all sorts of stuff about how to constitute a random sample of firms, and then we were going to the firms, we were interviewing them, etc. It was great. And then in the context of this project, and then I found another job for the enemy of the central bank, who were the Ministry of Finance, were actually the sworn enemy of the central bank. And so I had this second job, and then the two jobs had to remain secret from each other, because otherwise they would be very upset. And in this, I could see that actually economics was not what I was taught in class, that economics was not just about drawing indifference curve and finding the tangent point. It was really extraordinarily influential in determining the course of what was going on in Russia at the time. It was the heart of the economic transition. Critical decisions were taken with economic input. And that's when I decided that it was worth doing economics, because I thought, okay, maybe you have to go through this indifference curve business in order to go back, at the other end of this tunnel and be able to say something relevant on policy. So what I would hope now is that intro economics is progressively changes. In fact, I'm teaching a class for freshmen at MIT, 2 classes. One on development, which focuses on case studies, and one on, general economics and what economics think about, which is more of a, chit-chat related to the what's going on in the world today and so on. And to give people already a glimpse of what is the light at the end of the tunnel, to give them the stamina they need to go through the introduction, which is not very exciting for anyone.
Great, thank you. I can't see any hands yet, so I might just ask a follow-up question as well. you mentioned the sort of hostile environment that can be the case in the economics profession, say in seminars and so on. Would you say that as a woman, you sort of have to be strong in the economics profession, or are there other ways to influence?
I think, unfortunately, I think one has to be strong. Maybe this is changing, and this is changing faster in some field which have more women than others, but in particular in macro, which is relevant for a lot of you central bankers. As long as there are very few women, then the culture sort of self-perpetuate. And the women can only stay if they are willing to play ball with that. So in some sense, there is not much of a choice that you have to be strong, or you have to pretend that you are strong, which is a little bit difficult. But this changes as soon as there is a slightly bigger group of women, I think. So, for example, if you look at development, which is a field which has much more gender balance, it's a much more. I think the culture there is much calmer and friendly and all that. I also think that it can change. The culture can change without just having a woman there by virtue of men behaving better, because I don't think people mean ill. I just think they don't kind of realize that even the culture that they grew up when they're younger is not necessarily the best and most congenial way for everyone, and in particular for women or underrepresented minority. But there are a few things that can be done. Simple things like not starting to ask questions until about 10 minutes into the seminar, which we have started to do at MIT, and changes the dynamic actually quite a bit. And I'm finding that these changes kind of take hold, even in fields that are still male-dominated. And I'm quite hopeful actually that it can change that it will people will realize it's actually better that way, and it will continue on its own without any particular problem, and become more ingrained and create a more congenial culture in the next few years. But in the meantime, we just have to endure it.
Great, thank you. I mean, great to hear that changes are afoot, and we're optimistic that will continue. Now I've got a few questions. Brian Doyle, I think you were first.
Lag and getting this to come up. So I found the description of the program that JPAL has rolled out and has enacted. So what advice would you give to other schools and universities on what they can do, what lessons from this program to encourage and prepare more underrepresented groups to pursue careers in economics? And I'm hoping, as a central banker, we also are, big employers of research assistants. Are there any lessons? So we're not training in the same way that universities are, but we're training in a more practical sense. And I guess is there advice or lessons from these programs that you would give to us?
I think the biggest lesson is that our admission process is deeply flawed. And we knew it, right? We know that it's deeply flawed in the sense that it goes to the selection of one narrow type of people, which happen to be more white and more privileged and perhaps more male as well. But I think what a lot of people in university tell themselves is that this is the cost for excellence, and there is no alternative. And what we are learning in this program is that it just isn't. It's the cost for selecting in a particular way with the grades and the name of the school and the reference that you do know. Because when we went ahead and selected based on performance in the classes and that we want them to take, so for the equivalent for your program is in the task that you want them to do, we actually get better students while getting a vastly more diverse scope. So my advice would be that excuse me, I have to stop this. Someone is trying many different ways to find me. So the lesson is that one could do the same. One should do the same, and there is in fact no trade-off between diversity and quality. And my bet when we started this program was that it would be true, but I really underestimated to what extent. And that there is only a trade-off between our very narrow way of defining quality ex ante, which does not correlate very well with quality ex post, as in grade in our program or performance in the program. And then if one is creative in the admission program, in the admission, one can do much better both on diversity and on quality. So that's why we got really inspired to start the DED, a more domestic issues, domestic policy oriented version of the program, because then we will kind of do outreach towards this population we are looking for. I'm confident we will find students into this program that will be better than our regular, upper level undergrad admit. And more gritty than the PhD and more scrappy and wanting to do better. So from the point of view of another program, very easy. If it's another program, MIT favors and encourages using our classes as pathways. So what we did with our program, any other university can do with our program. They can use the same exams to give advanced credit and score for entry into their program. And I would definitely advise one to do that, because there is more than 20 students who deserve entry. For the Fed, it's a bit different because you're screening for research assistant, but likewise, you could use our course and look at the performance in our course in the micro and the probability and data analysis course, and say this is what you're gonna use for recruitment, and de-emphasize grades and recommendations and all of that. And you might think it's a leap and it's dangerous, but my experience suggests that it's not. That the people who do well on this exam will do well being Fed area. If you wanted to be more ambitious, then you would construct something similar that serves your screening purpose even better. But I would think that the combination of the micro plus the data analysis course would do a long way.
Thanks a lot. Chiara, I think, Chiara Scotti, you have a question.
Yes, hi Esther. Good to see you here. So I actually wanted to ask the same question that Brian asked, so I'll switch to a different one. So far we've talked about, or you have talked about, how to select students differently to give them, a different opportunity and to prepare them for becoming an economist. And then Brian asked you about, okay, what can we do as central banks? So I'm going to ask you a slightly different question, which is, after, all of the above. So once you are in the economic field, it's still true that women are a little bit at a disadvantage. And for example, there are studies that show that women are not cited as much as men. They don't have the same opportunities. And so I just wanted to ask, given your experience and your knowledge, on what you've done so far with younger students, what can we do, once you're graduated and you're older, to help out women or in general minorities to succeed?
Yeah, that's a great question. So the first thing is that there is a safety in numbers. This was kind of the discussion we were having with Julia before, which is that the culture improved just by, and becoming more inclusive just by the virtue of the fact that the group is more diverse. And I think life was much harder for women, 20 years ago than it is now, just because there are a few more women. And I'm hoping it would be easier for underrepresented minority in 20 years than it is now, because there'll be a few more underrepresented minorities. So that's the first lot. We're just getting more people in at the beginning of the pipeline is already going to improve the experience down the pipeline. Now, I take your point that it's not sufficient because there are all the other things that come up. The hidden curriculum catches up. The culture catches up, the sense, imposter syndrome catches up, and one has to kind of tackle this one at a time. So one thing is to make sure that people are feel competent and prepared, and therefore support them. For example, for your research assistants. Make sure that there are training opportunities for them. They have experience to anything that they think they should know, but that the other peers might know, but they don't know. They have time and resources to learn those before instead of just feeling incompetent and staying in the background. The other thing is it's harder to say. It's hard to legislate that women should be cited as much as men. I don't know how one does that. But anything that can, my experience, because I've worked on women leadership in a very different setup, but in political systems in India, my experience from that research is that there are prejudices that actually changes relatively rapidly with exposure to people you're not used to see in a particular position. So people form stereotypes that someone is able to do this or someone is not able to do this or whatnot. And this stereotype is powerful and they affect decision and choices, but they're also affected by what you see around you. And therefore, pushing a bit the envelope, making some specific effort, for example, to put women on to make sure that women get equal representation in opportunity to present, even if it forces your nature initially, and it sounds odd to have quotas. Actually, that's kind of a good way of disciplining exposure, and then it will become much more natural. People will realize, oh, women are just as good as presenting, in fact. So now we can, when we have a team which has both women and men, we can send a woman to present. So a little bit of pushing kind of helps kickstarting a process, because when you don't have experience, you kind of revert to what is known as status quo bias, and there is a role in leadership in forcing people out of their comfort zone. So I'll give an example for women presentation, but it could be. I'm sure there are other opportunities there within the institution for who takes the leadership of a project and so on and so forth.
Super, thank you. And I'm glad you brought up your research on female leadership, which I think is really super interesting. We've got one final question and 2 minutes left. Sarah Sheikh, please.
Hi, Esther. Thank you so much for your talk. I'm a research assistant at the Bank of Canada right now, and I had a question about, well, the past two questions touched on how after recruiting women, retention can be a problem. And I think with the hostile culture in the field, particularly in seminars, there's a bit of a first mover problem in changing the seminar culture. So from your perspective, do you think there are tangible changes that academic institutions and central banks can take, such as introducing a code of conduct for seminars that would help? And do you think that after leading institutions do that, it could successfully permeate and spread across the field?
Yeah, I think so. And not only that, but I think they are, to some extent already doing it. For example, I gave the example of MIT, where we leave 10 minutes to the speaker to speak before they get interrupted. So that might sound very minor, but I think it actually changes. It actually changes the nature. I given talk in some places where people were very proud to not let the speaker say one word, and we don't have that. One could go beyond that to think about other ways in which people could be mindful in the way that they interact with the speaker in seminars. I'm not sure what they are, but that's it's a failure of my imagination. If we and then I actually think it would be if there are such things that are known to change the culture, which I'm sure someone has researched, then yes, we should implement them. It will, as I was saying, I think it's kind of, even if people find it funny to start with. I remember, for example, for the 10 minutes rule, initially at MIT, my colleagues were like, really? This is going to be boring. We are going to miss, we don't want to hear someone talk on their own for 10 minutes. And then now, everybody is quite comfortable with it. I think it's not a rule that they can see that it has not made the experience of attending a seminar either radically different or any worse. So similarly, I think for many other rules you could think about.
Thank you very much. I think we're out of time, but this has been a really fascinating session with great insight. So thank you once again for joining us. And I think we've got a short break now, back at 1:40 Eastern Time. Thank you.
Thank you.
In economics. Just as a reminder, as for the previous sessions, we have two presenters, each is presenting for 20 minutes. Then we have a discussant who will talk for 10 minutes, and then a general discussion after each one of the papers have been presented and discussed. During the Q&A, please raise your virtual hand using the WebEx feature, and when called, unmute and start your video, and be clear and direct because we have limited time and we want to give everyone a chance to participate. So with that, we can start with our first presenter, Marlene Coffey, who's presenting the paper Innovative Ideas and Gender Inequality. The floor is yours, Marlene.
Thank you very much, Chiara. Thank you very much to all of you for attending this presentation. I'm really free to present my paper on innovative idea and gender inequality, and let me start with the motivation. Next slide, please. So there is a huge literature talking about some gender-related issue in education and labor. For example, the difference in terms of wage gap, the difference in terms of school attendance, the underrepresentation of women in math-intensive field. There are some potential explanations that have been provided in the literature, such as family commitment, risk aversion, competitiveness, and also sometimes some discriminatory factors. But so far, less is known on the recognition of women's idea. And at the same time, academic research offers a kind of an idea framework or a suitable framework to analyze idea, and in particular to see how women's ideas are perceived, used, and referred to. And there is also a growing literature showing some type of gap or discrimination or bias gender bias in economic literature, and that tend also to be more prevalent in economics compared to other social science or even other STEM fields. Next slide, please. So the question that I'm asking in this paper are the following. Is the credit given to women's work, and or are women facing any bias in the recognition of their work? And by work, I mean academic work. And if so, what are the effects or the implications of such bias? Next slide, please. So in this paper, I studied the recognition of women's work in male-dominated fields such as economics. I will use citation or omission from reference, and I have this a picture to show you like what I will be doing in this paper. So let's say that you want to write a paper, and in writing this paper, there is a bunch of other papers in the related literature. And for example, you have 500 papers that are kind of closely related to yours. So in writing your paper, you have to make a choice and who you want to cite. You have to select the paper that you want to cite. And in making this choice, it's possible that we can have some type of bias, and why not a gender bias? By contrast, imagine that you have an automated algorithm where each time you want to write a paper, you just insert the keyword or the abstract if you have it, and it provides you like the paper that are closely related to yours. And by construction of such an automated algorithm, this is pretty much agnostic of the gender. So by construction, there is no inherent gender bias. And the question that I'm asking is the following: what happens if we contrast the author choice and the automated algorithm choice? Next slide, please. So the contribution of this paper will be twofold. The first part will be on the topic. So I shed new light on the lack of recognition of women's work. I present some heterogeneous pattern depending on the gender of the citing, the journal, the institution, also the field. I show some potential effect on future outcome and career path. The second part is more methodological, where I use deep learning, especially natural language processing for public policy. I build a distance to link different papers. So I will have a citing paper, a cited paper, and a paper that should be cited according to the distance metric. I construct the omission index. This gives you the state where a paper that is closely related to another paper is not cited by the former. And the last part will be based on the patent literature. I will construct an innovativeness index that is kind of an alternative way to measure the quality of the paper. Next slide, please. So in terms of the finding, the key finding is what I call here the 2020 pattern. On average, omitted paper tend to have an order of omission. The order of omission of paper written by female tend to be 20% higher compared to the order of omission of paper written by male. And I exhibit also some difference, like for example, having male in the citing paper increase this omission probability by up to 6 percentage points compared to having female compared to females cited or omitted. Sorry. And the second part is also that even females that are published in the top 5 journals are not exempted from this omission. And as I said, I construct the innovativeness index to have an alternative way to measure the quality of the paper. And if I compare this to what the existing way to measure the quality, that is kind of the citation, I can see that to have the same level of citation as paper written by male, paper written by female need to be 20% upper in terms of the quality, the innovativeness distribution. And the last part of the paper provides some insight. This is more suggestive evidence that past omission could have some effect on the future career path of the author. And for example, I put here the example of the publication in top 5 journal, and I see a link, a correlation between past omission and future publication, where past omission reduce the probability to get published in a top 5 journal, for example, by up to 5 percentage points. Next slide, please. So there are a couple of papers that are part of the literature talking about either gender in economics, gender in academia, and other literature using text analysis. So the paper that tend to be the closely related to mine is the paper by Sarson, where she also look at the recognition of women's work, but in her work she look at like how co-authoring with the opposite gender affect the probability of getting the tenure. In my case, I explicitly use the reference to study the recognition of women. So that's the point I can make for this. Next slide, please. So this presentation, we have 3 main parts. The first part will be the data description. The second part, how we move from textual analysis to the construction of the omission and innovative index. The last part will be the empirical strategy with some type of discussion that end if we have some time. Next slide, please. Next slide. So for the data description, I use data from Web of Science, Econet, and also RePEc. So I focus in the main part of the paper on paper journals that have been in all major top 20 ranking. And the reason why I'm focusing on those journals is because those are a signal of quality. So I want to minimize that one reason for which one group or another group is not cited is because of the quality of the paper. And in the baseline, I will have like 24,000 papers ranging from 1991 to 2019. And this will exclude paper without abstract and reference, and preceding papers, comment, book review, biographical item. So I really want to focus on full-length paper to assess the citability, if you want, or not. And on top of that, I want to precise that I focus on published paper again, because this is a signal of quality. This is the first reason. And the second reason is that if in the reviewing process at some point, and because of the high standard that are imposed in the reviewing process, I'm hoping that if there is something that is missing, maybe this paper will be added in the reference. So I focus on published paper. Next slide, please. So this is a snapshot on the type of data that I extracted from Web of Science. So as you can see here, there is the title. I can have the author, the journal, some detailed information about the journal, such as the volume, the issue, and also the DOI, the published year, and the abstract. So I use the abstract, the keyword, especially for the text analysis part. I have also information about the institution, the citation count, and the reference. Next slide, please. So the second stage of the paper is to find the gender of the author, and after that infer the gender composition of those authors in a given paper. So to find the gender of the author, I use gender recognition based on first name. So I use an automated algorithm that is called GenderWise. On top of that, I complete this with mostly a manual check. So if the probability that a gender is we have a certain gender is lower than 0.8, I proceed to a manual check to see if the author is a female, is a man or a woman. So basically, I go on website, I check if I have a picture, I have an article talking about this author using some pronouns and so on to match the gender of the author. And from that, I can infer the gender of the paper in quotes. So for example, if we have only men in a given paper, this will be a male author paper. If we have only women in a given paper, this would be a female author paper. And if we have at least one male, at least one female, we can have a different subdivision, like at least one female paper, a mixed gender paper, or majority of female paper. In the database overall, in terms of the descriptive, 5% of the paper are written by only women. So those are female author paper. 74% by only men. So those are male author paper. But I have 77% of the author that are men and 70% of the author that are women. And as you can see, the percentage doesn't add up to 100, and especially the 70 and the 70% and the 17%, because there are some authors for which I can't find any gender. Next slide, please. So after that, I construct the similarity index based on the textual information. So how I do it? So the textual similarity, basically the idea is to see the commonality in the topical content of each paper. And after that, let's say that we have two papers, as you can see in this plot. We have one talking about orange, the other one talking about apple. The idea is to have a vector representation of those two papers based on the word inside the paper. And after, see the angle between those two papers. And this angle will give us the distance between two different papers that we are trying to compare. So after that, I construct the omission index having those similarities. And to make this more concrete, I have an example in the next slide. So let's say that we take three papers as it is here, PEP prime and P second. We have the first stage is, let's say we have the abstract, you take the abstract, and after that you split the abstract in a set of words, as you can see on the first column of this table. And to have those words, we have some data cleaning process where we drop words that are meaningless, we drop some stuff that are not useful, like the punctuation, for example. In my case, I also drop the number. I also take care of the acronym that are very frequent in economics. And finally, I have this list of words. And for each paper, I can say the number of times this word has been used in the given paper. Next slide, please. And after that, I compute this metric that's called the term frequency inverse document frequency. So the term frequency is the number of times a given word appears in the paper divided by the total length of the paper. The inverse document frequency is the number of paper, total number of paper in the database divided by the total number of paper in which we have a certain word. So for example, if I take the word trade credit here, the first cell is saying that the word trade credit appears 6 times in paper P, and I divide it by the total length of paper P. times the IDF of the World Trade Credit in the whole database, because the IDF is dependent on all the documents that we have in the database. And finally, to compute the distance metric, so the similarity, this is the dot product that is normalized. So for example, I will have the TF-IDF of the World Trade Credit in paper P times the TF-IDF of the World Trade Credit in paper P prime plus the TF-IDF of the World Retailer in paper P times TF-IDF retailer in paper P prime, and so on. And I divide by the norm 2. So after this stage, next slide, please. I have like all the pairwise similarity. So for each paper, I have the similarity with all the other paper in the database, and I can rank those similarity to have like the relative importance of each paper in terms of the distance metric. And from this ranking, I can exhibit the most similar paper. So in the baseline, I choose the most similar set to have like 5 paper, but I increase like this number. I play around this number basically in the robustness of the paper. And if I take the construction of the omission index will be as follow. It will take 1 if the paper P does not cite paper P prime, conditional on the paper being in the most similar set, and we take 0 otherwise. And to come back to the example that we have so far, so when we look at the relative frequency, pretty much those papers tend to talk about the same thing and are pretty close. And what happened in the database is the following. P, I've cited P seconds. So the omission index between P and P second will be equal to 0 because P cited P second, given that P second is in more similar set. But P does not cite P prime, even P prime being in the most similar set. So the omission index will be equal to 1. And it appears that P prime is a female author paper and P second is a male author paper. So this is basically the type of pattern that I'm capturing in the data. Next slide, please. So lastly, for this text analysis part is the construction of the innovative index. So as I said, this is based on the patent literature, especially paper by Kelly and others. So the idea here is to construct a metric that takes into account similarity for a given paper with all the past literature, but also similarity for a given paper with all the future literature. So if I take a paper that is published in the given year, I look at all the paper published before. This is a backward similarity. And also for the same paper, I look at all the paper published after. This is the forward similarity, and I add up all of those similarities. And the idea is the following. If a paper is novel, we expect the backward similarity to be lower because this paper introduced some new content or some new notion that do not exist in the past. If the paper have influenced the future literature, we expect the forward similarity to be higher because this, based on this paper, the other literature build on this. So we have the numerator basically of the innovativeness index that will be higher, and for the backward similarity that is lower, the denominator will be lower. So a paper with a high level of innovativeness index will tend to have a high forward and a low backward. So this is the idea. Next slide, please. Next slide. So for the empirical strategy, so the idea here will be to use the omission index, that's basically a binary variable that have been constructed to see how this is influenced by the gender. So the main dependent variable will be the gender. So the coefficient of interest is beta 0 here, and I control for a wide range of other variables, ranging from variables that are specific to each paper, for example, the institution, the field, the gender structure of the most similar, the number of authors, the number of reference, variables that are common to the different paper. So, for example, if they share the same primary field, if they have the same gender structure of the author, the same affiliation, and so on. And also variable in terms of the timing, so the difference in publication year and some year fixed effect also. So I just want to precise that I here is the citing paper, so the paper that cite at a given point in time, and J is the cited or omitted paper, so the paper that appear in the most similar set and that should be cited basically according to the distance metric. Next slide, please. So the main result of the paper is given in these tables, and as you can see, controlling for a wide range of variables, we still have like the order of omission of paper written by women tend to be 20% higher on average compared to the order of omission of paper written by female. And this finding is strong and robust to some alternative robustness that I put here. On the next slide, I present like some heterogeneous effects that depend on the journal and on the institution. I have others on the field, and I think the field aspect could be also of interest for macroeconomists at the Stanford Bank. But let me talk about this general aspect on the depending on the journal and the institution. So as you can see here, even paper published in top journal are not exempted from the omission. So having male in the citing paper increase omission of female by up to 5.3 percentage points if we look at top 5 journals, column 2. And one thing that is very interesting is also for the institution effect. So we can see here that like there is kind of a concentration of the effect on the mid-tier institution. So the low tier and the top tier tend to have some degree of omission, especially two-sided gender omission, but the bulk of the effect is really concentrated on the mid-tier. And this is very interesting to think about the mechanism. So as I say, I won't present this here, but again, if I take by field, there is a difference depending on the field where more theoretical fields tend to exhibit higher omission compared to more direct field. Next slide, please.
Marlene, you have 2 or 3 more minutes.
Okay, thank you. So here I have a couple of robustness that are presented here, and I will be happy to discuss them if during the Q&A session. Next slide, please. So one of the big questions is this gap due to discrimination or other factor? And one thing that is important to mention here is that we have some potential trait to identification, especially omitted variable bias. So for example, imagine we can think about networking, I don't know, self-advertisement, maybe women are not self-advertising their paper and so on. So those are things that it will be difficult to control for that. So I propose 2 tests here to get around those limitations. The first one is to test if this is a lack of information. So lack of information, I consider the case where there is an increasing likelihood that the different authors can know each other. So for example, if we share the same institution, if we are in the same network of co-authors and so on. The second one is to see like if there is a difference depending on the perception that we have on one's gender based on the first name. So there is a mistake here. This is not surname, it's first name. So for concretely, what I'm testing is the following: is Hannah omission probability greater than Cameron omission probability? And the idea used doing this is that if there are some heterogeneous effects unobservable that affect differently the gender, when we condition on a given gender, we should not expect any difference. So this is the hypothesis behind. Next slide, please. And what I'm finding is very interesting because actually Cameron has a lower probability to get omitted compared to Anna. And if I control this using like similarly for male, so if I take Cameron, which is a male, compared to Robert, which is a name that we know to be a male name, I observe also that Cameron has a relatively higher omission compared to Robert. So this is very interesting and give some intuition towards what is happening in the data. Next slide, please. So the next step, as I told you, I consider an alternative way to measure the quality of the paper using the Innovativeness Index. And with this plot, you can see that those are the citation and the Innovativeness Index are pretty much in line, except that we observe a gap between men and women if we take the citation compared to the Innovativeness Index. So to have the same level of citation, women need to be 20% upper in terms of the innovativeness distribution. Next slide, please. And if we compensate this by the number of omitted citations, we can see that this gap vanishes away. Next slide, please. So let me end with this part. That is just some scientific evidence that what can happen depending on the past omission. And basically, what I observe is taking different type of outcome publication in top 5 citation and what I call one shot. It's just the fact of appearing just one time in the database, like you disappear after, basically. I observe that there is a negative effect regarding those outcomes. So the omission, past omission, tend to affect future outcome. At least there is some scientific evidence that there is a correlation with future outcome of the author. Next slide. So I will just conclude here by saying that I present some new evidence of gender bias in omission from reference, paper written by women 20 percentile likely to are more omitted compared to paper written by men. Even papers published in top 5 are not exempted from that, and this tend to be not explained by seniority or lack of information. And from a policy side, I think this paper really raised awareness of the author, of the editor, and the referee, and also of the institution, because citation matter to have grant, to have tenure, and all those things. It's important to be aware of such issue. Thank you very much for the question.
Laura, please go ahead with your discussion.
Okay, so first of all, thanks a lot for having me. Thanks a lot for giving me the opportunity to read the paper. So I saw Marlene presenting this paper in a seminar longer than this one, but so also have the opportunity to read it. It was great. So I'm going to first start summarizing this, but just because for me it was useful to settle ideas. But I mean, Marlene did a fantastic job in her presentation. So I will try to be brief on that and then move to the comments. So next slide, please. Next slide. So what the paper does, well, the paper investigates whether there are gender biases in citation patterns, and specifically whether articles by equally relevant and innovative male and female authors are similarly placed. Okay. So the great thing about this paper is that Marlene is able to use machine learning techniques and also bibliometric data and articles published in very good journals. So this is really good papers. But use this information to establish whether first there are similarities between papers, and do this in a very automatic way for an incredibly large number of papers. And also then it's also possible to build links between papers and to identify first, okay, the papers that cite in a given paper, that this is difficult to do, but I think that more or less we understand how to do this. Also those that are cited, but I think that what is even more interesting, and for me it's like the big contribution of this paper, is also those that should be cited and they are not. So this measure of the omission by index, that is so crucial for the analysis here, okay? So next slide, please. And in terms of what the paper finds, so there is this, well, if on average, these omitted papers are 20% less likely to be cited if they are coming from female authors than male authors. But also there are very nice heterogeneity in terms of the effect. So one of the results that I was also for me very interesting to see is that the papers that are most likely to be omitted are those that are coming from women that are working at a nuclear institution and also publishing in not top journals. So I think that this visibility is going to be one of the very important issues here to understand what is going on, okay? So then there are also other heterogeneity patterns that probably were more familiar that somehow we were like expecting to have, because they are also prevalent in other papers that have been looking at these different treatments for females in the academia. So that this omission bias is higher in theoretical fields than in applied fields. Also, the more the article is perceived to be female, and also when there are, indeed, I mean, when who is the one that should be citing or not, also the gender of those matters a lot, okay? So then, although this is only, suggestive evidence, but I think that it's very important that also the paper get complemented with this additional piece of information on why we should care about this. Is also because, indeed, being omitted has an impact in your career, okay? So one possible quantification of this is that, it's reducing the probability of getting published in the top 5 journal in the future. And as you can imagine, this impact is not small, okay? So next slide. So my comments first, well, I see this paper as a high quality work that is making use more than that the range of data that is available there is how he managed to process this information, okay? So I think that really this construction of the omission index is a very important methodological contribution. But it's still, I think that also calls for more examination of what would be done with this data. Okay, so next slide for specific comments on that. So for me, what is still the puzzle in all of this literature is how to break this cycle. Okay, so we have these gender biases,
and I still don't see how to break that, okay? Because I mean, this is one piece in terms of citation, but we have seen in general that there are like lower levels of visibility, opportunities to be visible, apparently, for women in the academia relative to men, okay? So with Carlos, we were seeing this in the sense of, getting accepted to conferences. As you can imagine, this is like something that we have to do several times within a year. So even with, taking into account as much as possible for variants, still there is this significant gender bias, okay? So this will be one step also. So if people don't see you presenting, they are not going to cite you. Because, I mean, what is great about this paper is that, okay, let's confront what people do, what the machine will be doing, okay? But we are not machines, so sometimes when we have written papers and we have to include sites, reference that are for us, this reference has been at some point visible for us. So we get to find that reference somehow. It can be coming from our co-authors, from our networks, from, people that are presenting at our departments, or to be in conferences. But if people are not, if women are not participating there that much, I'm sure that is also affecting how we cite there. And also, this could be conferences. It's also, we have, there's also evidence that we have a smaller networks. Also, when we are presenting somehow, we also have a smaller audience. So even online, we have a smaller reach, okay? So for me, it's a matter of how to break all these different channels that is like putting us in less visible position in the career and the profession. So so most likely that people are not aware of what we are doing, okay? And then this is a very, another comment that I also associated with the same idea is that something that I don't know, I couldn't find in the paper is for this calculation of how this, the implication of this omission in our careers afterwards is whether indeed, it could even bigger that impact if we take into account that, in the future we are having less women because some of them already left the academia. So, and we know that this is something that could happen. Okay, so I don't know up to, whether really for that analysis you are like only considering those that are still there, those that remain. But just to mention that the impact could be even bigger, or even it was just nice to see as an additional outcome, how, if it's possible, I don't know whether it's possible to look at whether this omission could also affect your livelihood of living indeed. That it would be like a very, like a very severe outcome for this, okay? So thanks a lot for this work. And thanks a lot for increasing the awareness for people. I think that in many cases they are even not aware of what they are doing. So this is why I think that this kind of references are so important and useful in the profession. Thanks a lot.
Thank you, Laura, for your discussion. So before I go to the questions, Marlene, do you want to give a brief answer to Laura's discussion?
Yeah, thank you very much, Laura, for this great discussion. You emphasize some key points of the paper and also some key points that should be addressed after taking the further research on this topic. And one thing, two couple of things that I just want to say is regarding the idea of survivorship bias. So yeah, really, I try to assess this with this variable that I just call wild shot to some extent, just to characterize the fact that we have you like just one time in the database. And I think I count the sample like your last publication and your only publication was before 2010. So that the years after are not just to include like the time length to get published in those journals and so on. Increasing the chance to capture this exit pattern, but it's true that this could be a really cool pattern a really cool outcome to look into at some point. Yeah, and I agree. As I said, next research really, I think this will be the topic: how to break this vicious cycle, how to bring women on the top, and so yeah. So yeah, thank you very much for those comments.
So I see that Sarah has a question. Before going to Sarah, let me ask you a question. So you've provided some very interesting data, some very interesting analysis, as we've seen already today during the other presentations, during the panel, the conference, and so on, people have admitted that realizing that there is a problem, realizing that there is a bias is already like taking us halfway, to the solution or to the solution. But so, I could not help myself, during the presentation to think about, okay, so what can we do to address this? And I think that in your particular case, there could be some kind of solutions in that, the same way that, for example, a journal can, is asking for people to submit data, to submit, their programs, they could also ask, here is a tool created by Marlene Coffey, to check whether you're in fact, including all the references of people that are included in your work. Or it could be done at the very beginning. So I don't know, for example, there are services where you can go and, when you're interested in a topic, you can sort of search the papers that are related to that topic. And so these are just like a couple of things that come to my mind. But so I just wanted to pose the question to you as well. So when you were writing this paper, I'm sure that, you thought about, okay, what can I do with it? What is it that the profession can do in order to, if not solve this problem, at least ameliorate this problem?
So yeah, thank you very much, Yana, for those points. So exactly that's what I was saying by raising awareness. Basically, the idea is that you know what is happening, you know how to end, especially like the part where I use the compensation of the omission to complete the citation, and you can see that the gap vanishes when we use the innovative and compared to the citation. Like we know that first we have to realize that there is a problem on this from this side. And the next step is we know basically that if we can correct in a certain way by computing such a matrix, computing the number of omissions that one can have, or computing any other metric that people we want to come up with to compensate at least this gap that we observe. So this is really the direction that I have in mind when I say awareness of all of those, the authors, the editors, and other people. And if I take the editor and the referee and so on, I guess now, to some extent, you have to pay attention really to what is going on, to what is happening in terms of the reference of who the author is cited, basically. This is one thing also. And after talking about the compensation, especially for the tenure, I was just looking at the paper by Sasson actually, and see like what is the influence of one citation on the probability to get tenure, because she controls on that. And actually it's like 5% increase in the probability to get tenure. So if we can compensate using those type of index for the women, I think that will be something really great. So yeah, I definitely agree, and that's what I point out with the awareness thing.
Sarah, please go ahead with your question.
Thank you. That was really interesting. I don't know if you covered this, and apologies if you did, but I was wondering how to think about co-authorship. If I'm a man, does that mean if I co-author with a woman, my citations are reduced, or are you just focusing on papers that are sort of solely authored by women? I wasn't sure whether it was the share of women and whether it sort of mattered whether it was sort of two women writing together, or one woman writing with a man, or one woman versus one man, and how should we think about co-authorship?
So basically, thank you, Sarah, for emphasizing this point. I haven't time to cover all of those during the presentation. So basically, the mixed gender team are kind of between the women and the men, basically, in terms of the omission. So if I have to rank them, like the omission probability of men is lower compared to the omission probability of mixed gender team, that is lower compared to the omission probability of all female team, basically, all female author. So there are really in between those two.
Thank you. I think that we have no more questions, so we can move on to the next presentation. And it's actually Sarah who's going to present the next paper on gender differences in economic opinions. Sarah, the floor is yours.
Thank you. So thank you very much for the opportunity to present this work at this conference. It's been a really fascinating event so far with lots of interesting discussions and ideas. This paper is fairly preliminary, so it's very nice to have the opportunity to present it. It's joint work with Hans Sivertsen, who's also at the University of Bristol. Can I have the next slide, please? So we're very aware that groups of senior economists are largely numerically dominated by men. So some statistics here on the share of professors, chief economists in banking and finance, and also economic advisory council members. There are lots of, there's lots of discussion about the consequences of the lack of diversity in economics. So it restricts the talent pool, it may narrow perspectives and leads to groupthink, it shapes the discipline because men and women differ in the sort of particular things they're interested in, and also in the substantive opinions that they hold. So women tend to be more favourable towards government intervention, for example. The specific contribution of this paper is looking at gender differences in how men and women express their opinions. So not the substantive opinions that they hold, but in how those opinions are expressed. So the conclusion is that economics is dominated by opinionated men. So not only is economics dominated by men, but male economists tend to be more opinionated than female economists. So the paper really establishes a sort of fairly simple stylized fact and then discusses some of the implications. Next slide, please. So we're not the first to look at gender differences in expressing opinions. There have been experimental studies which have looked at sort of general population samples or student samples and found that women are less likely to express their opinion than men. So what we're doing is looking at whether this difference is present in a real world relevant sample. I think it's important because obviously what may be true of the population may not hold among a group of very self-selected people. Economists and the type of economists we're looking at who are really economists who are at the very top of their field are not like the general population. And so looking at whether gender differences are present among this group of very selected people, I think is important for thinking about whether differences in opinions might be relevant for sort of real world decision making. So I think what's really striking about what we find is that there are clear gender differences among a group of academic and real world economic experts who have also explicitly agreed to be on a panel in which they're going to be asked their opinions, and yet we still find these gender differences among a group of people, between men and women. So we're not really able to say anything about why these gender differences are present. In the literature, a number of factors have been highlighted. So there's, for example, gender differences in self-confidence, which may either be a different estimation by men and women of their ability or knowledge, or different levels of precision about beliefs. So I might not want to express my opinion because I might have a high level of uncertainty about the state of the world. There may also be gender differences in social confidence. So these are opinions which are expressed publicly, and men and women may differ in their confidence in expressing opinions publicly, and or they may anticipate different reactions in terms of expressing their opinions publicly. So we're not going to say anything about why the gender differences are present. We're simply looking to see whether there are gender differences and then thinking about what that means. Next slide, please. So I will talk about the data which come from the IGM Expert Economist Panel and present the results. And then we've got some even more preliminary results from the Bank of England Monetary Policy Committee, because we're interested in seeing whether these gender differences of opinions are relevant for real-world economic decision-making. And then I think, again, some reflection on implications at the end. Next slide, please. So the main data that we look at comes from the IGM Expert Economist Panel. That's the so it's run from the University of Chicago Booth School of Management. So it was established in 2011 with the aim of exploring the views of initially US-based economists on a wide range of different topics. There were initially around 50 US economists, and then a European panel was set up several years later. So not that you're expected to take in all the names, but I've listed who is in our sample in detail on the right, with the women highlighted in blue. So approximately 21% of the sample is women. So that's sort of in line with, I guess, what we'd expect, maybe slightly higher than the share of women who are professors in the US and the UK. They're a very homogeneous group. So roughly 70% have a PhD from the same 5 institutions. And you can see around half of them are currently based at around 5 institutions. So again, what is surprising is that we have gender differences among a group of people who are really quite homogeneous, both in their training and also in their sort of current institution. And there aren't gender differences in, so the women are just as likely to be from this narrow group of institutions as the men are. So the sample, the panel are asked approximately 2 questions each month. On a whole range of different issues, so ranging from beliefs about the impacts of COVID, beliefs about Brexit, beliefs about minimum wage, sort of beliefs about the way markets work, a hugely diverse set of topics. The nice thing about the data is it's quite a large sample with sort of 100 experts and multiple questions. We have about 18,000 responses. I guess there's a question about to what extent are these opinions meaningful for real-world decision-making? They are just opinions. Some of the members here hold policy positions. The responses are published as shared with the public and receive some media attention. They're not influencing real-world decision-making directly. So hence one of the reasons we're sort of interested in the Bank of England sort of as a separate panel to see whether these gender differences in opinion are kind of reflected in real world decision making as well as just sort of opinion giving. Next slide, please. So this is the way the questions are asked and the data are presented. So this is a question about vaccinations. So would mandatory vaccinations and a regular testing, would that promote a faster and stronger economic recovery? So the experts are asked to say whether they agree or disagree with the statement. There's a 5-point Likert scale. Do they strongly agree, uncertain, disagree, or strongly disagree? They don't respond to every question, and that's actually one of the dimensions we're going to look at. And then the experts are also asked to say how confident they are in their opinion. So they can say how confident they are on a scale from 1 to 10. The IGM weights the responses by the expert's confidence when it publishes the results. The experts can also leave a comment, and we'll also look at the extent to which men and women comment. So these are the data. And if you show the next slide, we use these sort of survey responses to construct different measures of how people express their opinions. So we've kind of grouped them into different categories. So we've got 2 measures which we call sort of volubility, which is how much men and women express opinions. So we take kind of whether someone actually responds to the survey as a measure of whether someone gives an opinion. So you can see, just over 80% of experts respond. There's sort of no opinion is on average around 17.5%. We also take a second measure of volubility, which is whether the respondent leaves a comment. Then we have a extent to which experts are sort of express strong opinions, express opinions with certainty, and express opinions with confidence. So we have a measure of whether the respondent is uncertain, whether the respondent strongly agrees or disagrees, and also how confident the respondent is. And then we also look at the extent to which respondents go against the consensus. So there's an earlier study that looked at sort of consensus in economics, and so we thought this was also interesting. Right. So these are the outcome measures that we're going to look at and see whether there are differences between men and women in their volubility, in their certainty, and their confidence. Next slide, please. We also look at whether this varies by whether the question is falls within the economist field or not. So we classified all the questions according to a set of fields, and we also classified the academics or the economists according to their field based on their NBR, CPR affiliations. So in the psychology literature, there's a phenomenon called male answer syndrome, which is basically that men have opinions about things they know nothing about. So we're interested to see whether is it the case that men just sound off about things where they're not expert, and actually when it comes to giving opinions in your own field, men and women behave the same. If that were the case, then in a sense these differences would be less important for real world policy making, because of, typically economists are asked to give opinions on things that fall within their field. So, if we see these gender differences when questions are in field, then this is sort of more significant for real world policy making than if it's just men sort of engaging in this male answer syndrome. So you can see just over 1/3 of questions are in a field. There's actually no significant difference in the average number of fields. So it's not the case that men are sort of expert in more fields than women are. There are gender differences in how female different fields are, as you'd expect. So labour is the most female field, macro tends to be the least female field. And we'll come back to sort of what some of the implication for the gender difference in opinions might be across fields later. Next slide, please. We also, possibly more controversially, sort of try and categorise the questions. So some of the questions we think of as being positive questions, by which we mean they're sort of empirically verifiable, and there's relevant evidence. So, for example, a question about the impact of the minimum wage is a question where there is a body of evidence that someone might draw on in giving an answer. Several of the questions are normative. So, they're asking not only about the economic effects, but whether a policy option is a good idea, which in a sense has a sort of implicit value judgment and a trade-off. So, we wondered whether it was the case that, men were more willing to make the trade-offs and women weren't. And then finally, some of the questions are about core elements of theory. So there's a statement about whether investors can sort of outperform the market, which sort of seems to be a question about a very core theory element within economics. So these categorizations are meaningful to the extent that there's sort of the lowest level of certainty in normative questions and the highest level of certainty in theory questions. And we also look at whether the gender differences hold within these different question types. Again, I guess we're thinking of economists being asked possibly more positive questions rather than normative questions, probably not giving expert opinions on elements of theory. So I think it's, again, useful to sort of think about whether the gender differences we observe are meaningful for real world opinion giving and decision making. Next slide, please. So these are really our main results. So we have these 6 dimensions of opinions and significant gender differences across all of these different dimensions. So women are significantly less likely to give an opinion. In other words, they're significantly less likely to respond to the question. They're on the panel, they know they're going to get asked questions, but they're significantly less likely to respond. They're significantly more likely to say they're uncertain. They're significantly less likely to vote against the consensus. They're significantly less likely to give a strong opinion, to say that they strongly agree or disagree. They're significantly less likely to leave a comment. And they have significantly lower level of confidence in terms of their confidence in their answer. Next slide, please. One of the other things we explored is whether there's variation over time. So, I guess thinking about this idea of social confidence, we wondered whether, maybe women were more hesitant to start with, but gained confidence over time, or perhaps men were overconfident to start with and lost confidence over time. Actually, what you see is that these differences are remarkably sort of persistent, or at least there's no significant trends. So again, I think this means that these gender differences are meaningful for policy making to the extent that people don't tend to learn and update. This is a behavior which is relatively persistent over time. Next slide, please. And in terms of whether the differences are just on questions where people are non-expert or areas where people are expert, we find that there are significant gender differences both when women are asked questions, both when men and women are asked questions in fields in which they're expert and also in fields in which they're not expert. So there's probably too many bars in the figure, but basically we've got the gender differences, men in green, women in grey, the non-expert on the left and the expert on the right. So you could see, for example, that there's a sort of gender gap in confidence when women are expert and non-expert. There's a gender gap in giving an opinion when women are expert and when people are expert and non-expert. So as you'd expect, expertise does increase certainty, volubility and confidence, but women are still less certain, less voluble and less confident than men, even when they're answering questions that are in their field. And then looking at these different types of questions, we find that these gender differences are present both on positive and normative questions. They're slightly weaker when it comes to theory, but on positive and normative questions, which we see as the type of questions that economists might be asked for their opinions, we find these gender differences are present. So roughly women experts behave more like men who are non-experts in terms of their certainty, volubility and confidence. Next slide, please. So, I guess, women are less confident than men is not perhaps on the face of it so surprising, but I think what is striking is this is a group of people who have made it to the very top in the profession. Economists are not, we've heard about the hostile environment. These are people who are very successful in their fields. They're a self-selected group. They've agreed to be on a panel where they know they're going to be asked their opinions. So I think that, a key takeaway that, I think we really need to, even if we implicitly know that women are less confident, I think we need to be reminded that women's voices are even more underrepresented in economics than the headline figures suggest. So we hear a lot about the headline figures, that women are 15% of professors or 20% of central bankers. But, in terms of their opinions, that women's voices are going to be even less present than those headline figures suggest. So in terms of the expert economic panel, they're 21% of members, but only 14% of strong opinions, or 12% of comments. So you start from a minority, and in terms of comments and voices, women even less present. Any gender differences in expressing opinions are going to amplify substantive differences in opinions. So we knew before that men and women have different opinions. If men give those opinions more forcefully, and if people respond to them according to the forcefulness, then that's just going to amplify those gender differences in substantive opinions. And a recommendation to IGM is that they stop weighting by confidence and do not pay attention to the strength of opinions, because in doing so it gives more weight to the opinions of men. There may be a concern that economic opinions in more male fields are likely to express more confidently. So maybe macro opinions are expressed more confidently than labour opinions, so that would matter for policy. And something that I think we need to explore further with examples is, increasing the share of women is likely to imply greater uncertainty and caution in economic opinions. So next slide, please. So this is where we sort of started to look at the Monetary Policy Committee to see if what we see in the economic expert panel also can be found in, the opinions of, a group of economists who are directly involved in policy making. So the Monetary Policy Committee sets the interest rate for the Bank of England. There are 9 members at any one time, 5 internal, 4 external. There's been 43 members since 97 when the Bank of England became independent. 260 votes, so those are economic opinions, and around 20% made by women. So there is going to be, there's a high level of consensus among Bank of England Monetary Policy Committee members. But I think unlike, my understanding is unlike the Open Market Committee, there's slightly greater variation in the votes. So we have 47% of votes with some dissent. So in other words, there is some variation, and the votes are seen as the opinions of the members. So Monetary Policy Committee members are encouraged to vote according to their own beliefs and express their own opinions. So we're aware there's a literature on the sort of preferences of women on central banks. They tend to behave more hawkishly. So we were trying to think of how differences in confidence might manifest in voting behavior. Next slide, please. So our current indicators are sort of two measures of what we think of as cautiousness. One is voting for the status quo, and the other is voting against the consensus. So our preliminary findings, which we think parallel the opinions expressed by the expert panel members, which show women are more cautious and less confident. Women on the Monetary Policy Committee are more likely to vote with the status quo and less likely to vote against the consensus. So this we see as being sort of tentative evidence that the differences in opinions that we see expressed by the IGM panel are also affecting behaviour in a real-world policy-making situation. Next slide, please. So just to sum up, and I think this is preliminary. I think the results are striking, and I think it's important to make this point. So I'll make it again. So gender differences in opinions, the way opinions are expressed, means that women's voices are even more underrepresented than the headline figures. I think we should think about, what this means. It's easy to think that the conclusion of this is that women should assert themselves more. That's not what we're saying. It could well be that it's men who are overconfident and expressing their opinions too strongly. I think an important area to investigate further is, in a sense, who is listened to. So our prior is that people are listened to according to how strongly they express their opinions and how confidently they express their opinions. Of course, if people know that men are going to express opinions strongly and confidently, it may be that male voices are less influential relative to females expressed in the same way, but we don't have any evidence for that. So in the absence of evidence to show that men are listened to less when they express opinions confidently, the concern is that male voices expressed confidently and strong opinions are going to be heard more than women's. The key question is sort of who is right. I mean, sometimes these are just opinions. There isn't a right or a wrong. There is just an opinion. But so men will be more influential in policy making. I think if we think that if a strength of opinion and confidence in opinion is what carries weight. And I think there is an issue. Possibly that men are too confident and too forceful in their opinions. So the evidence from other studies which have looked at male confidence and male opinions tends to suggest that it's the men who are overconfident, not the women who are underconfident. So relative to their actual performance, men tend to rate their ability too highly, for example, or male traders tend to have too much, they believe too much in the precision of their own beliefs, and they tend to trade too much. So evidence from other areas suggests that it's the men who are overconfident rather than women that are underconfident. So I like the quote from Danny Roderick saying it's okay to say that you don't know, and maybe economists don't say we don't know enough, or at least male economists don't say they don't know enough. I think there are some, implications for economic debate and decision-making, the nature of economic debate and decision-making. And I think there are also implications for the discipline itself. So I very much like this quote. Confidence is perhaps the greatest achievement of the economics profession. Economists' willingness to express opinions about complex matters confidently means that economists are influential, possibly. But obviously, it's likely to be a characteristic which has also given rise to criticism of economics. It's also, while it's our greatest achievement, it also may be its Achilles heel. And it may be a function of a very male-dominated profession, and a more diverse profession might express itself very differently, more cautiously, and perhaps with differences in the way it's perceived by other disciplines in the outside world. Thank you.
Thank you, Sarah. We'll go straight to Amanda's discussion.
Hi, everyone. So thank you for having me and giving me this opportunity to comment on a really great paper. Next slide. So as you heard, this paper explores gender differences in expressed opinions using 2 different samples of economic experts and finds significant gender differences that do not attenuate over time. Next slide. So I think this is a fabulous paper. It provides direct evidence on gender differences in economics and central banking in a way that we just didn't have access to 3 years ago when we started this conference series at the Bank of England. It presents a really rich analysis, as I'm sure you understood from Sarah's presentation, considering multiple measures of expression and the role of experience. It uses data on 2 different groups of economic experts, including one making policy decisions. It offers an extremely thoughtful discussion of causes and effects throughout the paper, something I really appreciate and that doesn't happen all the time within our field. And it has really important implications, as Sarah told us. Next slide, please. So we've been asked to comment not only on the technical aspects of the analyses, but also to connect to broader issues of diversity, inclusion, and equity in the profession and society. So I'll do that in my comments. Next slide, please. Thanks. But I want to start with 2 smaller technical issues. The first is the question, might controlling for citations and the regressions cause collider bias? And this is always an important question to ask, but especially when investigating disparities, in my opinion, and especially given the evidence that we saw in the first paper in this session, that there's a connection between gender and citations. The second technical or smaller issue is I would love for the authors to deal head on with the distinction between opinions and reports of those opinions in the paper, because we know the data can only tell us the reported opinions. And for instance, as Blinder notes, there may be reasons that the committee members would, for instance, go along in a stated way with the consensus, even though behind closed doors, the discussion could have been different. Next slide, please. So, first lesson for all of us, differences are not deficiencies. So within economic research and broader society, there's a bit of finger pointing, it seems, and possible bias in explaining gender differences. For instance, within economics, we've seen trends in research that women can't do math, women don't like money, women don't like risk, women don't negotiate, women don't say no, women don't lean in, women don't speak up. And those are important things to investigate, but they're framed in a certain way. And actually, over time, each of those attributes has been in some ways disproven or kind of shown to be inferior to other explanations. Next slide. So here's just one possible rephrasing of the empirical results in the paper. We could say men talk a lot, make conclusions more readily, stake out a position even when most other experts see the evidence differently and think they are right. And to me, that also accurately characterizes the empirical evidence. Next slide, please. So we see that, it's really important to examine our implicit assumptions as we state and hear the results of economic research. And there could be a problem in how we phrase things or interpret results, or even how we set up our models. And as Bill Spriggs very importantly noted, in the overwhelming case of economic analysis, a model of racial differences assumes there is something deficient about Black people. And so there's a way in which we as economists hold a responsibility to think carefully about how we're setting things up and presenting them. Next slide, please. So as Sarah and her paper says, it's okay to say, I don't know sometimes. The world is complicated. You know, uncertain may exactly be the appropriate response. And a little analysis I did just to shed more light on the situation was I downloaded some of Chicago Booth's IGM data, only for the US panel and for questions in 2021. But I found that economists of both genders are more likely to comment when they record their position as uncertain. So that indicates that there's something more to explain about the situation. They see some complication that demands both perhaps an uncertain response and a comment. And so we just want to make sure that, that we don't state certainty when we don't have certainty, as Sarah concluded her presentation. And, you know, there's this last point. Monetary policy makers, or policymakers in general, might feel that it's best to communicate clearly and with a single voice and with a straight path forward, even if they understand the complications. And, you know, that's the same story or argument I hear from instructors of undergraduate economics, that reality is too complicated to explain to the students, so we better tell them a simple story. But in doing that, we tell them an inaccurate story. And to my mind, at least in the education, economics education realm, it's led to significant efficiency and equity problems. So, of course, there are communication issues that policymakers have to consider, but it would be good to reconsider the conclusions. Lesson 3, next slide. So, of course, we all need to listen carefully. And in the context of this paper, I went down and looked at the text of the comments that the experts offered through the IGM survey. And I think it would be fun for the authors to do some text analysis of those comments. And here I have shown you a non-random sample of comments, but let me just say all of them are really thoughtful, and well, not all of them, many of them, men and women, are really thoughtful about what they say and how they respond. But we do see some comments that point to definitions or details or how the response would depend on conditions. And so looking for those keywords in a text analysis, or perhaps looking for some sentiment analysis about whether comments are sincere or sassy, or nuanced, or full of dogma, or positive, or negative. I think it would be pretty fun to see if there are any gender differences in those. But what I fear is that sound bites are amplified by, actors outside the economists themselves. So in the media, perhaps in the general public, perhaps by economics instructors. And if that's true, then the voice problem, the underrepresentation problem that Sarah really insightfully identifies, that, women's voice is even less represented than headline figures suggest, would be even more of an issue if their comments, their insights aren't repeated by others. And indeed, if the comments and the insights are more nuanced or longer-winded, it may be for good reason, but they're not necessarily going to be heard. Next slide, please. Lesson 4, build inclusion. So there are structures we can put in place in our organizations to make sure that all members are heard. So individuals with different propensities and types of expression can all contribute. And one example is that the Federal Reserve research divisions have created and disseminated inclusive meeting guidelines to make sure that all of our small meetings are done in a way that every member can contribute. Another example is the issue of optimal monetary policy committee design. And I know that this has been examined in the literature, but not the inclusion aspect of it. So how does the structure of the conversation through voting protocols and numbers of meetings, the agendas of meetings, and procedures within those meetings affect the inclusiveness of the environment and the ability of all participants to speak and contribute? So that could be not only a research question moving forward, but of course, one that the monetary policy committees take head on in examining whether there are procedures they could add to their current structure that would generate even more inclusion. Next slide, please. The fifth and final lesson I'll share, be an effective bystander. So what I did is I went to the same smaller sample that I pulled of IGM data, the economic experts data, and I looked at the distributions. And what I find is that a minority of respondents, all of whom are men, produce the bulk of the comments. And so 5 individuals out of 43 for this sample are responsible for 30% of the comments. 10 individuals are responsible for half of the comments. Yet the median man comments just as frequently or infrequently as the median woman. So what we see is that, I'd say the vast majority, to build an analogy to the broader profession, are really well-meaning, well-behaved, right, and concerned potentially about all voices being heard. But all of us individually have the ability and responsibility to kind of help make conversation more productive. And so, within a spoken meeting, there are opportunities for individuals to tell other individuals, okay, all right, we've heard you, let's hear from this other person. And as far as policy structures that could remove the outlier number of comments, you could do what we do in classrooms all the time, that if there's a student who's speaking up very often, we could ration their airtime. Next slide, please. So in conclusion, I'll just say this is a great paper that's going to teach us a lot, not only about the situations at hand, but some broader lessons. So thank you.
Thank you, Amanda. So before we go to questions, and I encourage people to raise their hands, Sarah, do you want to answer to Amanda's discussion?
No, I just want to say thank you so much for engaging so thoughtfully with the draft paper and providing really useful comments for both presenting the work so far and I think other things to look at. I was very careful at the end to say, I don't think that this implies that women should speak up, but I agree that the language throughout is presented as if it's, men are the benchmark and women sort of are judged relative to that benchmark. So I think it's a very fair point. We've thought about doing text analysis of the comments. I like your suggestions for how we should approach that. And then, so other comments I will incorporate into the analysis. So just thank you very much for a very, very insightful discussion.
So I think that Julia went first, and then we'll go to Marlene.
Yeah, thanks so much. Really great paper. Particularly given how often economists are actually wrong. So maybe, a more humble approach by men, given your findings, might not be a bad thing. I found your analysis of the MPC really interesting, and maybe one quick observation or one and a comment. So in terms of comment, I think that there are sort of two types of minority votes. So one could be a vote for change, but a minority vote, or you could vote for the status quo when the majority votes for change. And I'd be interested if there's a difference between men and women here. And then the other is sort of a bit provocative. I mean, if conclusion is that women tend to vote with a consensus, there's also a lot of discussion around groupthink in central banks and on committees in particular, and wanting to avoid that. So is there a danger with having more women on committees that we might end up with more groupthink? Thanks.
Do I? No, I think. I mean, to be honest, so I think the sort of monetary policy voting is not necessarily. It's not our area of expertise, and I think these are very preliminary measures. I think we could do more, and I think also possibly examining how votes are relative to, say, market expectations. So what we wanted to capture is that women have greater uncertainty about their beliefs, I think. And so men are sort of, believing things much more confidently than women. I think we haven't necessarily reflected that fully in the measures that we've got, and can explore the sort of different possibilities more fully. So, yeah. Yeah, I mean, and again, this groupthink. I mean, it really depends on what's right and what's wrong. I mean, I don't know, so is it, sometimes you want caution and sometimes you don't, I guess, so we'll need to think about whether caution is socially optimal. I think globally it is. I think economics would benefit from greater caution personally, but not necessarily every decision would be better off if it were a cautious one.
Marlene, please go ahead.
Yeah, thank you very much, Sarah, for the great paper. I have just two quick questions. I was wondering to which extent some research regarding some outcome like no comment or no response and so on could be just due to the fact that maybe women do not think it's important, it's relevant, so, or they have other stuff to do. I don't know, family commitment. I mean, those have been proven. That we have a difference in the between men and women in the literature regarding those outcomes. But to which extent it's not just a difference in terms of how we express our opinion, but just that, okay, you don't find it like really important, so you don't spend that much time on this and so on. And the second point is there a way to regarding the question of which answer is the right answer? Is it being just inserted in the right path, or having a strong view of right path? Like, if you can see, especially for the central bank committee, if what happened if comparing to the decision that or the vote that have been done and compared to what happened after. I understand that you may lack some counterfactual to make a proper analysis, but still it could be insightful to see like just what happened after, if it was the right path or the wrong path. Thank you.
Yeah, I mean, just with regard to your first thing, I mean, so do women think it's important or not? I mean, I think this is a group of people who've agreed to be part of a panel where they're going to be asked for their opinions. And I think we also see this gender difference when it comes to the field in which they're expert. So, if it was just women give opinions only when it's in their field and men give opinions all the time, I think that would sort of speak to the importance issue. But, I think the fact that it's a very self-selected group of people who've agreed to give their opinions, so they obviously regard this as an important activity because they've agreed to sign up. And also when it comes to their sort of specific fields of interest, you also see this gender difference. I think that's suggesting that it's important. And that's also why why we wanted also to look at a real world situation as well, so that the consistency is sort of illustrating it is a meaningful difference. And yeah, no, I agree that it matters not only that these differences are present, but also, you know, what does it mean for society, which is sort of your question about, you know, who's right, who's wrong, and we will do some more thinking about how we would measure that.
So next we have Neil and then Lisa. And in the meantime, can I also remind everyone who have already asked questions to put their hands down? Thank you.
Yes, Neil, Neil Erickson at the board. Can you hear me, Chiara? Yes, good. So my comment really builds on one of Amanda's slides about listening carefully, and in terms of possible additional and sort of complementary interpretation, namely that there may be gender differences when communicating the same message. And this may also apply in terms of racial differences or ethnic differences. And so Sarah's mention about the importance of adjusting those voices and the recommendation not having IGM do weighting seems to be really important. And this is something that also, you know, could very well comes up in other disciplines where there are experts expressing confidence. And one that obviously comes to mind is with doctors, not only in serving as an expert opinion, but also in terms of design of all sorts of medical experiments. And the well-known situation is, of course, in drug testing, which typically was done on young, white, healthy males, which is not representative of the general population. Then just actually a question or thought for Marlene. There actually may be larger biases than the 2020 that you were picking up due to sample selection with working with the top 20 journals. And that could happen either directly because of sample selection bias by editors at the journals, but also implicit bias by what sort of research topics are chosen by men versus by women. And it's something like a Heckman type bias for sample selection. And it is something that might be correctable in principle and maybe in fact.
Yeah, just say thank you. I think the doctor's example is a really very relevant one. I haven't looked to see whether anyone has studied the confidence of doctors, but I agree that that might well be comparable to the case of economic experts.
Lisa, do you want to go ahead? Kim, can you?
Having a little trouble moving her up to a panelist, but I'm going to go ahead and unmute you, Lisa, if you want to go ahead and ask your question verbally.
Okay, can everyone hear me? Okay, great. Yeah, I don't know what was going on there. So I was thinking sort of about this issue of overconfidence that you mentioned kind of at the end of the presentation. So one thing this brought to mind is that there's this, I think, somewhat well-known relationship that if you ask someone to self-report their own knowledge of financial matters, and then you also have them take like an objective financial literacy test, you'll find some sort of odd patterns in the tails. And so you'll see there's sort of generally a positive correlation in that folks are somewhat more confident and when their literacy is higher, but that the people who report the very highest level of confidence tend to actually perform worse on the financial literacy exam than people that are a little bit less confident. And so I wondered if you had sort of done anything looking at like kind of the tails here and sort of seen if there were gender differences in being extremely confident, and then maybe especially being extremely confident in a field that's not your own, and whether, you know, that might give you just maybe a little bit more insight into how much of your sample might be sort of expressing overconfidence, and whether there's sort of gender differences on that margin.
Yeah, thank you. Well, we'll look more because we've just looked at the means, but we can look more at the distribution.
So thank you. I think that this brings us to the end of this session. So let me conclude by thanking all the presenters, all the discussants for the great conversation. We will take a short break and we will be back with session 3 on the effect of policies on wage gaps in about 10 minutes. Thank you.
Everyone.
Welcome everybody. Welcome to session number 3 on the effect of policies on wage gap. We have only a presenter in this session. This is Almudena Sevilla from the UCL, and she's going to present a paper entitled Pay Transparency Initiative and Gender Pay Gap, and show us an evidence for the UK universities. As with the previous papers, Almudena will have 20 minutes for the presentation. That will be followed by a 10-minute discussion by Trevor Logan from Ohio State University, and then 10 more minutes for general discussion. Almudena, the floor is yours.
Thank you very much, Anna, and thank you very much to the organizers for having me here today presenting this paper. It's been a really interesting conference, and it's almost 9 p.m. here in London, so I hope I can still concentrate. Anyway, so this paper is joint work with a former PhD student who's now working in policy at the government in the UK, Danulla Gamage, and 2 colleagues from Queen Mary University, where I used to work, Shushanta Malik and George Cavestus. Okay, next slide, sorry, I forgot about that. So just to give you a brief overview, so what we do in this paper, we examine the impact of a pay transparency initiative on the gender pay gap in research-intensive universities in the UK. We show that this kind of information shock as a result of this pay transparency initiative significantly reduced the gender pay gap in UK research-intensive universities, and we explore the potential channels. We explore 2 channels, whether it is a bargaining effect, so women bargaining for higher salaries and promotion, or whether it is a reputational effect, whereby universities fear this reputation being, after the information shock being released, whether universities react to avoid reputational damage. Next slide, please. Next slide. Okay. So just to give you a little bit of background for this paper, there's been quite a lot of progress in general in the economy in terms of female labor force participation and educational attainment, but the gender gap remains persistent. So depending what you, whether you control for characteristics or not, it ranges between 20%, 5%, depending on the industry, etc. In the higher education sector, in particular in the UK, is not different from the economy. We have some work with Sarah Smith, who was one of the previous presenters, using this same data, where we uncover pay gaps among professors of around 5%, 10% in some instances. So next slide, please. Okay, so in previous conferences, we've discussed some of the policies that, particularly in academia, seem to have had some success. The mentoring programs by the AA CSWEP team has proven to be quite successful. Positive action programs in the UK, the Athena Swan program, I will be talking a little bit more about that. This is something that we also analyzed in a paper with Danulla. In the US as well, the gender neutral clock stopping policies, and several others. So here, please next slide. Here we're going to focus on a fairly recent, or at least in terms of policies, fairly recent initiative that is gaining popularity, and this is the pay transparency policies and regulations. So governments have been introducing pay transparency in the last 5 years at great speed. The UK passed a law in 2017, Danish government, Austrian pay transparency law. Since we started with this paper, Spain has also passed a law, and Italy, different countries with different conditions on the different laws. But they're all aiming to uncover the gender gaps in the economy in a more transparent way. So why pay transparency? What is the rationale? So this is data from the Fawcett Society, which is a non-government organization in the UK, whereby in a survey they did in 2018, they found out that about 53% of women and 47% of men at work are reluctant to share information about how much they earn with other colleagues. And 31% believe that their contracts prohibit them from talking about their pay. Okay, so transparency is an issue. Next slide, please. So from an economics perspective, from an economic theory perspective, it doesn't take long to realize that in whatever model of discrimination we may think of, either a Vicarian preference model or a statistical discrimination model, the lack of information, and in particular asymmetric information about pay, can make discrimination discrimination wouldn't go away, even because you basically break down the assumption of perfect markets, right? Perfect competitive markets. So when you make that information available to participants in the market, there may be two main effects that are at play. One is a reputation effect. So firms may experience a reputation cost, and therefore they may act upon that, or a bargaining effect on the side of the employees, whereby knowing women in particular, knowing the wages, the real wages, will ask for either promotion or a pay rise. Next slide, please. So we contribute to the literature that studies this type of pay transparency initiatives. So the previous literature looks at issues of well-being that could be linked to productivity, and a relatively recent literature starts looking at wages, and in particular the wage gender gap, and results are mixed. And I'll comment what we find in light of the literature later on. Can we move a little bit down in the transparencies? So here we're going to assess the causal role of the information asymmetries in this market, exploiting this initiative that published all the salaries of professors or academics in UK universities. We're going to use this quasi-experimental method, and we have administrative data on all the academics in the UK, and in particular in these research-intensive universities. So that gives our results high external validity. And we also have panel data, so we follow individuals over their work years. For the years that we observe them. So that is going to allow us to say something about the mechanisms that are at play. Please, next slide. If you move down until we pass on this table, because I'm not going to talk about this table. This is just to give you an idea of the sort of papers that are out there in the literature. But if you can move down to the next slides. Next, please. Next. All right. So, what's the institutional framework in the UK? So the policy that we're going, or the intervention we're going to exploit, is what happened in 2007. The Time Higher Education, it's a magazine, started to report pay in the UK. For academics. So it includes the nominal pay of male and female full-time academics by university, and it was easily accessible through the Times Higher website. And since it's been published in this data since 2007 onwards. So that is the sort of intervention that we're going to use. And just to give you an idea of what the university setting in the UK is, we're going to focus on Russell Group universities. So it's not identical, but you may want to think of the Ivy Leagues of the UK. So in total, it's 24 universities. And they concentrate most of the research funding or research income across all the UK universities. And they also have high autonomy from the government over how they structure their budget and pay. So these are universities that operate in an international market, labor market. And there's also an interesting feature that will come handy for us when trying to assess what are the mechanisms behind our findings, which is that the pay structure in the UK is different for professors and non-professors. So non-professorial pay obeys a scaling system which is very rigid, whereas the professorial pay is individually negotiated within between the employer and the employee. Non-professorial pay is negotiated by the unions directly with the university, and these scales are set so there is little flexibility for employers to actually raise wages beyond a particular scale for that employee without going through the process of promotion, etc. Okay, next slide, please. So this is just an idea of an example of what the publication was. So you can see the universities in the first column, and then for the different professorial staff, women, men, at the different rankings. Okay, can we move down, please? Okay, so the data that we're going to use is the UK Higher Education Statistical Agency data, which collects information directly from the university. So universities need to report to HESA on certain characteristics of their labor force at the individual level. So we have information about individual wages, their level of education, gender, etc., ethnicity as well. And we're going to select a sample of research-intensive universities or academics working in research-intensive universities that are employed full-time and in permanent contracts. So these are the standard academic career contracts engaged in teaching and research during the years. So we have this data for 2004 until 2016. These data started to be collected by HESA in 2004, and it's continued until now. So it continues to be collected. So we have quite a few 24 universities, academics in 24 universities, and quite a few observations. So remember, we observed the same individual over time. Even if they change universities, we continue to observe them. Only if they leave the academic sector altogether, we stop to observe these individuals. Next slide, please. So these are just some summary statistics where we can see already some gender gaps emerging. So the first row is quite interesting, I think, because it's fairly rare to have representative data of this sort in wages. So these are the real wage of academics. So the mean annual salary for female academics is about 55, and for male academics it is about 62. So there's already quite a gap in terms of pay between men and women in academia at these top universities. Next slide, please. Yeah, so this is what I had already mentioned. So for the sake of time, let's move on to the next slide. And so this is how the gender pay gap has evolved over this period. So the left-hand side is just the raw data. In the right-hand side, we control for some individual characteristics. And what we see is a striking. So the red line represents the 2007. This is when the Times Higher started to publish these salaries. And we see a drop in the gender pay gap. So we're going to move to next, please, to the regression analysis. Next, please. So here we're going to exploit the temporal variation in pay publication and use diff methodology where we use men as the control group. Because we have individual over time, we're able to control for as well individual fixed level characteristics. So if we move to the main results table, that would be great. So next slide, please. And next slide. Okay, thank you. So we basically present the different models when we control for university fixed effects and time fixed effects, and time and university fixed effects interacted. So basically the columns 4 and 5 are preferred specifications controlling for everything that we can control for. And what we see is that the pay transparency dummy is not significant. So it means that men didn't react to this intervention. However, the pay transparency interacted with the female dummy is positive and significant. So it means that that pay transparency had an effect on the wage gap, and it had an effect through women's wages becoming closer to men's. So the dependent variable is the low wage. So if we go to the next slide, please. So in terms of magnitudes, what we find is that following the pay reporting, the log of the female annual earnings increased on average by 0.62 percentage points. That's about 323 pounds relative to men. And based on an average pre-intervention earnings levels of men and women, these increase translates in a reduction of 4.38% in the gender pay gap. Next, please. Okay, so this is just some robustness check. If we can move down to, next slide, please. So just to give you a brief overview, I'm conscious of time, in terms of how our estimates compare to the literature. There are now 2 papers that analyze, using different methodologies in different periods, that analyze the most recent 2017 regulation, pay transparency regulation in the UK. And they find that the gender gap decreases in the economy overall by 2.8 percentage points. So our estimates are lower for the university sector. And although they are, our estimates are a little bit higher for professors, I'll show in a minute. so it seems that the university sector may be more regulated. Pre-transparency doesn't have such a big effect. So that's the main takeaway from this slide. If we can move down to the next. We also check whether other policies going on at the same time may have confounded our effects. One of the policies is this Positive Action Accreditation Program, the Athena-SWAN program. However, non-STEM disciplines or departments couldn't apply were not eligible for this accreditation program. And so when we run our main models on non-STEM departments, we get the same results. So that gives us confidence that we're really capturing the pay transparency initiative here. Next slide, please. I'm going to skip this. We'll just do the usual event study to rule out pre-trends, but I want to move to the mechanisms, if we can move down a little bit. So we test for the reputational effects by looking at whether universities with a higher pay gap at the beginning were the ones that reduced their pay gaps more when this information intervention came into place. And I don't think I have time to discuss the results, but we don't seem to find.
You have 2 minutes, Almudena.
Yeah. So, thank you. We don't seem to find that this is the case. So, if we can move down to the next slide, please. And so this is the results. I'm not going to comment on that, but we can come back to those in the discussion. So the other mechanism that we explore is whether there is some bargaining effect. So we look at the panel dimension in the data, among other things, and we see whether women are more likely to leave the university or the higher education sector or not, and whether that is sign that they are actually getting promoted within their universities. Okay. And we also check whether the effect of the pay transparency regulation was different for professors and non-professors. So professors had more ability to bargain. Okay, so just cutting the story short, we do find that female professors reacted more, so they got higher pay increases after 2007, and we don't seem to find that these women are leaving their universities. So it seems to be a bargaining effect within a particular university. So if we can move down to the conclusions, and I'll conclude. I don't have time to talk a little bit. So overall, the intervention led to a fall in the gender pay gap at UK universities. The main channels seem to be driven through bargaining effect of these women within a particular university, and not getting outside offers. And we can interpret these coefficients as a lower bound. We don't know to what extent. There is some evidence in the literature that even when information on wages and salaries are published, it's not always the case that individuals access that information. So if that is the case in our sample, then this is a lower bound of the true effects. Thank you very much. I'll stop here.
Okay. Thank you, Almudena. Trevor, now you have 10 minutes. Thank you.
Thank you, and thank you for inviting me to discuss this paper. I'm going to address this in 3 different ways. First, as an economist, and second, as an academic administrator, and then third, thinking more broadly about what this tells us about gender dynamics. And so first, as an economist, I'm thinking the specification using the sort of sharp treatment of the 2017 announcement, thinking about you wanting a placebo group to do this. And so the current structure of the paper, men are the placebo group because their wages are not affected. But as you're mentioning earlier, I wish there was more information on those who were in collective bargaining agreements that would not have been affected by sort of publishing their wages if those wages were published. So you think about those for whom essentially they have wage transparency by the nature of collective bargaining. So publishing their wages doesn't do anything for someone who's in a collective bargaining group because they've already observed what the wages are. They can go to the collective bargaining agreement and literally see what the wages are going to be. And so publishing those publicly doesn't have any effect, as opposed to these individually bargained contracts would be. So I'm thinking that having that as a control group could be particularly important. I'm wondering too, because one of the great things that you do in the paper that you show in the appendix is the additional or supplementary occupations or compensation that faculty receive, which occurs here, could be another driver of gender gaps or could be maldistributed. And that in and of itself could have changed in addition to your primary specification. So thinking not only about the main jobs that academics are doing, but do we see differential access to these additional work assignments that are compensated, as opposed to this much larger discussion that we've had in the academy about uncompensated labor that is disproportionately performed by women. So you might see women moving into different roles or having the additional roles as a function of the transparency to say, why is he receiving, so many pounds a year and I'm doing sort of something similar? And that might be a really interesting effect. I think, secondly, going to the welfare effects, recently, Syracuse University had addressed its equity issues in terms of gender disparities in compensation. And then they were subjected to a class action lawsuit that they recently settled, which will also now pay for, addressing equity issues is forward-looking, and yet you've underpaid people for several years. And so you need to address that's the welfare calculation of how has these people been collectively underpaid for a period of time. The same thing has occurred in the bargaining or the gentleman's agreement between Duke University and the University of North Carolina, Chapel Hill to not compete for each other's faculty has now also been settled in litigation. And so thinking about that as a framework for larger scale welfare calculations of how much is lost in terms of wages aggregate due to this sort of disparate treatment by gender will be particularly important. I think one of the things that I was interested in when you have this in cost centers is that you mentioned that you have an underestimate. And I'm thinking about pre-treatments that could underestimate the effects that you might want to control for if you possibly could. So in some work that my colleague Bruce Weinberg here is doing in the United States context, he finds that the implementation or the start of a female dean's tenure results in a closure of the gender gap. And so if we knew something about administrative tenure, that also itself might be related to the gender presence in fields and gender gaps in fields, that might also have been something that would actually anticipate some of these effects. And so he has great work on that. But that can be related to the share of women in a particular discipline, who then would comprise the range of academic leaders. But thinking about how that might set priorities for academic administration would be incredibly important. And I think there's something that could be said about misallocation of talent here if we're thinking about the changes. If people are relatively undercompensated, I know the results here don't speak about women leaving their current positions subject to the publication of the results, but if we could still think about applications of occupational duties within a particular job that could still be misallocated because of differences in pay. Another question I had was about, which is a bit more detailed, is that it appears that in the paper you talk about universities knowing that the announcement is coming, but not knowing that the data would be published. And so were there ever any anticipation effects, or were they shocked by the publication, but they knew that the policy would be instituted? And was that the reason for their inactivity in terms of trying to address some of these gaps? And then I think there's another issue about the returns to tenure differing by gender. And that's another way of framing these results, particularly because it is the women who are in the full professor ranks who appear to be undercompensated. And those women have been, by definition, have been in the profession much longer. And so there are differences in the return to seniority by gender that I think are particularly important. I wanted the historian in me wanted more institutional detail about the weight setting process. I know it's individually determined and bargained, But in the American context, you're not really bargaining with your, say, your chair or your dean. You're really bargaining with the provost or some other higher level administrator in the end who controls the resources at the institution. And so I know that these institutions have a lot of fiscal independence, but it was still unclear of how that bargaining process worked. And is it an agreement where some of these institutions could have departments or units that have their own budgets that are allocated from the central administration that they control as they will, or others could have a much more centralized process that requires addressing pay issues in any area to be signed off by senior administrators. And that would be another sort of institutional detail I wanted to know more about. And so some of the larger issues I'm thinking about are sort of, when do the pay gaps begin? You know, you have this great detail about these people essentially over the life course of their time in the professorate. And so you could think about, in a related project, just mapping out cohorts and looking at, is there a pay gap, you know, conditional on the cost center that you're using? Is there a pay gap at the time of entry into the professorate? And then when do these sort of gaps emerge? There's some new recent literature really showing that some of it is centered around after tenure decisions, some of this is centered around other sort of salient times that occur and that have differential effects by gender, and you could do that cohort analysis with this data. Getting back to this question of sort of returns to tenure and investment, doing this analysis, I think, by cost center will be particularly important. And the reason why is, I think for your interpretation of the bargaining result, I'm less convinced by, because I don't think bargaining occurs at the university level as much as it would occur at the disciplinary level across universities. So I know my rank and I'm discovering a cohort of people. I can think about people at my own institution. But in the data that you have, I can start thinking about people at other institutions and their productivity. And I can use that to think about my market wage in a broader sense. And so there could be a way in which you can think about the cost center parts of this, which are really disciplinary sort of focus, and think about that as where the bargaining is actually occurring. Because I don't think it's just the university issue. I think it's going to be disciplinary as well. And I don't know exactly the econometric specification that would get you there, but that would be one of the things I'd be interested in. Another implication I'm thinking about this are there spillovers when this occurs to other related areas? You know, does learning about the pay structure at another university, which you might have not known anything about at all, encourage faculty movement more generally? And does it actually encourage those who are saying we are really, really underranked relative to our peers to move up in the pay scales more generally? Now, that might impact women more because they are facing a larger disparity than men, but do we see sort of movement at universities overall? And you mentioned that that wasn't as large of an effect here at the university level, but I would have to think there are universities that are just not paying their faculty on average the way that other universities are, and that would be a signal, a different sort of reputational signal than what you're talking about in the paper, one that I think will be very important for universities to solve as they attempt to recruit faculty into their ranks. So I think the larger issues...
Can you start wrapping up?
Oh, yes.
Can you start wrapping up? Yeah.
Yes. The larger issue I think that this is talking about is allocation and misallocation, but also about tenure in professions and returns to tenure. And so I think adopting that framework for the paper will be incredibly important and I think informative for policymakers in thinking about higher ed.
Okay, thank you very much. We open now the general discussion. If you have a question, raise your virtual hand and I will call your name, so you will be able to unmute and talk. I have here several hands. Rene Adams.
Not a hand, it was applause for earlier.
Oh, sorry. So the other one has also disappeared. So far, they are not questions, so let me ask you one question. I am really impressed by this finding that universities with a larger gap do not react differently to universities with a smaller gap, what you call the reputation effect, which actually goes against this idea that employers doesn't like to be seen as unfair employers. because then will be harder for them to recruit. Some productive workers will leave, and so on. You don't see workers leaving. So this seems to be a very particular market. But I was wondering whether you have any evidence or the chance to get any evidence on whether those universities with larger gap, those more unfair employers, have problems to recruit in the market, in particular to recruit women. Do you have any information on, or any idea?
These are universities where women, if I remember correctly, women are not as represented as in other universities. So the earlier wage gap is also linked to lower representation of women. I mean, the good thing about the admin data is that we have lots of observations, but the information about each of the individuals is limited. So we don't know. I don't think we could infer from the data whether these universities face higher difficulties in hiring these women. Although we could look at whether the share
ratio. Exactly, looking at the ratio over time, whether there is a polarization.
Yes.
No, but probably the number of women is relatively low in any case, right?
It is. Yeah, so we have about 15% of professors, 20% of professors, I think. It's higher at the lower ranks of the distribution.
Okay.
Yeah, but this is
so. Very good. Julia, do you have a question, Julia?
Yeah, thank you. Really interesting paper. Thank you very much. I guess my question was sort of a bit related, or at least following on, and it was around the total number of women in the sample and how that changes over time. I mean, obviously, there's lots of other factors driving that other than pay. So, I wouldn't expect any causation necessarily, but you could see it going both ways, I guess. More women, if the pay gap reduces, more women being attracted to the universities, but also on the other hand, women becoming more expensive for the universities. So, just interested if there's a trend there at all, or if it just stays quite similar. Thanks.
Yeah, so there is a trend of the representation of women increasing over this period. But you are right, we haven't really explored these exactly, so women becoming more, so I guess, women have become more expensive relative to men because they are able to bargain better now that they know the wages, and I guess that creates two effects, right? So that the universities may not want to hire higher paid women. So yeah, I guess we could look at how all these ratios of men to women have evolved over time as another sort of outcome of this paper, to try to disentangle what's going on in terms of how universities react to this higher relative wage of women. Definitely.
And next question, Iknur Tser.
Yes, hi, thank you very much. Well, actually, this is not like, but first about this Julia's point, did I get it incorrectly at the presentation? You were saying that this difference, economically speaking, is at £300, right? The change. So do you think like that £300 is really economically that meaningful to make the universities not to hire a female employee compared to male? I don't know. This is totally like, I was just, when she put it out, I was just thinking out loud, but maybe, I don't know, but actually somewhat related to what she was thinking, I was not really considering this ratio of female-male or male-to-female as a dependent variable just to see, but like somewhat as a control, or maybe I'm thinking it wrongly, but what I was thinking is that different departments have different, I'm talking not about university, but within a university, different departments have different wages. And although at some point you said that for non-professors it was like giving like a collective bargaining, but for instance, I know for LSE that like finance people are earning significantly higher than people in statistics. So I was thinking maybe the gap that you are finding is somewhat could be attributed to the ratio of people working in such departments, right? So if, for instance, people working for finance, I mean, the female working for finance are increasing compared to the people like working in statistics, then this gap as well, like coming through, like narrowing, possibly because of that as well. I mean, this could just bring another dimension. I mean, I really enjoyed your paper and I think it is super well executed. This is not like saying that, oh, what you are saying is incorrect. It's just like, I found it super interesting to include such a dimension on that one. Like we see it a lot in the US as well, like different departments, business schools and so forth, having like a huge differences on the salaries compared to the others. Just something to broad on that. Thank you very much.
I think it's really important and it resonates with some of Trevor's comments that I haven't had time to discuss, but I'll email you later because they were really good. And I think it's key. I think I don't know whether actually, I can't remember whether we control in the results that I've shown, but certainly at some point we were at least controlling for the cost center, so that's the closest that we have to the discipline, but certainly more needs to be done in terms of these interactions, with this pay transparency, and again, the discipline may be the right comparison group as opposed to the university in a sense. So definitely, thank you. Yeah, very important.
Okay. I wanted to offer you a minute to answer to Trevor, but you just mentioned your email. He actually was very dense and very useful for you, his discussion.
Yes.
Yeah, and I want to say thank you to everyone, and we resume in 10 minutes. Sorry, we resume at 10 past 4 Eastern time, 10 past 10 Central European time. Thank you.
Thanks a lot.
everyone. Welcome to the speed session. We're going to have 5 papers where each author is going to be presenting for 7 minutes. Afterwards, I'm going to give some thoughts and ask some questions of the presenters. Then they are each going to have about 2 or 3 minutes to respond. And lastly, we're going to open it up for general discussion with a Q&A from the audience. Given the large number of papers, I suggest you write your questions down so that you remember what they are. Otherwise, it might be difficult for everyone. Okay, our first presenter is Anna Stansbury, and she's going to be presenting how socioeconomically diverse is the economics profession. Anna.
Thanks so much, and thanks everyone for having me. So I'm presenting joint work today with Robert Schultz, who is also here at the conference and is at the University of Michigan, Ann Arbor. And we're both very passionate about gender and racial diversity, and actually met at a diversity and economics conference a few years ago. And that got us interested also in another aspect of diversity that we think is under focused on in these conversations, which is socioeconomic diversity. Next slide, please. So in this talk, I'm just going to outline some descriptive statistics that we've assembled on socioeconomic diversity amongst economics PhDs in the US. We're focusing here on people who received their PhD in economics and in other disciplines since 2010, and we're going to focus only on US-born recipients because it's difficult to compare measures of socioeconomic background across different countries. The data is from the Survey of Earned Doctorates, which is a census of all PhD recipients from US institutions. Everyone who finishes their PhD has to fill out this survey. And the survey contains a variable which tells us what the highest education level of your parent or guardian is. So we split people into 3 buckets. Those who are first-generation college students, that is, they have no parent with a BA or higher. Those who have at least one parent with a BA, but no graduate degree. And those who have at least one parent with a graduate degree, which could be a PhD, it could be a master's or an MBA, or it could be a professional degree like a JD or an MD. And that is our key measure of socioeconomic background for the purposes of this talk. Next slide, please. So the key stylized fact for you to take away, if there's just one you take away from this quick talk, is the one on this slide. On this slide, you can see the 14 major PhD fields as defined by the NSF: engineering, mathematics, computer science, humanities, and so on. We pull out economics from the other social sciences, and we show on the left the share of US-born PhD recipients who were first-generation college graduates in each of these fields, and on the right, the share who have at least one parent with a graduate degree. You can see that economics is by far the lowest in terms of the share of first-generation college graduates. About 14% of economics PhD recipients who were born in the US were first-generation college graduates. In contrast, on the right, you can see that economics is the highest in terms of the share with at least one parent with a graduate degree. About 2/3 of US-born economics PhD recipients have at least one parent who has a PhD, a JD, MD, MBA, and so forth. Economics is less socioeconomically diverse than math, computer science, physical sciences, biological sciences, and far less diverse than the other social sciences. Next slide, please. Another important and striking fact to take away. We know that economics is one of the worst performers in terms of gender diversity and racial and ethnic diversity. We've talked a lot about that today. These charts plot the share who is a first-generation college graduate, so no parent has a BA or higher, on the y-axis against the share who's female on the left and the share who is an underrepresented racial or ethnic minority, URM, on the right. And you can see that there's this very strong correlation across fields. And what that suggests to us is that the factors that are preventing economics and other similarly non-diverse disciplines from attracting, supporting, and retaining URM individuals and women may be the same kinds of factors that are preventing economics from attracting, retaining, and supporting first-generation college graduates. Next slide, please. It's important to note, however, that the axis of socioeconomic diversity is related to, but not the same as, the axis of racial and ethnic diversity. We know that people who have both of these minoritized characteristics are going to face intersecting challenges. At the same time, we can also see that within every major racial and ethnic group, economics is the least socioeconomically diverse along major fields. So it's not the case that economics' lack of racial and ethnic diversity is what is explaining its lack of socioeconomic diversity. I know the graph is small, but basically what you can see on the left is the share by field that's a first-generation college student within major racial and ethnic groups, and economics is in red, so it's always the smallest share. On the right, it's the share who have at least one parent with a graduate degree. Economics is in red, and you can see that it's always the largest share within every major racial and ethnic group. Next slide, please. One of the factors that may be driving economics to be lacking in socioeconomic diversity is the fact that economics seems to be drawing from institutions, undergraduate institutions, who have a pool of BA students who are less socioeconomically diverse than average. So this shows the undergraduate institution type of US-born economics PhD recipients who did their BA in the US, which is in practice 99% of them. Public institutions tend to have a more socioeconomically diverse population than private institutions. The share with a BA from a public institution is lower in economics than in any other PhD field, slightly less than half. The Ivy Plus institutions, which is a term that Raj Chetty has used in some of his work on college mobility, the 8 Ivy League plus Chicago, Stanford, Duke, and MIT, have a very advantaged student body. More than half of students at the Ivy Plus institutions at the undergraduate level have parents who come from the top 10% of the income distribution. And you can see that economics draws a very large share of its PhD recipients from these Ivy Plus institutions relative to other PhD disciplines. Next slide, please. The final stat I want you to take away is that this lack of socioeconomic diversity is particularly acute in the so-called top-ranked economics PhD programs. So these graphs show the share that's first-generation college student across economics PhD recipients by the rank of the economics program as defined by the US News and World Report ranking of econ graduate programs. So that suggests to you that just over 5% of US-born economics PhD students who are at those top 15 ranked institutions are first-generation college graduates. And about 80%, the graph on the right, have a parent with a graduate degree. The reason we highlight this is because work by Todd Jones and Ariel Sloan has shown that more than half of tenure-track faculty at US economics departments are from these top 15 institutions. So this is indicative of the fact that the professoriate in economics may be even less socioeconomically diverse than the population of PhDs that we're looking at. Next slide, please. So overall, we think that these stats illustrate that economics has a socioeconomic diversity problem. We've been comparing it to the population of PhDs, but we of course all know that PhD recipients are also on average very unrepresentative compared to the general population. So if we compare to the general population of similar age, a US-born economics PhD graduate is 5 times as likely as their similar-aged peers in the US to have a parent with a graduate degree, and 1/5 as likely to be a first-generation college graduate. This matters for equity reasons if we want everyone to have access to our profession. It matters for efficiency reasons if we believe that barriers to access prevent the most talented people from getting into the profession. And it also matters in terms of the substance of our research, particularly as we're a discipline which concerns itself with issues like poverty, inequality, unemployment, access to education that disproportionately affect people from less advantaged socioeconomic backgrounds. How can we study these issues without representation from people who actually experience them? So hopefully we've convinced you that socioeconomic background should be an important part of these conversations going forward and spur future research. Thank you.
Wonderful. Thank you very much. Next presenter is Danielle Sandler. She's going to be talking about diversity and labor market outcomes in the economics profession. Thank you.
Great, thank you. So I'm excited to share this work with my colleagues Lucia Foster and Erica McIntyre. So this work is the opinions of us and not the Census Bureau, and all results have been disclosed. So next slide. So we're going to be focusing on the labor market for economics PhDs. And why? Because, as we all know, since we're here at this conference, economics is a diversity and equity problem. In particular, it's harder for women and underrepresented groups to get promoted in academia. But most studies on the economics profession are focused on academia, yet almost half of recent PhD placements were in industry and government jobs. So we both don't know much about those sectors, and we also know little about career mobility in economics. We know a lot about initial placements, but not where people go after those initial placements and how often there's churn between them. Next slide. So this paper sort of plugs some of those gaps in the literature. We link the survey of earned doctorates from the National Center for Education Statistics to longitudinal Census Bureau data on jobs from the longitudinal employer household dynamics data and IRS W-2 data. And this will allow us to look at dispersion of employment and earnings outcomes by demographics. So our data has some key advantages on others that have been used to do this research. We have a large sample. We have 12,500 PhD economists. It's almost universal coverage of U.S. economics PhDs granted in the last 20 years who are then working in the United States. And then we have longitudinal data on the outcomes, so we can track those initial placements as well as the movements across sectors over time. Next slide. So to start with, I want to give a snapshot of where our sample is working in 2017. So we cut this data into two ways, one into broad sectors of academia, industry, and government, and then by demographics. So we can see that the distribution of female economists, this is both citizens and non-citizens, is relatively evenly spread across the three sectors, with a little bit more representation in government, a little less in academia. Non-U.S. citizens are much more well represented in industry and less represented in government, which makes sense since a lot of industry jobs or government jobs are not available to non-U.S. citizens. For U.S. citizens, we split by 5 broad racial categories. So we combined Hispanic, American Indian, Alaska Native, and Native Hawaiian Pacific Islander. Unfortunately, the sample sizes are too small to show the latter two groups separately. And so this group, you can see sort of the small distribution of this group relative to the U.S. population. We're seeing around 5% in all three sectors, whereas the combined group would be around 19% of the U.S. population. But they are represented in sort of all three sectors. White economists are of over 70% in all three sectors. Asian economists are more represented in industry and government and less represented in academia. Black economists, once again, this is an underrepresented group, so it's about 3%, 3 to 4% in all three sectors, whereas the U.S. population is around 13% African American. But it is evenly distributed across the sectors relatively. And then the last category is 2 or more races and race not reported, which is also relatively evenly spread. The reason we care about these sectors is sort of twofold. The first is that economists working in these sectors have different roles and responsibilities, both in the profession and in the economy. The second is that their compensation in these sectors differs. So I'm going to show that next. So next slide. So this is the earnings distribution the first year after a PhD, so the placement. And you can see even for initial placements, economists working in industry job earn more than economists in academia and government. One more click on the slides. Yes, and so the gap between government and industry is 85% in this first year, and between academia and industry is 77%. Next slide. This gap in earnings grows over time. So you can see the industry jobs at the median earn a lot more 10 years after PhD. The gap between government and industry is 71%, and academia and industry is 63%. In addition, the industry jobs, there's a much wider distribution. So there's a sort of a range of outcomes for people working in industry, whereas for the academia and government, there is a long right tail. So there's people that are doing significantly better than others, but there's also the big mass around the median. Next slide. So we can't do these earnings distributions by the race groups because we don't have enough sample size. So to understand differences in earnings across race and gender, we're going to run these simple Minster regressions controlling for polynomial inexperience, and then we're going to show the regressions both with and without PhD program fixed effects. So this will help us understand how much sorting into PhD programs plays in the later earnings of the PhDs in our sample. Next slide. So we're starting with female PhDs. So this is relative to men. We can see it between 15% and 9% earnings gap between men and women. And so the gray bar, darker gray bars on the left are without PhD program fixed effects, and the lighter gray bars on the right are with PhD program fixed effects. So you can see that the PhD program fixed effects changes the earnings gap somewhat in some of the sectors, but the gap remains. So and then that last column includes both PhD fixed effects and employer fixed effects. So we're throwing a lot in there, and we still see a 9% gap between men and women. Next slide. So for the African American economists relative to white economists, we're seeing without PhD program fixed effects, we are still seeing big earnings gaps, 11% in academia up to 44% in consulting. Some of these are reduced when we add PhD program fixed effects. So the sorting into PhD programs matters here. So that it's both levels of the pipeline are important. And the gap sort of remains even once we include employer fixed effects. So next slide. Next slide. For Hispanic, American Indian, Alaska Native, and Native Hawaiian Pacific Islander, the story is a lot more mixed. So these, in all cases, the percentages are smaller. So the biggest we're seeing is a 6% gap. And there's sort of a mixed story of when we add the PhD program fixed effects. There's a sort of wider distribution of where economists in this group go to school for the PhD program. And then next slide. And finally, Asian Americans, we're seeing another mixed story. We actually see some earnings premiums if we don't control for PhD program fixed effects, but then a gap once we control for PhD program. Once again, these are small, so we're seeing 6 or 7% gap or premium at the largest. Next slide. So I think I'm about out of time, so this is our work in progress. We're really interested in feedback, so please feel free to reach out if you have any comments on things you'd like to see with this interesting data.
Wonderful. Our next paper will be presented by Mackenzie Alston and the effects of the 2020 social justice movement on faculty. Go ahead.
Thank you very much. So this is joint work with Sarah Jacobson. Next slide. Over the past decade or so, we've been seeing a lot of high-profile media cases of police brutality. This kind of started with Trayvon Martin in 2012, which started the hashtag Black Lives Matter movement in 2013. And then every year, we keep hearing more and more stories. Most recently, there was George Floyd, who was killed by a white police officer in Minneapolis in May 25th of 2020. Next slide. And so in this project, we're specifically looking to see how faculty were affected by George Floyd's death and the resulting social justice movement. But before getting into that, evidence and previous research has shown that different faculty have different experiences in academia. And if you look at faculty of color, there are reports of underrepresentation, differences in likelihood of being promoted or tenured, and then also just different experiences at work. So you see a lot of qualitative research where faculty of color are talking about how funding agencies or journals don't acknowledge the type of research that they're interested in the same way as their white colleagues. They sometimes face problems in the classroom where students are questioning their authority. And then they're often asked to do a lot of service work, but aren't rewarded for it when it comes time for promotion and tenure. And then on top of that, they can be in work environments where they might be facing microaggression or other things that makes it difficult for them to work. Next slide. So given all of these factors, we thought it was extremely important to understand how faculty of color are affected when we have these race-related external shocks, like the murder of George Floyd and the social justice movement that followed it. So our two big research questions for this project were, one, how do race-related social justice issues in society affect faculty's research, teaching, and service? And then two, how do these effects vary by race? Next slide. So to answer those questions, we conducted a survey where we reached out to our faculty at over 120 institutions in the United States, and we particularly looked at faculty in economics, political science, psychology, and sociology, and related fields or departments like business and policy schools. And what we were doing was asking them how they thought their research, teaching, and service were affected by the social justice movement, not only during the summer in which George Floyd was murdered, but also the academic year that followed. In the end, we collected almost 1,300 responses. They were predominantly from white, non-Hispanic scholars, almost an even split between women and men, and they predominantly came from research institutions. Next slide. So we asked about, again, research and teaching, but for this presentation, I'll focus on some of the research results. One question that we asked them was how many projects do you think were negatively affected, not affected at all, or positively affected over the summer because of the social justice movement? This is showing you the difference in responses based off of race, where the darker bar is showing you the number of projects they said were negatively affected, lighter bar is showing you no effect, and the medium bar is showing you a positive effect. On average, white scholars and black scholars are working on a similar number of projects, but when you look at the fraction of projects that were negatively affected, that number is higher for black scholars. And that's true even when you add controls for things like age and tenure status. However, there is no difference in the fraction of projects that people said were positively affected by the social justice movement. Next slide. We also asked some questions like how their ability to mentally concentrate on research were affected. And so this is showing you the distribution of responses. Darker bar is showing you black responses, and lighter bars are showing you white responses. And you see that for black scholars, over 60% of them were saying their ability to mentally concentrate was negatively affected. And in fact, when you kind of pull these very negatively affected and somewhat negatively affected responses together, you see that there's a higher fraction of black scholars in that group compared to white scholars, and that's even when you add for controls. But interestingly, there's also a higher fraction of black scholars that say that their concentration on research was positively affected by the social justice movement compared to white scholars. Next slide. We were also interested to see how these effects carried on into the academic year. So this is still looking at the ability to mentally concentrate, but it's focused on academic year 2020 to 2021. So you see that the responses are different, but we're still seeing a significant difference in the number of black scholars that said that there was a negative effect on their concentration on research compared to white scholars. But the difference in positive effects, the racial difference, is no longer statistically significant once we look at the academic year. Next slide. To try to understand what was going on a little bit better, we also looked at how people were dividing their time between research, teaching, and service, and how this was affected by the social justice movement. What we saw is that the predominant answer among both white and black scholars was that their research time fell because of the social justice movement, and their teaching time increased as well as their service. But when you dig into the service component, you start to learn some interesting things. So 92% of black scholars and 98% of white scholars said that the time that they spent on diversity, equity, and inclusion increased since May 2020. But when you actually look at the hours of time spent on these types of service activities, you see that Black scholars were spending more time on this work. On top of that, they were more likely to have a DEI leadership role, and they were more likely to say that their time spent mentoring students of color increased after George Floyd died in May. Next slide. To sort of wrap up, we did find evidence that faculty were negatively affected by the social justice movement when it concerned their research, and then wasn't able to show you, but also in terms of their teaching. And this was definitely true in the summer of 2020, but we also saw some effects going on into the following academic year, where there were still, in some cases, evidence of racial differences. And so we believe part of this can be explained by how people's time use changed, where the big story is that more hours were spent on diversity, equity, and inclusion for Black faculty compared to white faculty. But it's all not a sad story. We did ask people if they felt happy about the service that they were doing, for example, and the most common answer was yes. And as I showed in these slides, some people were saying that their research was positively affected by the movement too. Next slide. So that wraps it up here, but I put the email of myself and Sarah in case you want to reach out later with questions. Thank you.
Thank you. Our next presenter is going to be Leonora Rees, Lifting Diversity and Inclusion in Economics, how the Australian Women in Economics Network put evidence into action. Take it away.
Thank you, Raquel. Thank you very much for the opportunity to contribute to this conference. It's a pleasure to be representing the Women in Economics Network from Australia and to present this paper, which is co-authored with Rebecca Cassells, Jugyu Yengen and Danielle Wood. Now, for all of those researchers out there who have been investigating and interrogating what works to improve gender equality in economics, we want you to know that we have been reading and learning from your research, and this paper is a documentation of the practical way that we listen to your research and put it into action. Next slide, please. Now, in Australia, have we missed a slide there? Yes, thank you. In Australia, we acknowledge our First Nations people as the traditional custodians of the lands on which we gather. I'm joining you from the lands of the Yugambeh people, which is in southeast Queensland. Their traditional greeting in Bungalang language is Jingi Wala. The image you see there on the screen is the east coast of Australia looking out to the Pacific Ocean, obviously with the US and Canada on the other side. So even though we have many kilometres of ocean between us, we are united in our common cause. Next slide, please. So what happens when we run a Google search for Australian economist? On the next slide, you can see it's an impressive and a distinguished collage, but we need to squint hard to spot the females or anyone who is not white. And some of the women, like Wendy Carlin in the bottom corner, don't even get their own photo. Now, this picture is important because, as has been highlighted throughout this conference, women's underrepresentation is not just about head counts, it's also about voice. It's about influence, it's about respect and recognition of women's contributions. On the next slide, please. To provide some benchmarks using our census data, we see that women comprise around 1/3 of economists in Australia, and that fraction has not budged over recent decades. They comprise around 40% of the population who hold an economics qualification. On the next slide, please, you'll see that inside school classrooms, female representation is falling. These top two graphs are for two of Australia's largest states. What's disillusioning is that we actually used to be at around equal shares during the early 1990s. On the bottom graph there, we see that in university lecture theatres, female students remain in the minority. On the next slide, please. We see that in terms of the gender imbalance in academia, female professors are also in stark minority. So that's the picture. What did Australia do about this? Moving to our next slide, please. Professor Deborah Cobb-Clark of the University of Sydney raised this issue with the Economic Society of Australia and convened a mentoring retreat in 2016. And that's where the idea for WEN was born, and it was launched in 2017. And we articulated these 4 objectives with a holistic outlook. The first, to support women currently in the profession. And this is not just about career development. This is about providing a sense of community, of solidarity, of belonging to the profession. The second point is about fostering women's ongoing career progression to achieve that senior representation and leadership. The third point is about public visibility, recognition, opportunities for influence, including in public policy discussion. And the fourth point, thinking ahead to the next generation and fueling that pipeline of future female economists. Now, on the next slide, please, you'll see that this has given rise to an array of initiatives, and you can read more about these in the paper, but just to highlight a few here. Mentoring. We paid attention to what other organisations, such as CSWEP in the US, had been doing, and one of our mentoring programs was conducted as an RCT with favourable results. We were mindful about gender equality approaches that imply that women have some sort of capability deficit or deficiency that needs fixing. We know it's not the women, but the system and the culture that needs fixing. And so we have also invested in ways to elevate awareness and research about implicit biases and what needs to change at an organisational and societal level. And one way is through our annual Australian Gender Economics Workshop. We have created a media register, so journalists and conference organisers no longer have an excuse to say, I just can't find a female economist to talk to. And our resources for students highlight the wide-ranging opportunities that economics offers, and it's communicated with authenticity and passion. And you can find these freely available on the WEN website, including our video on YouTube, which is titled Economics, Understand the World Around You. On the next slide, please. Some key themes from the literature and the research really guided our approach. So our paper offers more detail, but here's a snapshot. To tackle misperceptions about economics, we focused on the human dimension and well-being. And you'll see that the STEM fields have done this quite well in their efforts to attract more females. We highlighted the practical usefulness of economics as a life skill, and the research on andragogical teaching, which is teaching for adults as opposed to teaching for children, really highlights the importance of examples that students can personally relate to. We knew we needed to tackle narrow stereotypes of economists through greater diversity in role models and public visibility. This was important not just to inspire more women, but so that more men, including that next generation of male students coming through the system, become accustomed to seeing female economists as the norm. Now, the research shows us that females want to fix problems and help others. They are community-minded problem solvers. I mean, what more could you ask for? So we highlighted to students how an economics toolkit equips you for this. And we took note of studies that found that talking about salaries and earnings actually deterred female students. And you'll see that in all of our WEN student resources, we do not mention how much you can earn. More broadly, we were informed by the research on what works to address gender biases in workplaces, including the influence of unconscious bias. And WEN has also been a vehicle for highlighting where women's experiences are being neglected or deprioritised in economic policy making. And WEN has advocated for this to be addressed, such as through gender lensing or gender responsive budgeting. Next slide, please. Now, once WEN was created, what happened? Well, we saw female membership in the ESA double and stay that way. And this is in absolute numbers as well as a proportion. On the next slide, please. We do need to invest more in our metrics and our evaluation. That's an important part of our next stage of development. But an area of clear improvement has been the increase in women economists featured in the Australian media. And this coincided with our public broadcaster, the ABC, launching a 50-50 target. So WEN was able to assist through our media register, through referrals, through supporting our members to participate. There's a few quotes there that reflect on this impact, but that quote at the bottom really speaks to it. A student told us that she had recently started taking an interest in economics on the news, and she just assumed that most economists were female because that's what she saw. So that's the type of impact that we want to have. The next slide, please. Now, in the paper, we report on the results of a survey that we conducted to get a sense of WEN's impact. The sample size is small, but these indicative results are positive, especially in terms of WEN improving the representation and recognition of women, broadening the range of topics being discussed, and raising awareness about equality and diversity issues. We also collected qualitative feedback. On the next slide, please. This revealed an awareness amongst members that WEN was important not just for women, but for shifting perceptions among men. And you can see that in that quote in the last paragraph. It says it's just as important for young men to look up and see both genders represented, and for them to broaden their thinking around economics and to think about women's issues as actually being human issues.
Lenora, you're slightly over time, so I'm just going to ask you to wrap up. Yeah.
Sure. So on our next slide there, we've got final slide. Where in the paper, we share some practical challenges, including limited resources, aims to conduct more robust evaluations, improve diversity within WEN, and sustain momentum. Thank you very much.
Thank you. Okay, our last presentation today will be by Renee Adams, and she's going to be presenting the 3 S's. Actually, I made that up. It's sex, science, and society. Take it away.
Thanks very much. Can you hear me? Okay, I had a problem. Yeah, okay, good. So last but hopefully not least, so the story of this paper, actually, let me say this paper is co-authored with Jing Su, who should be also online. So the story of this paper is that the business school that I'm in circulated an email listing the people or the faculty members who had been listed as among the top scientists, among the top 100,000 scientists worldwide, according to the data that we're going to use in this paper. And obviously, you know, the bad news was, of course, that most of the top scientists were men in the business school. And so that was a bad news. The good news was that I saw this data and I was like, oh, this is potentially quite useful for looking at women's representation in science. And the reason that it's potentially useful is because it has an international dimension. Okay, and what we're actually interested in here is the standard story that women's preferences somehow explain everything. Okay, so we don't think that that's necessarily true. And so how does the international data help us? Well, unless you believe that women and men are systematically sort of biologically different across countries, we argue that we should observe the same sort of occupational distribution across sciences in each country if preferences drive women's selection into science. If we don't find that men and women distribution in science looks basically the same in each country, then that suggests there's other factors that matter. So it's a very simple story. Next slide, please. Okay, so we're basically arguing that it's not just preferences, it's also culture. And here we're looking at societal culture. So the data that we have comes from this study that was underlying the announcement at the business school about all our top scientists, which consists of all the people who were cited. So basically, it's this paper by Ioannidis et al. From 2019. They took all the people who were cited in 2019 and ranked them by the citations. So it's essentially the top 100,000 among the people cited in 2019. The data covers 20 scientific fields from 137 countries. And we're doing something very simple here. I won't show you all the results, but basically the first observation is, there's variation across countries in the representation of women among the top scientists. There's variation across fields. And what we want to look at is whether culture matters. And so what we're looking at in particular are two measures of culture. The first is country level sort of gender culture. So these are country level culture measures specifically related to women's participation in the labor force. We get these from the World Economic Forum, from the World Value Survey. We have female labor force participation, and there's this new database on women in business laws. We also have a measure of field level culture, which comes from a paper by Leslie et al. From 2015. And what they do is they ask academics, what is the level of brilliance necessary to be in your field? And so we're going to use these measures of brilliance to see whether they matter. Next slide, please. Okay, so what we do is very simple. So we have data at the individual level. We collapse it to the field country level. And we calculate the percent of women among the top scientists. So that's the dependent variable. And we regress this dependent variable on measures of country level culture that are specific to gender. And the columns here vary primarily by the measure of culture that we use. The four columns on the left, we have the different measures of culture, 4 different measures of culture, and the main variable here is really just the culture measure. And what you see is gender culture is related to women's representation among the top scientists in a country. In the middle 2 columns, what we do is we get data from another paper on the percent of women among scientists in a field. So this is not just among top scientists, but it's among scientists in a field. We use that as the main explanatory variable. And the idea there is obviously if you have more women in a field, you should observe more female top scientists, right? And so you do observe this positive association. And then in the columns on the right, what we do is we look at whether culture sort of moderates the conversion from the field to the top, right? And so we interact culture with the percent of women in the field, and we do observe a positive correlation. So this suggests that when culture is more favorable towards women, then women are much more likely to be able to make it to the top. And I haven't discussed fixed effects or whatever here, but we do try to put in field and country fixed effects in order to account for sort of other emitted variables. Now, what I'm not showing you here in the interest of time is some individual level regressions that we have looking at women's ranking and movement across countries. But I will show you something about STEM in the next slide, please. So the argument about women's preferences is particularly prominent when people discuss STEM fields. And so what we do here is we focus on looking at women in STEM fields and whether culture affects women's entry into STEM. And what you see here is the interaction with STEM and culture is actually negative. And at first we thought, well, how is this possible, right? And then we graphed the result, and basically what we find is gender culture leads to greater women's representation in STEM fields and non-STEM fields, but actually the conversion is higher for the non-STEM fields. And so, which is an interesting finding that we weren't expecting, and we think deserves some more attention, because there is a backlash right now also about sort of the non-STEM fields claiming that they're not getting enough attention. Next slide, please. Okay, and just finally, the previous results highlight that country culture matters. These results sort of point out that they also matter. So what we hear is we put in these beliefs about how brilliant you have to be in the field. And the column on the left, you see that the more brilliant that people think you have to be in a field, the fewer women are top scientists in that field. Two columns, we look at the male and female beliefs separately. Both of these are negatively correlated with women's representation, although the men's beliefs are more strongly correlated. And when we put both of them together, we see that only the men's beliefs survive. So this idea that women's preferences only matter doesn't seem to hold water. It also seems to be that men's preferences play a role here. Okay, next slide, please. Okay, so to conclude, we think the evidence is consistent with the idea that it's not just women's preferences. Culture also matters. And we think that we need to take a broader perspective on why women do not enter science. Thanks.
Wonderful. Thank you very much. I'm going to moderate myself now, I think, and discuss these 5 papers. I won't be doing it necessarily in order, so don't feel bad if I jump around. It had to do with what I thought made more sense. I can't see my slides, so are they up? No.
Just 1 second, sorry.
Just one moment and we'll have them up.
Okay, thank you. Okay, wonderful. So I guess first thing I want to say is thank you very much to the organizers for inviting me to discuss these 5 papers. It was a challenging job and I really enjoyed it, I have to say. So what I'm going to try to do now in my discussion is to be able to fill out what they had to leave a bit because of limited time, maybe make some general points and also ask some general questions. The questions are not always going to be paper specific, so if you feel like tackling them in your answering time or response time, please go ahead and do so. Next slide. Okay, so I think at the end of today, we've learned what we kind of knew, which is that economics is an amazingly elitist profession. It lacks diversity in gender, racial, ethnic, and socioeconomic dimensions. The big questions, of course, are why and what we can do to change this. Next slide. Next slide, yeah. So I'm going to start with the socioeconomic background of U.S. PhD economists. And this paper by Schultz and Stansberry examines the socioeconomic origins of PhD economists using the SED and restricting the sample to US-born PhD recipients. Next slide. I'm going to show you some of what she found. I'm going to be stressing more the temporal dimension than what she did. So this is a figure from her paper, and what you can see there in the red line at the top is the share of economists with at least one parent with a post-grad degree, meaning PhD, master's, law degrees, etc. From 1970 onwards has been increasing, has every other discipline put up here. But it's been increasing more for economics than for any of the other disciplines. The counterpart of that we can see also in the next slide, which shows you that the share of what Anna called first generation economists, which is economists with no parent with a BA or higher, that's been decreasing for all disciplines as well, but it's decreased most for economics. Okay, economics started a little bit below most of them, but it's now way below most of them. Neither of these two facts, in some sense, are surprising. The share of PhDs, in some sense, has been increasing in the economy. The share of U.S.-born economists, the share of U.S. individuals with no parents of a BA has also been decreasing. And one thing I would suggest, just so that we can sort of feel how elitist PhDs are in general, would be to graph that figure, include one more line in your diagrams so that we can see what's happening to people of this age group as we go a long time, and see how much more elitist PhDs in general have become. Next slide. This is a share of female in economics is in red. This is a fact that is now well known, a lot due to work by CSWEP and a lot of authors that I'm not going to mention now. And as you can see, economics has a low share of women, and like math, the dark green line, and computer science, the lighter green line, it's kind of gotten stuck over time. Not only has it gotten stuck since the beginning of the 90s, more or less, but it's actually slightly decreased, which is kind of bad news. And it's actually decreased in mathematics as well, and I'll get back to that. Next slide, please. The share of underrepresented minorities, those are increasing in the population as a whole. So one more time, I would say it'd be really interesting to see what's happening just in general in the US in order to be able to judge this figure from a more socioeconomic point of view, more generally for all PhDs. But as you can see, there's very different behavior by the red line. Once again, that's economics, and by other disciplines such as psychology or social science, excluding economics. Those are the top rapidly rising lines that you see in that figure. Economics once again has gotten stuck, towards the end of the 90s. There's not been really much of an increase in the share of URMs among US-born PhD graduates in that discipline. The same thing is true, again, I'll point out, in math and in computer science. Actually, let me take that back. It's true in math and less true in computer science in the last few years. Next slide, please. This is a slide that Anna showed you, and I'm just showing it to you again. It's really amazing. It tells you that this lack of socioeconomic diversity is not coming because URMs are way underrepresented in economics. It's just true in general for each group that you look at. And I know that it's small, but it's Asian, non-Hispanics, Black non-Hispanics, Hispanics of all races, other non-Hispanics, and white non-Hispanics. And in fact, that slope, let's talk about it as a slope between, economics at the top on the left, at the bottom on the right, one of them being graduate degrees, the other one being first generation. That slope is actually steeper for some of the underrepresented minorities than it is for whites, showing you that it's really not coming from the underrepresentation, but it's just a general fact that's true for all groups. And here I'm not showing you gender, but it's actually true for women as well. It's not that they come from a different socioeconomic background than their male counterparts by and large. Next slide. This slide Anna also showed, and this shows you that economics is also elitist in the sense that the share that has a BA from the Ivy Plus institutions is largest in economics. It's 16%. What she didn't show you is actually on the next slide. Next slide, please. Yeah. Which is the share of Ivy Plus bachelors, BAs, by the rank of the PhD program. And it's really quite astounding. I did not know this fact. If you are ranked 1 to 6 as a US PhD program, your share of Ivy Leagues is going to be, 40-something%, which is, just gigantic. And whereas if 7 to 15, it just falls to below, I can't really guess it, let's say 28%, and 16 plus, it's below 10%. So you really see a very steep gradient in the share of the PhD class that's coming from Ivy Leagues. The counterpart of this, not fully, because there are some elite public institutions, is the fact that those from rank 1 to 6 have a smaller share of their their PhD students coming from undergraduates that come from public institutions. Next slide. So the questions I would have for this is, well, obvious. Why is economics less diverse than other disciplines? So what the authors do is they ran a series of regressions with a dependent variable that was having a post-grad parent. And this was run on the field, so economics, physical sciences, biological science, etc., and a series of controls. The controls included, they were increasing as we went along in that table, the year, the demographics, the BA field, the BA institution, and the PhD institution. Now, as they added the controls, this decreased the indicator on economics PhD from 15 percentage points to 5 percentage points. And the similar exercise done not for a parent post-grad, but rather for having parents that are first generation, also decreased the economics PhD indicator from around, say, 12 or 13 percentage points to about 5 percentage points. So it really decreased it. Next slide. Now, what this exercise does, though, is that it really reassigns our ignorance to an earlier stage. So, for example, an important contributor to the socioeconomic privilege status of economics PhD is the fact that their most important feeders into economics are math and economics BAs. Now, math and economic BAs have themselves more socioeconomically privileged students. So we're now kind of taking everything back one step, which is a useful thing nonetheless to do, but it's kind of just moved the mystery back, and we have to ask ourselves, why is it that math and economic BAs come from more privileged socioeconomic backgrounds? Similarly with the Ivy Plus institutions, we can control for BAs, where people are getting their BAs before they do their PhDs. That's going to, that's going to have some explanatory power for the degree of parents with postgrad degrees. But again, why is it that Ivy Plus institutions have such a large presence in PhD economics, especially in the top-ranked graduate programs? So I think we're just taking the question back one step. And next slide. And one potentially important question or factor, and I couldn't understand how important it might be, is that economic PhDs are overwhelmingly not born in the US. So 70% would be, was a kind of my back of the envelope calculation, looking at your data, was not born in the US. And you have to ask yourself how this might be affecting the type of US born student who actually makes it into an economics PhD program. So one thing I would suggest to the authors is that maybe they want to get some bounds on this by saying, well, let's suppose that it was like the next science or social science. It had that level of foreign students. And suppose that only the most privileged are going to come in first and then go down the road. How would that then affect the degree of socioeconomic privilege that you see in economics? Okay. Next slide, please. So let me turn now to the paper that Danielle presented. And if Anna's papers can be seen as asking, where do economics PhD comes from? The paper by Danielle asks instead, where do they go and how do they fare? It has great data in that it sense that it combines the same SED that Anna was using with census and IRS data, which allows a longitudinal perspective on outcomes. Now, we have a similar issue that I was pointing out with respect to foreigners that we saw in Anna's paper. Here, the authors can only study the sample that's working in the US. So I think that, my guess is that, Anna's sample went down to about 10,000. Here, the sample size decreases from 23,500 to 12,500. So we're looking at 53% of the class of PhDs, but that's the ones that we're studying, and that's not necessarily a wrong thing to do. It just is something to keep in mind when you're trying to interpret the data. Next slide. So what are the main findings? So everything is relative. So I'm just going to stress that because it looks like distributions of numbers. It's actually not a distribution, it's all relative. So relative to the distribution of male economists, women are more likely to be in government and less likely to be in academia. Relative to the distribution of white economists, Asian economists are more likely to be in industry and less likely to be in academia. Relative to the distribution of white economists, Black economists are more likely to be in government and less likely to be in industry. And relative to the distribution of white economists, Hispanics, AIAN, and NHPI economists are more likely to be in academia. So that's in terms of employment sectors. Next slide, please. Oh, I thought I would be able to see this better. Okay, so I think Danielle put up quite a bit of this. I'm just going to stress a bit because I found it quite fascinating. So I need to make this bigger. Hold on one second. I need to squeeze you guys. So it's the black line there that is academics that come from the top 5%. The blue line is the top 20%, and the others are the little more line on the left. That's the dotted one. And what this is showing you is earnings in first year by PhD rank. On the left is academia. On the right is industry. Yes, there's inequality. You know, people in the top 20 relative to the top 5 are earning 87% of those in the top 5. Those in the other are earning 64%. And as you can see, that gap is less important in industry. After that first year, it's 93% and 74%. Next slide. The interesting thing is what happens later and the contrast between academia and industry, and some speculation as to what that might tell us. So as you can see on the left, again, everything has moved further apart. Now the top 20 are making 73%, whereas others, the other group is making 52% of what the top 5 are making. That's after 10 years. Whereas in industry, actually, things have gotten closer together. The earnings have converged. You see they're at 95% for the top 20 relative to the top 5. And at 75% for the others relative to the top 5. Now, if you wanted to take a very simplistic view, but not necessarily incorrect, you might want to argue, you know what, this is showing me that there's some weird thing that goes on in academia, whereby initial merit or small differences in merit get really, really magnified over time. Not necessarily due to anything that's meritocratic, but the fact that if you're in a top 5 department, you're going to be asked to present at many more conferences. You're going to be, sending your papers to the top journals. You're going to be doing a lot of things that if you're even in the top, 15th department, you're not going to be asked to do. Maybe industry is more competitive. Maybe that's what we're seeing there. That's what is happening after 10 years. Of course, the simple rejoinder to that is that no, it's not that. It's just that, those initial differences, they really, really matter. And you see the true merit after 10 years, whereas the selection that happens in industry is far less, it brings everybody much closer together. So it's not clear what it's showing, but it is I find it a very interesting fact that I wanted to bring more attention to. Next slide. What about women? This Danielle didn't have time to go into. Initially, on the left, this is after the first year after PhD. This is now all top 20 economics programs. So we're not looking at differences in rank. We're just looking at differences in gender or differences in earnings by gender, subject to being in the top 20 ranked PhD programs. And you see there is a bit of a difference, but it's not much, not for the median, not for the 75th percentile. 10 years later, you see that the means and the medians and the 75th percentiles by gender have moved much further apart. So again, we see something going on. It'd be interesting to know what it is. Next slide. So when I saw these first two papers, I really maybe I was in a bad mood about how elitist economics was. And it made me try to think about what might be going on. There's a very nice article in the Journal of Economics Perspectives called The Superiority of Economists, where superiorities should not be taken literally. It's by Fourcade, Ollion, and Algan. And it discusses the insular and hierarchical structure of our discipline. For hiring, there's much more exchange among top departments than in other fields. And in fact, one of the presenters early this morning was discussing the case of Mary Daly, who's governor of the San Francisco Fed, and saying, you know, how it was risky to hire her because she didn't come from an elite PhD program. And if somebody does badly and they're not from an elite PhD program, it reflects badly on you from having hired her. Whereas if you hire a safe bet from a top PhD program, maybe, it just, it happens. So in any case, hiring is much more, compared to other disciplines, much more among top departments than in other fields. And publishing, which is a theme that's very dear to us in economics, academic profession, the top 5 departments account for 29% of all the authors in the JPE and 38% in the QJE. For networks, and this is my term, not theirs, it's immense in economics. It's really important, I would say, if you're a young economist, to partner, to write something with somebody who is in a top 5 department. The top 5 departments, if you are a PhD, comes from a top 5 department. The JPE publishes 46% of its articles from someone who came from a top 5 department, whereas the QJE publishes 58%. Furthermore, there's control of institutions. This is something that we really need to think a bit more about, I think, in economics. The editors, the co-editors of leading journals, the NBER program directors, the AEA positions, you name it. I haven't seen any numerical study about it, but visually, belonging to a top 5 department is very important. Next slide, please. So now let me turn to the top scientists paper. Now I'm going a bit out of sequence. So the paper that Renee presented explores the relationships among the share of women top scientists and the share of women in science and several measures of culture. And what they show is that countries with greater gender equality in terms of its culture, which is measured in a variety of ways, have a larger female share of top scientists controlling for the field in which they're in. And within a given country, a greater female share of scientists in that field is associated with a larger share of female top scientists in that field. And furthermore, the effect of the female share of scientists is larger in countries with more equal gender culture. That is, it seems to have a magnifying effect in terms of getting it there. And that was the main interesting result that I found from that paper. Can we move one slide? Sorry. So what I put up here are PISA scores. This comes from a paper from Guizo, Montesapienza, and Gales. On the top, you see the gender gap in math in yellow, in gray for reading. The gap is women's scores minus male scores, the average, okay, by country. And so you will be able to figure out what countries it is. And on the bottom, you have actually the gender gap index, which is a measure of gender inequality. It's actually the WEF one that the authors also use. And what you can see is that there is some relation, to be shown more rigorously than this, but there's some relationship between measures of women's equality in other spheres and the gender gap in math. And as you go towards the right, the gender gap in math slowly is disappearing and in fact gets overturned for the case of Iceland, whereas the gender gap in reading remains and if anything could even become larger. So this paper that came out in 2008 in Science was just meant to, show that there's a relationship between culture as measured by gender gaps and culture is measured by gender gaps via this index and the gender gap that you see. Raising the question once again, as Renee properly did, how much of this is preferences and how much is it something else? Next slide. So I guess my question to the authors would be, does the same relationship exist if you use a gender gap in math PISA scores to measure culture? Well, I think it'd be very convincing since it speaks to something that most scientists need, which is mathematics. And in particular, since often there's a discussion about distributions, if you were to take the gender gap, say, in being in the top 10% of a country level distribution of PISA scores. By the way, I forgot to say, for those of you who are not familiar with what a PISA score is, PISA scores are reading and math scores, math tests taken for a representative sample of 15-year-olds from 40 plus countries, more or less. So would this be, if you were to take the top 10% of the country level distribution of PISA scores, would this be a better predictor of the share of female, of top scientists? And then your measure of top scientists had to do with citations. And as various panels that came before us have pointed out, those might be quite gender biased themselves. And so if they are gender biased, maybe what you're directly picking up is that bias and not necessarily in some other sense, what's the share of top female scientists. So it would be interesting to see if you could find some other metric, maybe patents, maybe something else that would be worth looking at. Next slide. So the paper that Mackenzie presented was based on a survey that she and her co-authors did in December of 2020 and January of 2021. And the main question that they asked is, how did the social justice movement affect faculty research, teaching, and service in the summer of 2020 and in the fall semester of that year? Their main findings were that Black scholars were more likely to report a negative effect on research concentration, on research and on concentration, and also a somewhat larger positive effect during the summer. Black scholars were more likely to report a negative effect on research in the fall, showing that these effects were persistent. Women and younger scholars were also negatively affected, and the time spent on diversity, equity, and inclusion services increased for all, but significantly more for Black scholars. Next slide. I guess one question I had was, did the time that women spent on DEI services also increase significantly more than their male counterparts? That's something I was interested in knowing from your paper. And of course, a big question is, how should we address the fact that some events have disproportionate effects on some groups? Next slide. Now, we ask, as you well know, especially in the last 10 years, for much more service work from URMs and from women, especially because they are underrepresented. Almost no place that I've ever been at or seen compensates for this, which is really a very unfair form of taxation, precisely because these are also not things that are necessarily going to get you tenure. So especially for younger kids, but really for everyone. I think that the fact that this is not taken explicitly into account is disproportionately benefiting some groups and disproportionately hurting others. And it's a system that really needs to be questioned. So moving to something like a point system for teaching and service work would really allow for easier and more transparent compensation. So you do more hours of service, maybe you should be doing less teaching, or you should be paid more. But there should be something that's done that explicitly recognizes the incredible burden that we put on certain groups in academia. Next slide. Moving on to the paper on women in economics in Australia by Leonora. The main findings there was that there was a shrinking share of women who enroll in economics in year 12, which is their last year of high school. There was a fairly constant share of women who enrolled for bachelor's degree in economics. And that when, which was established in 2017 and is undertaking many initiatives, seems to have made a difference. And we saw that clearly with the very large rise of people who joined I think it's called the ESA in Australia as a result of next slide, sorry. So what I did here is I just went to an Australian website just to see how different Australia looked, perhaps from the US. And what I would like you to concentrate on here is, this is showing you in, I'll call it rusty red color, the women, and an orangey color, the men. And what I wanted you to show you was what was happening in IT, because I want to make a comment about it. IT is in the middle row. It's the second from the left. And as you can see over time, the share of women in IT actually fell. Okay. Something that also happened in the US. Next slide. And I don't understand why it is that Australians call it commerce. But if, by the way, this combines commencing BAs and PhDs. So I'm not separating it out because it wasn't separated out there. This looks now more closely, as you can see, the share of women in math kind of stayed constant, the share of women in math was constant for a while, and then it kind of fell in the last few years. Similarly, it's falling a bit in physics. If you go over to the right and you look at women in economics, you also see that relative to the mid-2000s, there's been a slight fall of the share of women in economics. Next slide. Next slide, please. So I felt that Australia looked remarkably similar to the US. It shows a slightly shrinking share of women in economics, math, and IT, which is very similar to what we see in the United States. For myself, I would have loved to have seen the evolution over time of other fields relative to economics for easier comparison and also differentiating across academic levels, distinguishing between secondary school versus BAs versus PhDs. One has had a clear impact on the female share of keynote speakers and membership in the ESA. And the interventions that they've done makes use of the, is it Royal? I hope it's Royal. The Royal Bank of Australia's findings, it might not be Royal, the Royal Bank of Australia's findings that female students' interest in economics, and this has been repeated before in other sessions, relative to their male counterparts, is more strongly motivated by wanting to identify and solve problems and by interest in social issues such as climate change and globalization. Next and last slide. So some final thoughts about what we might be able to do or want to do. First of all, it seems obvious that teaching economics so that it focuses more on socially relevant questions may result in economics being more attractive to women and URM. For very similar reasons, I would say, it's also then more likely to appeal to students from less privileged socioeconomic backgrounds. These might also be students who are more interested in solving socially relevant questions. And of course, it's not that economics is not interested in socially relevant questions. It's just that first-year economics does not focus on any of them, for the most part. Now, a problem in economics is it's truly elitist nature. People think, partly because of ideology, partly maybe self-interest, partly some sort of bias, that what they attain is really their merit, okay? Yes, maybe what white men get, it reflects, something else, maybe there's discrimination, but if they get it, it's their merit. So, that's true for salaries, for publications, for prizes, for keynotes. I'm now speaking very much of academia where one really sees this. We now question this when it comes to white men. And maybe it's really time to think about the political economy of our profession and question the outsized influence of the top 5 PhD programs. Work that has studied the role of networking economics, works that would study the role of networks in economics, from editorial boards to assigning referees, to choosing speakers, to running the key prize granting committees of the AEA, would be very, very helpful in this respect. And I'm really looking forward to someone doing the same type of work that we've seen today from all 5 of you in very different ways, to doing it for questioning why we accept that the top 5 departments in our profession get to run things. Okay, thank you very much. With that, I think I'm in time, hopefully. I'm going to mute myself, and I'm going to let you answer whatever questions moved you to you wanted to answer, and why don't we do it in the same order of presentation? So why don't we start with you, Anna?
Absolutely. Thank you so much for that discussion, Raquel. I found myself nodding along to a lot of it, not just the parts that were about my presentation. So thank you. I'll address two things briefly. I mean, there's lots one could say, but just in the interest of time. The first point is about elitism and the broader question of Ivy Plus schools and BA institution. I completely agree that this seems to point up a broader question of why are economics PhDs selecting from these institutions or from a smaller subset of institutions? And why does that look different than in other fields? Is that a broader phenomenon of elitism? One of the things that we will be wanting to do is to dig deeper into other categories of BA institutions to look at this. So we just did this rough categorization of the Ivy Plus and looking at public versus private. We also want to look at the top public feeder schools into economics PhDs. We have very granular data thanks to the mobility study on undergraduate institutions in the US of the socioeconomic background by institution that we can hopefully match to try to understand these different feeding patterns depending on more granular BA institution. And that's definitely a priority. On the other point about international students, I think this is the big thing that we also want to dig into more. You're absolutely right. So 70% of economics PhDs granted in the US are to non-US born individuals. And this is the highest share of any PhD discipline. So this is one of the kind of unique factors about economics in the US. I'm one of those people. I wasn't born in the US. So trying to understand socioeconomic background for these groups and how that differs, and then also whether the internationalization of the economics PhD is sort of disproportionately edging out less advantaged US-born candidates is one of our priorities. 2 facts just to share with the audience quickly that I didn't share in the talk. One is when we do those buckets by parental education for all PhD recipients, wherever they were born, you still see that economics is pretty close to the bottom. Humanities starts to edge it out in terms of the lowest share of first-generation college recipients, but economics is still below math and computer science and still well below the other social sciences, even when you include all PhD recipients. Obviously, parental education means different things in different countries, especially when you look at the degree to which a parent having a postgraduate degree implies greater socioeconomic status than having a BA. So this is going to be a bit rougher, but when we look across continent of birth and look at PhD recipients across fields in economics versus other fields who are born in Europe, who are born in the Americas, outside of the US, who are born in Africa, who are born in Asia, who are born in Australasia, you also see that pattern re-emerging, that economics is less socioeconomically diverse on average, particularly for those born in Europe and in the Americas. Not nearly the same extent for those born in Asia or Africa, which is quite interesting and something we want to dig into more to see in which context are those patterns of advantage reproducing themselves. So I'll stop there and let the next person say something.
Yeah, wonderful. Thank you. Danielle.
Yes, so thank you. Yeah, we have a lot of additional results that we've been working on. We really wanted to focus on the outcomes by race for this conference, but we have been looking. Unfortunately, the diversity issue in economics is so severe that we can't do a lot of the exercises we're interested in by race. So those earnings distributions. We've done it by some other cuts. We did, there's enough gender distribution, enough observations by gender. And then we do the different institutions. And so that kind of builds on the hierarchy in economics. So we see that, I think you showed that we see in academia, the top 5 and top 20 matter a lot. Like the outcomes for those graduates are significantly different than those from the lower ranked school using REPEC ranks. Whereas if the economists that go into government and industry, we don't see that sort of ranking of outcomes nearly so strongly. So it's for thinking about the economics profession more broadly than just academia, maybe one way of sort of thinking about getting away from the elitism of the top 5 schools.
Thank you, Danielle. Mackenzie.
Thank you. You gave a wonderful discussion of our paper. One of the points that you made was about whether or not there were gender differences in DEI service. And Sarah and I haven't gotten a chance to look at that yet, but I wrote that down on something to do at the top of our to-do list. And I think, I've spent a lot of time, Sarah and I both have, trying to figure out, like, okay, now that we have these results, what do we do next? And I think your point about making sure that people are compensated for the work that they're doing is like the key highlight. So if you're asking people to do all this extra service work, but then that's not going to be rewarded in their promotion and tenure packets, that's a huge problem. And so we're hoping that by bringing awareness of the results from our findings, from our survey, we can get departments that kind of think differently about how they want to count the work that faculty do.
Wonderful, thank you. Leonora.
Thanks, Raquel. I'm so glad that this discussion has also brought up socioeconomic status because one of the findings from the RBA, that's the Reserve Bank of Australia, I'm sure they'll forgive you. So they also have detected a decline in school students from low socioeconomic backgrounds studying economics. So that's also very concerning. That also speaks to this thread of elitism because it can be mapped to the public versus private school divide in Australia and the fact that fewer public schools are offering economics as that feeder into the university system. So that's something that does need attention. You're right about expanding our analysis to take into account relativities and comparisons with other fields. The question about commerce, yes, I think economics also there's been a bit of an identity crisis within how to label economics, and in some sectors, economics has kind of been absorbed into something called commerce or business, and it's lost its distinctiveness and its humanities elements, which is part of WEN's mission to really emphasise that distinction from finance, from accounting, from business. And lastly, the metrics that we use to measure impact. I'm glad you remarked on that because at the moment, really, we're using existing metrics such as keynote presentations, prizes. That's the existing system. But part of change and progress is also about challenging that existing system and drawing upon, for instance, the importance of service, the importance of really making a difference to the profession, and how can we work out a way for that to be elevated and valued as a measure of impact as well.
Thank you for those remarks, Lenora. Renee.
Yeah, thanks a lot, Raquel. Just one point about the gendered citations. So I think actually, if our results are driven by gendered citations, it would make the same point if they were not driven by gendered citations. And so, because our point is basically that you can't argue that women's ability or women's preferences drive everything if there's variation across countries. In the representation of women, that's correlated with country-specific factors, right? So if the citation patterns are correlated with country-specific factors, it also suggests that it's not women's preferences driving the results, right? So obviously it would be cool if we could show like who's citing whom and see if that's, if there's clustering of citations within a country. I'm not sure we can do that, but I don't think it's a problem for the interpretation. But thanks for raising that, because obviously, gendered citations is a huge issue.
Okay, wonderful. I think we have 6 minutes or 5 minutes. And so if there's any questions from the floor, this would be an excellent moment to raise your hand and ask a brief, concise question. So I thought Chiara had put up her hand, but okay. So Neil Erickson, I think I have to get your hand or something. Yes, and now I unmute you. Okay, so Neil, I think you need to unmute yourself. Wonderful, we can see you. Neil?
Yes. Can you hear me though?
Can you speak louder or put up your volume?
Yes. So can you hear me better there?
Yes.
So first, as a member of the program committee for this conference, I'd very much like to thank Raquel for such a detailed and cohesive discussion of these papers. Then a couple of very specific comments. I was really delighted to see sort of constructive work that Leonora had presented. There's a lot of discussion on the evidence on gender and racial gaps in society. That's very key to document, but we also want to see what works. Very promising. On Anna's paper, I think it would really be interesting to go and examine the non-US born, not only for the reason that Raquel brought up, that it's such a large percentage, it may US-born PhD, but also that it's changed so dramatically over the last several decades. Go back 4 decades, and it was very much smaller. So there's a time series aspect to that. And it's really important to understand this because it has an influence on graduate schools' approach, PhD candidates, and also potential employer perspectives. And on that, I should note that historically, the Federal Reserve Board did very little hiring of US-born citizens as economists, and that changed about 2 decades ago thanks to some very forward-looking policy by this chair at the time. So,
thanks for those remarks, Neil. Any other questions from the floor? In that case, let me say thank you to all 5 of you. I really enjoyed this, and I'm sure the audience did too. And I'm sure everybody who's going to live stream it is also going to get a lot of it. I think there's 2 minutes left before the governor comes on, and so maybe we can disappear from the screen. This is a comment, I guess, to Tim. Bye,
Great conversation. I'll go ahead and take you off the stage now.
Okay. So on behalf of the Organizing Committee, it is my great pleasure to welcome the Governor of the Bank of Canada, Steve Macklem, to give the closing remarks of the conference. Governor, the floor is yours.
Well, thank you, Cesar, and good evening to all our participants and anybody who's been watching. It is a great honor to wrap up what has been a very insightful day and bring this valuable conference to a close. I'm grateful that what began in 2018 between 3 central banks has grown to include the Bank of Canada, and I am really looking forward to hosting the conference next year in Ottawa. The issue of diversity and inclusion is very close to my heart. And when a central bank governor says something's close to their heart, what do? They give a speech about it. In April, I gave a speech that outlined how diversity and inclusion in our profession and our institution matters. And I went further to argue the case for an inclusive recovery to the pandemic. My colleagues at other central banks have given similar speeches. Indeed, this morning, Chair Powell kicked off the conference by observing that entrenched inequalities that prevent some of our citizens from fully participating in labor markets not only hold them back from opportunities, but they hold the whole economy back from realizing its full potential. This conversation at central banks has sparked a debate about whether central banks are expanding their mandates, whether we're overreaching, getting distracted from our focus on inflation targeting, and even a criticism that we should stay in our lane. My own view is that we are tasked with serving our citizens, not some of our citizens. Now, I probably don't have to convince anyone here that diversity and inclusion matters at every level of economics, finance, and central banking. It helps to avoid groupthink, it improves decision-making, and it fosters innovation. The research presented today by Professor Sarah Smith reinforces this conclusion by measuring gender differences in the way economic opinions are expressed. And as Professor Michael Weber's research underlines, our institutions generate more trust when our citizens see themselves reflected in us. We also heard today that we need to go beyond understanding diversity and inclusion in economics and finance to understanding how the work we do as economists and central bankers affects inequality. And drawing on some of the insights from today, that's what I'd like to discuss before we wrap up. Improving diversity at central banks and the economics profession is important. And we are making progress, even though there is some way to go. And Nobel laureate Esther Duflo's keynote speech vividly illustrated this, highlighting that we need to innovate at every level to accelerate progress. We also need to work on being inclusive, and that can be harder to measure. As we become more diverse, we need to make sure the people we add to the discussion feel wholly included and valued once they're at the table. Research we saw today provided some innovative examples on how to measure inclusiveness. And importantly, we need to bring an inclusive lens to the broader economy so that the benefits of increased prosperity are shared. So how do we get there? I won't pretend this is a comprehensive list, but I would highlight 3 dimensions. We need to be better listeners. We need to be more inclusive and more relatable communicators. And we need to better understand how our policy tools affect equality in the economy. So let me take each of these in turn. As central bank leaders, we can get so focused on where we are going that we can forget to stop and listen as often as we should. And we need to listen more to people who haven't been part of the discussion all along. At the Bank of Canada, we work hard to keep the diverse employees we've attracted by ensuring that they feel heard and included. We have several employee resource groups made up of people from equity-seeking groups and their allies. They're making important recommendations to help build a truly inclusive culture. We've also stepped up efforts to understand diverse perspectives by engaging in a wide variety of groups outside the bank. Our colleagues at the Federal Reserve and the European Central Bank conducted mandate reviews that included outreach and consultation, and we've learned from that. For our review of our monetary policy framework, we met with a dozen civil society groups. We surveyed more than 8,500 Canadians, and we engaged over 200 people in online community discussions to gain insights into what they understood and thought about inflation targeting and the alternatives. All of this input is being considered as part of our upcoming renewal. In short, we listened. We've also added voices to our table. Recently, we helped found the Central Bank Network for Indigenous Inclusion, partnering with the Tulo Centre for Indigenous Economics here in Canada and with the central banks of New Zealand and Australia. And we're very pleased the Federal Reserve Banks of Minneapolis and St. Louis have also joined the network. This group is going to help us gain a better understanding of the economic realities of Indigenous peoples. Effective evidence-based policy decisions will require insights deepened by understanding. Our commitment is to listen to Canadians' diverse perceptions and concerns. We do that by engaging directly with a broader set of stakeholders and integrating a wide array of perspectives from research, analysis, and other sources into our work. That's how we're going to learn. Communication comes next, and yes, it's close to my heart, so I used my second public speech as governor to talk about it at Jackson Hole. The last 15 years have seen a profound change in how information is shared, consumed, and debated, and central banks need to adapt. The internet has slashed the cost of communication. This has disrupted traditional media and led a growing segment of the public to get their news from alternative channels and social media. But the democratization of information hasn't necessarily made us better informed. With more information has come more disinformation. On top of that, the pandemic and our exceptional bond buying programs have challenged public perceptions of our operational independence. So it's more important, but harder, for central banks to be trusted sources of information and analysis. We build trust by clearly explaining our objectives and actions. Traditionally, we've spoken to people through markets, the media, and experts. We talk to them, and they explain our actions to people. But in this new world of ubiquitous information, we need to develop a direct channel to speak to people. That means being more accessible and more relatable. It means having new communication products and vehicles. Most central banks have started on this journey, and it's no easy task. At the Bank of Canada, we are expanding the scope and reach of our educational programming of the economy and the role of the Bank of Canada. And we want to increase our accountability and relevance through clear, relatable communications. Trust comes when everyone understands the actions we are taking and why. Research today presented by Professor Michael Weber reminded us that part of being relatable is having monetary policy committees that are representative of the diversity of the citizens we serve. And Professor Paula Profeta finds that the best indicator of improved gender equality on a central bank's monetary policy committee is improved gender equality among central bank staff. This underlines the importance of our efforts to attract and develop a more diverse workforce. Factoring inclusion and equality into our policy decisions is where we really walk the talk. Monetary policy is not the primary policy instrument to address inequality, but our policy formulation benefits from more diverse inputs, and our policies can affect inequality. Let me offer some live examples. First, when we set out at the Bank of Canada to review our inflation targeting framework with the federal government, we invited all Canadians to participate in the renewal process, and we published a report on what we heard. One message that came through clearly from Canadians is that they want our policies to be fair for everyone. Our focus on inflation control has long recognized that inflation is particularly tough for Canadians on low or fixed incomes because they are most affected when the purchasing power of cash declines. Low-income workers are also the most vulnerable to the boom and bust inflationary cycles. But is there more monetary policy can do to bring about a more inclusive economy? Very unequal impacts of the pandemic and the exceptional monetary policy tools we have deployed are challenging us to think more deeply about this question. In responding to the pandemic, we paid close attention to its very unequal impacts across sectors and across workers. We're also looking at how the monetary policy tools we've deployed, including quantitative easing, are affecting inequality. As the policy panel we had today made very clear, other central banks are also focused on understanding the distributional impacts of monetary policy. Changes in monetary policy have always had consequences for both income and wealth, on how both income and wealth are distributed. Similar to reducing interest rates, QE works to stimulate demand by lowering borrowing costs and encouraging spending. This supports job creation, and it's clear that the single best contributor to reducing income inequality is to get people into jobs. At the same time, our policy interest rate and QE also affect the prices of assets and not just the prices of government bonds. QE can boost wealth by increasing the value of assets, such as the investments Canadians have in their retirement savings plans and company pension plans. But of course, these assets aren't distributed entirely evenly across society. As a result, QE can widen wealth inequality. We will look closely at the outcomes of QE here and elsewhere, and we'll work to more fully understand its impact on both income and wealth inequality. Let me conclude. The conference today has sparked important research on diversity and inclusion at central banks and within the economics profession. It's my hope that this will help drive change at our own institutions and around the tables where decisions are taken. And I hope those decisions can ensure the economic recovery from the pandemic is as inclusive as possible. Thank you, everyone who made today's conference possible, despite the challenges of time zones and geographic reach. I look forward to seeing many of you next year, and I really hope we can be together in person in Ottawa. We need to continue this valuable work. Thank you.
Thank you, Governor Macklem. This concludes our third conference on diversity and inclusion in economics, finance, and central banking. Thank you to all the presenters, the discussants, the panelists, the participants, the session chairs, our technical staff who've dealt with all sorts of challenges. We appreciate you. And of course, those of you who are watching online. It's been an incredible day with a lot of, I thought, very productive conversations, and I too look forward to seeing everyone in Ottawa to continue that conversations. Thank you very much, and take care.